What's up, team? Whew. All right, we're up today. It is 5 in the morning, Texas time, 6 a.m. Central time. How you guys doing today? Today we have non-farm employment change data dropping at 8:30. We got Jerome Powell speaking at 10. And so, yeah, let me know what you guys are expecting for today. Just as we said yesterday, we told you guys that we thought we might pull back a little bit yesterday. And that's exactly what we got. We got exactly that, a pullback, and we basically called that exact thing that happened. We told you guys we thought we'd probably dip, that we had liquidated, almost all of our swing trades ahead of the Jerome Powell congressional testimony yesterday. And again, it looks like it was the right move. We got out. This is how you start to get in kind of a flow state of the market where you can kind of see and potentially understand what the reactions to stuff might be. The whole, thesis of why we chose to make that decision yesterday was simple. It was because in between yesterday and the previous Jerome Powell speech, or Jerome Powell going live, we had negative inflationary data. And so because of that, our assumption was that, he would come out and say some corrected things relative to before, because the inflationary metrics that we had gotten previously, like CPI, PPI, all that stuff was worse than the last time. And so he did need to update us in that regard. And that's exactly what he did. He updated us. He said that he would, we could potentially do 50, essentially. So yeah, we were spot on. Anybody that watched the stream yesterday should, remember we said us saying that, and yeah, we were right. Yes, Powell speaks again today. So yesterday he spoke in front of the House, or in front of Congress. Today it's going to be a House congressional. It's going to be a House testimony. I mean. All right, guys. So. All right, guys. So yeah, market's actually bouncing back a little bit over the last couple minutes. You can see Tesla at 187s. The question is, are we buying this dip? I think that's the question. All right, guys. Do we bounce today, guys? All right, but yeah, SPY at 3.99. Are you guys buying the dip? That's my question. I don't know yet. Yeah, we bounce. Oh, I'm still in TRKA. Yeah, honestly, a terrible trade. And one of the reasons I genuinely just don't trade penny stocks, man. You know, like this is why you don't trade penny stocks, is because they get pumped up, they get sensationalized. Everybody says, buy them, they're great, they're going to be amazing, they're going to go crazy. You know, you look on Twitter prior to the dump yesterday, everybody's like, TRKA is going to go crazy. I mean, I'm down like 40 bucks, 50 bucks. So, you know, I will exit it today when I can. But yeah, this is why you don't buy penny stocks, guys. This is why you don't buy the hype. You're going to have a lot of people telling you to buy it. You're going to have a lot of people telling you it's different, that somehow it's different than all the other penny stocks out there. And it never is. These are terrible companies that are just, again, just terrible companies. For the channel, bro, I'm always hating on penny stocks, dude. I'm always telling people not to buy them, you know. You were the one telling everybody it was going to go crazy, but yeah, I lost money on it. Again, it's all good. It's $50. I'm not super upset about it. I'll probably use it as a educational experience though for the channel as a whole. Though I'll probably tell people, hey, look, you're gonna have people that tell you to buy these things. You're gonna have people that tell you they're different. If you look on Twitter, you got a bunch of people saying TRKA, gotta do a crazy squeeze. You know, very rarely does that ever happen, and you know, I think you got to just call a spade after a certain point. And you can trade these, you know, but in the end, most of the time you're going to lose money for them. No, I think I'm monetized. Yeah, I'm monetized. Yeah, we're live. We're monetized. Yeah, I just checked it to be safe. Yeah. Oh, well, yeah, it's definitely a terrible trade. But I mean, again, it's 100 shares. I lost 50 bucks on it. It's one of the reasons, like, you could say you made however much, and that's fine. But like, it's genuinely one of the reasons I don't buy penny stocks. You know, because by the time you hear about them, here's the reality of it. By the time you actually hear about penny stocks, they're probably extended at the top. And again, I'm not mad about it. I mean, you guys might say I'm mad about it, but like, I got in this understanding the risk. I told people yesterday I might lose $50 if I'm wrong, and that's exactly what I'm down. I'm down like $52. And it's all good. It really is. Like I said, I'm not hating. Maybe there's other ways to make money, but like, I've been a broken record with this. Again, penny stocks are suckers bets. You know, they're trades for, maybe you make money on one specific penny stock, but the problem is, like, most of them will not do even what TRKA did, you know. See how easy it is to get caught up in the hype? Oh, 100%, man. I absolutely true, bro. And again, I'm very green on the year, you know. Like, I don't trade penny stocks for this reason, and I'm very green on the year in my Thinkorswim account. It really is one of those things where I'm gonna use it as like an educational thing. Like, hey guys, like I got caught in TRKA hype, uh, and I lost. And this is the reason penny stocks just don't work. Is because here's the difference though. Like, here's the thing. This is the talking point I'm gonna use with it. Is that while I have when I spent $100 in a $30,000 account buying TRKA, you got new traders who spend thousands and thousands and thousands of dollars on these stocks, and lose everything they have doing what I just did, except I did it with 100 shares, Yeah, y'all might be right. Like I said, maybe I got in late, 100%. You just have to learn to take profits, moon market covered. Hey, like I said, I think it's easy to say, hey, you got to get in early, and it's easy to say, hey, well, whoever covered this 10 days ago. But if you look on Twitter, that wasn't the overwhelming sentiment for most traders, I would say, when it was at like 90 cents. That wasn't the overwhelming sentiment. The overwhelming sentiment was that it was going to squeeze, it was going to punish the hedgies, and again, it's 100 shares. Like I said, I'm down $50. So I have the ability to be able to laugh at it. I really do. Where a lot of people don't. And I think that's the lesson, is that where I lost $50 in a $30,000 account, some people lost thousands and thousands of dollars. And the other thing is, like, okay, we can look at this and say, oh, well, moon market covered it 10 days ago or whatever it was, right? But I think the context that you need to have there, and again, it's all love here. I'm not hating on anybody. Like, again, it's all love here. Again, hopefully I can use it to save some traders money, which is what I'll try to do. But I guess what I'm trying to say is that you can look at other YouTubers and say, oh, well, this person mentioned it 10 days ago. But what I really recommend that everybody does in that situation, what I really recommend you do, is go back and look at all of their call outs, not just the ones that are successful. Go back and look at all the stocks that they say are going to go crazy, are going up big. And you'll see that, like, I would say less than 20% of the stocks that people mention like that actually run, like less than 20%. And so it's like, you can say, oh, well, you just got to wait for them to call it out 10 days ago. The problem is that if you do that each time, which is the only way to trade, is to be consistent with, the stocks you do it on. If you do that each time, you're going to lose money too, And so point is, it's incredibly difficult to make money. I saw a post on Reddit where someone went all in on TRKA, 100% of his buying power. He's down 45K. Can't feel bad for, 100%, man. I don't feel bad for them. I mean, I feel bad for them. Don't get me wrong. I actually do feel bad. But it is what it is, man. Like I said, I'm one of the biggest people on YouTube who tell people not to buy penny stocks, man. Like I said, you'll have people that are like, nah, bro, I made $537, $1,000.26 yesterday trading penny stocks. To be honest, half of them are just full of it. Half of them are actually down on the year, and like they're just trying to justify their own trades to sound cool on the internet. Most of the time, I would say people are losing money trading penny stocks in that way. Like, I would say most people are losing money trading penny stocks that way. Again, maybe some are making money from it. I'm not saying they're not. What I'm saying is that most people lose money doing that. Honestly, this is an insignificant part of my trading, though. Like I said, I'm down $50 in this. One thing that I'm incredibly proud of is that I called this huge drop in the market yesterday. I told people I had liquidated my whole swing trading portfolio for the most part. I'm still holding AMC because I don't think AMC really moves with the market. But luckily, I liquidated basically all of my swing trades leading up to the Jerome Powell Congressional testimony yesterday. And it was the right move. I had people trying to tell me to buy stuff yesterday in mid caps, and it was the right move to liquidate because the market dipped down heavily. And again, the question I have now, we did a Twitter poll. The question I have now is, do you buy this dip in the market now? Do you buy this dip? What about SI? I don't trust SI either. Like the most you'll see me ever play with penny stocks is what I did with TRKA, where I buy like 100 shares and I lose like $40. And again, I think like the reason I take trades like that is because I look at it in terms of like risk and reward. Um, no, I'd rather buy the SQ, so you'd rather short. Like you said, John, name one penny stock up on the year. Yeah, I mean, there's a couple, but it's certainly not a majority of them. I'll put it that way. Yeah, bro. Honestly, the argument at the beginning, it's not a short attack. This is not a short attack, guys. Like, I'll put it this way. TRKA dipping like it did yesterday is absolutely not a short attack. Like, you can tell by the price action. TRKA dipping yesterday is everybody that wrote it up over the last couple months taking profit. Like, they're rushing to get out of it. That's all it is. That's all this is everybody that bought it over the last couple months saying, oh no, the moon is over, let's get out. That's what's going on. Yeah, so today we got non-farm data. It'll be interesting. Yeah, we're gonna do a poll here today. The float size? Let me see. I can check the float of TRKA. TRKA's got a float right now, according to Yahoo Finance, of about 30 mil. FinViz about 32 mil. TD Ameritrade says it's got 67 mil. Morningstar says it's got 26 mil. Wall Street Journal says it has 35 mil. Short float is anywhere between 30 and 50%. Yeah. Hey, at least if you do it right like that, Matt Kors Fanny Pack, I get it. Like, that's the only way to do it. If you're gonna take penny stock trades, the only way to do it is to get in and get out fast. But unfortunately, and be real, like, what I'm about to say is true. Unfortunately, that's easier said than done for new traders. Like, I'm gonna cut this immediately. I don't care about my $50 enough to hold TRKA. But think about it like this, right? There's a lot of traders who, instead of spending 100 shares, spent thousands and thousands of dollars on TRKA. Thousands and thousands of dollars, right? And so when you're down $5,000+ on TRKA and it's down big, it's really tempting to say, hey guys, I'm not going to sell. I'm going to diamond hands this. I'm just going to sit on it. And then you just kind of turn into long-term investors. Eventually they get delisted. Eventually TRKA, which, let's be real here, is a terrible company, is going to get delisted and probably go to pink sheets, is my guess. Maybe not, but I'll put it this way. It's not the first obscure media company to hype itself up and pump itself up over a short period of time, I didn't say that 350 million. It doesn't have 350. It has I mean, I don't know. According to most brokerages, it's got about 35 mil. Why do you think it has 350 mil? Yeah. Well, yeah, they don't have put options because, frankly, to short something, you have to have long-term investors, and these things don't have long-term investors, as well as they don't have people selling put options because, again, somebody would have to be crazy selling put options on something like this, All right, Apple dipping down a little bit. Are y'all buying the dip here? Let me look at some of my favorite stocks. So we got out of Google yesterday. We got out of SPY. We got out of Google. We got out of Ford the last couple days. We got out of Microsoft. Microsoft's still pretty high up there. Microsoft holding better than a lot of this other stuff. Meta dipped, but Meta was up on a big run the last couple days. Google pulled back, but it still didn't pull back that much either. So the SPY actually dipped pretty heavily relative to everything else. So what dragged the market down? Walmart dipped, Target fell. What's up, Layla? Yeah, we cut most of our swings yesterday. Oh man, that's what's going on. For TRKA, the company got a minimum bid, a minimum NASDAQ listing requirement letter, which means that, to put this into perspective, right? So like when terrible companies are listed on the NASDAQ, a lot of them will fade down under the minimum price to be listed on NASDAQ, right? And so NASDAQ will send out what's called minimum listing requirement letters, basically saying, hey, look, if the price of your shares are not over X amount by this date, then we're going to delist you and you're going to go to pink sheets, basically. And so apparently that's what happened with TRKA. And that's probably why we got this pump. Here's the reality of it though, guys, is that an offering is probably pretty likely here for TRKA. Like a lot of struggling companies will pump themselves up and then they'll hit you with an offering and dilute their company and sell shares. Once the pump is done, they'll dilute the company and sell shares and then scam basically everybody in them. And then the price will go right back down. I don't know if that's happened already for TRKA. Again, I don't really know too much about it. Luckily, my average was like 80 something cents. And so it wasn't even 90 cents. So like, glad I didn't spend too much money on this thing. Oh, so it did do an offering, Snow. Well, I mean, both of them might be true, where they got the NASDAQ minimum listing requirement, and then they decided to dilute themselves and do an offering in order to stop that, you know. Are they going to do a reverse split as well? Is what I'm assuming could happen too. What's up, Ricky? What's up, Dan, Marcus, Mark, Anonymous, Johnny, Matt, Layla, Sim, Snow, Martin, Pawn, Cake, Maximus. What's up, team? What convinced you to buy that thing in the first place? I thought you were better than that. I mean, listen, I'll play around with penny stocks. Like what I always do when I do this, like you see, I bought 100 shares, right? I bought 100 shares. I lost $50 because it's just one of those trades where, number one, the reason I get into trades like this is because sometimes I've been lucky with regards to squeezes, right? So I've been able to enter with a small share size. If I lose, I lose $50. If I make money, I can make hundreds sometimes doing this. If they get a crazy run up, but a lot of the time, this is going to happen. And so it's just kind of trades that I'm okay with losing whatever I lose on it. Small risk trades that potentially have a larger reward. But yeah, this one just didn't turn out to be that. Again, I'm in that at the 80. So luckily we're down a pretty insignificant amount, but yeah, we're not perfect traders either. We kind of get caught in nonsense too. Just say no. FOMO is real. Hey, kind of. It happens to everybody. Luckily, when I get caught in FOMO, it's with very small size. Like, I don't think I've ever been like, hey, I'm buying this. I don't think I've ever been like, hey, I'm going to buy this really hyped up penny stock and put thousands and thousands of dollars in it. I don't think I've ever thought that. I don't think I've ever done that, luckily. Here, vote on the Twitter poll here. We asked people, do we drop or bounce more after JPOW? Vote on that poll. Yeah, worst case scenario, I'm down a tank of gas. And that's the way I really looked at it, is that okay? And to be completely honest, if you want me to be completely honest, I probably would have liquidated this when we got that huge dump yesterday at 80, 70, 80 cents. To be completely honest, I just forgot about it, to be honest. I completely forgot I was holding it. And then when I woke up this morning, the chat reminded me about it, and then I had to look at it. But yeah, to be completely real, I honestly forgot about it. Like, it just didn't mean much to me. It's a little bitty trade, you know. Like, if I'm in swing trades, I'll wake up and I'll check blue chips. This was just something that I completely forgot about. Oh, I bet it did, MS, man. Yeah, I was thinking about you when the market tanked. I was like, yep. Remember, I told you it might work out. I thought it might work out too. I liquidated my swings. I didn't take anything short, but I liquidated my swings by the same logic, man. By the same logic. And as soon as we tanked yesterday, I was like, man, my guy probably made some money. So good trade, bro. Good trade, man. I thought it might work out for you, though. You know, I genuinely thought it might work out. And of course it did. But yeah, today Powell speaks again. So yesterday was a congressional testimony in front of Congress. Today is in front of the House. So it'll be fun to see what happens. All right, guys. All right, so Jerome Powell basically said the only way out is for Congress to raise the debt ceiling. All right, guys. So yeah, we did get some more votes on Twitter. 89% basically think that we don't bounce today, that we drop more. I'm gonna go ahead and do a poll here since we haven't done one yet. And it's gonna be bullish or bearish on today's non-farm data. Bull or bear on today's non-farm data. We do have non-farm data coming out at 8:15. I believe it's actually at 8:15. But yeah, so are you buying the dip? I think there's an argument for it. I think that now we got the negative sentiment stuff out the way with yesterday's Jerome Powell House or Congressional testimony. I think there's an argument for maybe a potential bounce now, but I don't know. DCA, yeah, it depends on what your plan is. DCA can be a good move, but it needs to be, you need to be okay with pullbacks. basically, Andrew. I mean, I DCA not into the S&P 500. I like to pick out the individual stocks myself because I think when I do that, it's easier for me to find value, like objective, cheap value. Uh, you know, but I don't know. 3,200 on the. I'm assuming you mean 3,200 on the S&P right now. The S&P currently is going to be at about 3,900, 39s. 3,200 is a very large drop. I would almost certainly buy that dip. I think 3,200 would be well underneath the low of the year on the S&P 500. So yeah, I would absolutely buy that dip. And even if we pulled back more, I'd probably try. Once that happened, I'd probably dollar cost average into the market at around 3,200 over a couple weeks period, and try to just get a good average. And if we keep dropping, the DCA would kind of curb some of the volatility from that, and I'd be able to get a good position in. But yeah, 3,200, man, that's going to be below the yearly low, the 52-week low. I would certainly buy it there. I'm not telling you should, but I would certainly be buying up stuff there, to be honest. Yeah, that's what I'm assuming, MS. And so I'm assuming a bounce. And we might position ourselves for one on some stocks, but it depends. We're not going to take any large positions today, but we might buy up a little bit of stuff, anticipating the opposite of yesterday, basically. But yeah, for sure, Marcus. Good hedge, man. Yeah, 10 a.m. Eastern time for Jerome Powell Island time. Yeah, for sure. So he speaks at 10 a.m. Well, people on Twitter are never optimistic, to be honest, and that's okay. Like I'm okay with bears. We're getting a little bit of a bounce right now. Again, part of me wants to buy this dip. I might buy this dip short term when we can trade. I still got a couple minutes before I can, though. But I might buy this dip when I can trade. The market's a little extended, so it's hard to look at right now. It's hard to gauge. Yeah, I mean, Matt Kors, no offense, man. It does seem like you're kind of trying to pile on and just kind of troll a little bit, especially since I've never actually seen you here before. So if it's your first day here and you're trying to be overly critical over a little bitty, like I said, I think the way you have to understand it is that it's easy to say, hey, don't pile in at the top. But yesterday, most people were saying that we were going to squeeze up well past where we were. And so, again, I guess the easiest way to put it is that TRKA has been up big percentages for the last 20 plus days. You know what I mean? So it's easy to say now that we've pulled back in hindsight. Yeah, we were at the top yesterday. It's really easy to say that. But if you look at a lot of the influencers talking about TRKA, not many were saying we were at the top yesterday. Most of them were saying, oh, we're going to keep going up. We're going to rip up big. The other thing is, again, it was 100 shares. I lost literally $50. And so I could take whatever trades I want. I don't have an obligation to anybody to take trades, and trying to critique a losing trade just because, it goes against the, what people want, isn't necessarily reasonable. I think that most penny stocks are going to be suckers bets, that people are going to be down. I think you're going to have people, when I say this, that are like, nah, bro, I'm up 500% on the year. But the reality of it is most of those same people are down on the year. They just don't want to say it. Most people that invest and trade penny stocks are losing traders, 100%. And you're going to have small little pockets of winning traders, but it's certainly not the majority of them. And, if I have an obligation or a duty to my viewers, it's to tell them that most penny stocks are scams and that don't get stuck back holding them, because almost all of them are going to get delisted, go to zero, including TRKA. That's about the realist I can be with penny stocks, is like they're all scams. And that's what I tell people most of the time here, is that they're all scams. Now, I can take a small risk, big reward trade where I'll probably lose, but the times that I win are going to maybe justify it with TRKA like I did. But again, it's the reason I got out of this one is because I got stuck in the drop, and I completely forgot about the trade. Like I completely forgot about TRKA. I probably would have cut it at like 50 or 60 cents yesterday, but to be honest, it just didn't mean that much to me. It was such a small trade, it didn't matter. Um, just to be real about it. I think being a bear is a losing strategy. It depends on what time frame. I think short term you could be a bear. That's fine. I think long term, if you're betting against blue chip stocks long term, it's the worst. It's the worst direction you can choose to go on blue chips, because most blue chips are going to go up 8 to 12% a year on average. Sometimes less, sometimes more, but 8% I think is what they give you on average per year. And so to bet against that long term, so to bet against blue chips long term is the worst direction you could ever take, because it's going against long-term statistics and probabilities. Ford yesterday. Yeah, I'm thinking about buying the dip. We'll see. Yeah, again, the easiest thing to say here, like the easiest way to like shut down people who are going to try to like harp in on anytime I lose, the easiest way to shut it down is that I'm green on the year, and I have to be green on the year, because if I wasn't, I could actually get in trouble for saying this. I'm green on the year on Thinkorswim. I paid capital gains taxes last year in stocks and crypto. And so, people could say I'm a bad trader. They can say, oh, or whatever they want. But like, again, it's just talk most of the time. And it's all love here. I don't claim to be an expert. I'm certainly not a guru, and, people can do whatever they want. Tesla down at 186 it's at the bottom of the 20-day range. I don't know what we're going to do here. I could buy this up, but I think Tesla's a little bit too volatile for me personally, for my taste here. Show us the silver prize, or this thing. Look at this thing, man. This is just the most beautiful thing ever here. Yeah. Right, I got my sneaker to hold it up at the back. There we go. There we go. Buy up Tesla. I don't know about that, man. But yeah, you got the play button right there. I'm not gonna buy it up yet. We'll wait. Remember, guys, we do have non-farm payroll data. Today's not non-farm payrolls. Today is non-farm employment change data. So it's still job data, but it's not as big as non-farm payrolls. Non-farm payrolls is going to be on Friday. Today, we've got the NBA mortgage index data. We got ADP non-farm employment change data expected to come in at 200,000. And again, this is one of those things where we don't know what kind of reaction we're going to get in markets. We don't know if this is going to evoke a positive or a negative reaction. ADP is who performs payroll services. The ADP National Employment Report is a measure of the monthly change in non-farm private employment based on payroll data of approximately 400,000 U.S. business clients. The release 2 days ahead of Gov data is used as a predictor of Gov labor market report. Stronger than forecast is supportive of the U.S. dollar. Weaker is negative for the US dollar generally, but I think because of that, I think higher might be interpreted as worse. I think higher data here might be seen as bad because of inflation problems, right? At least that's it's been consistently that for a while now. And again, I'm not saying what we're going to get. I don't know. Expectations for this are 200,000. So I think if we do over 200K, it's going to be interpreted as a negative here. But I'm not 100% sure, to be honest. Remember to get in at some point. You always say, I wish I would have bought that dip. Yeah, but I think one of the reasons I'm green on the year is because of that. Like, one of the reasons I'm green is because of that that selectivity. Like, I'm very selective with what I buy. I'm very selective with when I buy. And then when I buy, I go pretty big into what I buy. And so I have to be very selective. So what I'll probably do today, just at least what my plan is so far. And again, I'm going to preface this with like, don't copy me. I have no idea what I'm doing. I might be wildly wrong about anything and everything. But what I'll probably do is I'll probably start to establish some small blue chip positions. Like, I'll probably try to establish some smaller blue chip positions. I'm not going to take big size, and I'll tell you why. Is because we still have a lot of data coming out over the next week. We've got a lot of data. Over the next 7 days of market activity, we have unemployment, non-farm payrolls. We've got Jerome Powell speaking with the House today. We've got jobless claims Thursday. Next Tuesday, we have CPI data. And then I think we have PPI data next week as well. And so the next 2 weeks are incredibly full of economic influential data that I don't really want to get. Again, you got a lot of people yelling crash, 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 right? I saw somebody post about it yesterday, and I absolutely agree with them, where they said generally when we crash, nobody expects it. Right now is different. Right now, you got so many people yelling the sky's going to fall that they think the odds are against the crash happening. And that's kind of the stance that I've taken. I just don't think we're going to crash. I think the only argument is that people say, oh, well, we have to have a recession before a crash, or we have to have a recession before we bounce. To be honest, we kind of already had one. We've had 2 consecutive GDP losing GDP quarters. So by that logic, that could be considered a recession. We might have had a little mini one, and now we're bouncing back from it. But again, I don't know. I really don't know. But that's my plan, is to take very small blue chip positions where I can get out fast if I need to, basically. And we'll see. And if we're very correct short term, then we'll take profit, of course. So yeah, I mean, Anonymous, you talked about the SPY breaking 30, or the S&P. So number one, it's not the SPY, Anonymous. You're talking about the S&P 500. The SPY is in hundreds. So the SPY is basically in hundreds. So the SPY right now is at 39 or 398, basically 399, 398 on the SPY. So basically what you're asking is what happens if the SPY breaks 350. Is what you're asking, basically, if the SPY breaks 350, which would be 20% or roughly drop in the SPY. If the SPY breaks 350, obviously it's not going to be good. Obviously people are going to be skeptical. I'll probably be buying up stuff at those points, though. But again, obviously it's not going to be great. Yeah, all good. It's all good. What do you consider a crash? I think most people consider a crash a very fast 15% drop. So, I mean, if we dump under 350 on the SPY, that's going to be considered a crash. And again, I don't know if we get it or not, but that's what's considered a crash. So yeah, we're probably going to cut TRKA right now and just forget about that one. We lost $50. Right, 100%. Most people are losing money trading in general, not just penny stocks. Yeah, for sure. But I think, okay, I'll put it this way. I think that the shorter time frame you zoom in, the harder it is, the more people are losing money. Like, the shorter time frame you're in, the more people are losing money. So I'll put it this way. I think you got a decent amount of people losing at investing. I think when you zoom into swing trading, I think you got even more people losing at it. When you zoom in to day trading, you got even more people that are losing at it. When you zoom into day trading penny stocks, you got even more people that are losing in it. I think that's the way to look at it. I think that's probably the truth. And nobody likes to hear it because, again, I guess it's like everybody wants to believe that day trading is going to have a low barrier of entry. Like you're going to be able to day trade penny stocks and get rich, right? That's what everybody wants to believe. I don't know if I buy it though. I think most people are going to lose money. All right, we're going to finally buy up this dip of the SPY here. We're going to buy 25 shares, just a little day trade. Again, don't copy me. I have no idea what the SPY is going to give, but we pulled back enough for me to be comfortable buying the small pullback here and see if we bounce. I might add a little bit to it if it pulls back. The reason I'm buying this is because the volume weighted average price and the 200 EMA are right next to each other here. You can kind of see both of those levels right there. So we're going to buy small, take a little small risk and see what happens. Yeah, you better believe we're going to be buying stuff up if we do crash for sure, All right, yeah. Meta's an interesting one that we might get a little pullback in. All right, we're going to go ahead and take another 25 shares. I'm old enough to remember that someone razzed you for 1 minute period charts. Yeah, they were just emotional. Like that's all it is. Like again, I posted about it on Twitter yesterday, where it's like when they can't critique my trade, so they critique my time frame. Again, like I said, anybody. I'll put it this way: anybody that's genuinely trying to critique me for having 1 minute charts up on the screen is just emotional. Like that's just emotion, because like anybody that's looking at it objectively is going to say, okay, well, like if he's scalping, you're going to use 1 minute charts for scalping. Now, the person, whoever's critiquing it, might not like scalping, but scalping, you're going to use 1 minute charts. Number two is like they critiqued me for my swing trades, and then they critiqued me for using 1 minute charts. And so it's like, okay, the other part of that is that anybody that watches this stream, and really just anybody normally knows I don't swing trade off of a 1 minute chart. That's like a ridiculous assumption, is that I'm swing trading off of a 1 minute chart. Like when I swing trade, I put like a 20-day chart or an hourly chart sometimes, or a 4-hour chart or a daily chart. Nobody in their right mind is swing trading off of a 1 minute chart. It just doesn't mean anything. Like most of the time when I have a 1 minute chart up like this, like during big economic releases, it's only because I'm trying to show people the reactions to the data, and so like how do you watch the reactions in the closest way? On a short-term time frame. You got to look at a 1 minute chart. I'm not going to put a 5 minute or a 15-minute chart up as data comes out. Then people aren't going to understand the extent of the movement from the data release with any other chart outside of a 1 minute chart. It just doesn't make sense to use anything else during those data releases. And so again, it's kind of one of those things where they can't really critique what I'm doing, and so they try to like desperately find reasons to criticize because they've been wrong. Like that's all there really is. And in the end, it honestly gives me even more pride about it, because it makes me realize that like they're just throwing stones because they're mad, and that feels good. That feels good, to be honest. The question is, do you buy Meta here on this pullback? Like, do you buy Meta on this pullback? I don't know. Yeah, we get in a limit order right here. Term crash is subjective. Yeah, for sure. But most people are going to consider crash a very quick, like what, 15 to 20% drop. But it is subjective. It varies. It's opinionated. Is basically what subjective means. It's an opinion outside of fact. Right, 100%. Yesterday, they tried to laugh at you for selling before the dip back down. 100%. Silence after you made the right move. 100%. They tried to make fun of me. What was really funny is like during the Jerome Powell press conference, right? We made money yesterday. Like during the Jerome Powell press conference, we started shorting stuff. And rightfully so. The market was dumping down, right? So what we do is we'd wait for a small little bounce and then we'd short. When I was shorting, I had so many people trying to make fun of me. They were like, ah ha ha, this dude's shorting. Ah ha ha ha. And then it's like we start to drop, like we start to break lows, and then it's just kind of cricket, 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 you know? And so again, if I could teach anybody anything on this live stream, it's to not let people influence you that much, because every trade, every step I make here, every move I make, no, every step I make here, people are going to try to critique what I do. And most of the time they're wrong. And so you got to go your own way. You can't get pulled in too many different directions. Like in the end, the reality of it is most people are biased by their own, like what they want to happen. So you're your own best advocate. You're going to look out for yourself the most. And so you're going to understand what you're doing more so than anybody else. Even with me, like, don't let me influence you too much. Because I have my biases as well, I guess is the point. All right, so we're in the SPY. We are break even essentially right here. I'm also thinking about buying Meta, but I think Meta is a little bit more up in the air. Snapchat, hey. Yeah, so you can see we bounced. Maybe I should have took it a little bit larger size, but we did bounce a little bit at this 200 EMA VWAP area. People get mad at me for even my pronunciation of VWAP. They say, "Oh, it's VWAP." You know, it's like, bro, be quiet, man. What about Tesla here? Tesla's down. Are y'all buying the dip? I don't know, man. I did a Twitter poll, and I asked people, "Are you buying this pullback?" 69% said no. We drop more. My HKD is up. No, it's not up much. Oh, it is up. Oh, that's nice. Oh, nice. It's gapping up some. Like I said, I'm holding one share of this, you know. Yo, John, the market's going down. We dropped yesterday. Yeah, no, I literally called the drop yesterday. I exited all my swing trades. Told people we might pull back some. Told people I was skeptical and wasn't buying up stuff. And again, the logic of it is important to understand. Like the reason I knew, or I didn't know, but the reason I guessed we might drop yesterday is very simple and it's easy to understand. Okay, if you follow the press conferences with Jerome Powell and you follow what he's actually saying, which is going to be a big influence over markets, if you actually follow what he says, if you want to find discrepancies in price action between what he's saying, you got to look at it like, okay, the last time he said this and what has changed since he said that, right? And that was my logic of liquidating my swing trades, is because last time Jerome Powell said 25 basis points was probably going to continue. And what had changed between yesterday and the last time he spoke? What changed is that we had worse inflationary data come out. We had CPI higher than expected. We had PPI higher than expected. We had worse inflationary metrics relative to when he spoke last. And so because of that, my assumption was that he was going to update us and give us some corrected projections based off of the worst inflationary data that we got. And the market might not love that. The market might dip back down. And that's exactly what we got. We got updated inflation expectations. We got updated rate hike expectations. Basically, Jerome Powell said we could do 50 in March 22nd. So that's why we did it. And again, at this point in time, we might buy up stuff because now that he got that out the way, maybe we get a bounce now. Maybe not. Maybe we keep dropping. I really don't know. But maybe he got it out the way now and maybe we're going to bounce. I really don't know. But if we do take some positions, again, it's going to be small trades because Today we got non-farm data. We got Jerome Powell speaking with the House, testifying in front of the House today. We got jobless claims tomorrow. Friday we have unemployment in both the U.S. and Canada, as well as non-farm payroll data. Friday. Next Tuesday we have CPI, which is the biggest inflationary metric that the market looks at. Is CPI. It's Consumer Price Index. It's the largest inflationary metric, and it's the biggest reaction we're generally going to get with economic data. We're going to have we get thousands and thousands of people tune in for our CPI streams. Generally over 5K people are here live, and we probably get 30 or 40,000 watchers total on the stream. So yeah, it's a big day Tuesday of next week. It will influence markets, and it's something that if you're taking trades, you need to understand next Tuesday is big and might influence your trade and holdings in that way. You think I'm in my mom's basement? Bro, I'm married. I got kids, bro. You want to see my library, sir? Look at that library over there. See that library? Man. My mom's got some nice books over there, huh? You know? Come on now, man. Steering wheel falling off on Teslas. Hey. Hey, what's up, Chris? What's up, man? No light? I mean, I've showed you guys my library before. I'll turn the lights on a little bit. All right, so we're slightly green in our SPY trade. Very slight, though. Apple at 152s. What's up, Roderick? What's up, man? Okay, we got non-farm data dropping right now. It's 7 o'clock at about an hour and 3 minutes. We got non-farm data dropping at 8:15 market time. So we'll put this up. All right, so here's how long we have until non-farm data comes out. Honestly, the weather is beautiful right now, man. I love the weather right now. Yo, John, what is your advice for me? I am bullish. Well, I mean, you got to be a little bit more specific than that. Number one, I'm going to preface it with like, we give no financial advice here. I have no idea what's going to happen. I might be wildly wrong about anything I say here. Do not copy me. We are not liable for any losses. And again, I might just be wildly wrong about everything. Yeah, mortgage data coming out. I don't think the market reacts to this data. It'll react a little bit. It reacts to non-farm. What's up, Justin? For 60K plus, I'd expect a better material. Yeah, I've never had a Tesla. Yeah, it doesn't matter. Like I said, anybody that's genuinely trying to kind of like take the few losing trades that I have and like harp on them is, like I said, just kind of they're either trying to troll or they're desperate to criticize for whatever reason. But again, I'm green on the year. That's all I really need to say, which is better than, I'll put it this way, I'm green on the year in TD Ameritrade, which is better than I would say at least 80% of everybody else. Yeah, I used to have a poster of a lotus on my wall. All right, guys. So, yeah, I don't know what HKD is going to do. We'll probably cut the SPY trade here too. We'll give it a little second. Bitcoin, yeah, I don't know, man. Bitcoin is in kind of one of those pullback stages of the last few days. I don't know what Bitcoin's going to do. Right, anybody's going to lose money. Sometimes, like I said, anybody that's trying to pinpoint the losses I have and critique them, or again, winning traders just don't act like that. Again, I'm green on the year. That's all I ever really need to say is that I'm green on the year. Nobody can really say anything to me about it because most of the people critiquing me are not green on the year, and so it's all good here. It doesn't matter too much, man. Non-farm data might affect things, but it's not going to be as big as like CPI or anything like that. It might move things, but it's not going to be like big. All right, guys. So again, we're in the SPY. It's small. Yeah, we're in the SPY. It's small. Timers for non-farm data. Yeah, thank you, Luis. I appreciate that. Yeah, timers for non-farm data comes out at 8:15 Eastern Standard Time. So in a little bit less than an hour, that data drops. Man, politics is just crazy right now, bro. Like, I genuinely try to stay away from it. Like, any financial channel that takes super one-sided views on politics is, not looking at it objectively. Yeah, 100% pawn. You know how it goes, bro. Everybody here is just the greatest ever. Everybody here is up 500% in ABC penny stock in the last day. Everybody here turned $50 into 500 million last week. and they've never been wrong, and they're the greatest ever, Bitcoin at 22.1 thousand. Meta right at the previous closing price. Again, we're in the SPY. We're pretty sideways and neutral here. Just a little baby day trade. Yeah, CEI, bro. Where did Max go, bro? CEI. And that's the best example I could use. Is like, bro, you get people that are like, yeah, to the moon. To the moon. And then it's just kind of like, you never hear from those stocks again, bro. They're just terrible companies, man. They're just genuinely not good companies. All right, Tesla breaking under the VWAP. Hey, what's up, Brad? Yesterday was weird. It's like everyone took their grumpy pill in the morning. Yeah, 100%, man. It's just kind of, people get emotional when they lose money, man. Like you get some people who lose money and then they go in the stream comments and they just try to kind of like, misery loves company, right? So people who are unhappy want to make other people unhappy, Like that's really what it is that unhappy people want to make other people unhappy. Apple at 152. See, the problem is like we got a dip in the SPY yesterday, but we didn't really pull back that much in Microsoft. Microsoft's still at 255. Apple's still over 150. Meta's still over 184s, almost to 185s now. So it's like we pulled back a little bit, but it wasn't super profound of a pullback. Like it's not something that I'm excited to buy the dip yet. So like I might find some stuff. Name something that you think is extended on the downside, guys. Ford pulled back to 1280, still not really cheap. Snapchat ended up ripping up to 12s yesterday, still not necessarily cheap. Google at 94s, 95s, maybe. HKD's kind of running. So what are we expecting from this non-farm employment report? 200,000 is what the expectation is for this. So 200K is what they're expecting. He doesn't want to destroy. I mean, Raphael, I guess the easiest way to put this is Raphael says it's not fair. Powell wants to destroy the economy. Here's the best way to put it. What other options does he have to combat inflation? How else are we going to combat inflation? The only tool the Fed has to combat inflation is raising rates, right? And what raising rates does is it discourages spending or hurts the market, right? Like that's all it really does. That's the only tool they have to combat inflation. And so, what I heard yesterday is a lot of people being critical of Powell, but not really many people telling him what the other options are. So it's like, if you're going to criticize Powell, that's fine. But like, what do you think he should do then? If he doesn't raise rates aggressively, inflation's only going to get worse. And so like, what does he do here? What kind of tools can he use? And what should he do to the market? And again, I'm not saying there is a right or wrong answer there. I'm genuinely asking, like, what does he do there? Because inflation's bad. Inflation's high. The only tool the Fed really has is to raise rates. And that's what they've been doing. Now, maybe they raise it more aggressively than anticipated. But, like, what do they do now? Raise rates at a lower pace? Then people are going to be scared and criticizing him. And they're going to say inflation's out of control. And, they're not doing enough to combat it, is what they would say if they raise rates at a lower pace. We're already not raising rates super aggressively. We're only raising them 25 basis points lately, Doesn't sound like fun at all, Tim. Bull bear, I think that's a silly expectation. I think that Lulu is a fashion company that is relatively new. Like, it's a relatively new fashion company, and fashion companies are vulnerable long term. Short term, they make tons of money. They're money making machines short term. But holding it for 20 years is probably, it's probably not going to beat the market over a 20-year period. And eventually it's going to settle down and it's going to lose people are going to lose their interest. Remember me saying this too. All right. Like, remember me saying this. If you look at every major fashion brand that's sprouted up over the last 30 years, all of them have gone down. except for maybe a handful of them. But if you look at, here's the easiest way to put it: American Eagle, terrible company now, down huge percentages. Abercrombie and Fitch, terrible company now, down huge percentages. Hollister, terrible company now, down huge percentages. And so you can look at all the major fashion stores really over the last 20 or 30 years. And outside of like even the big ones like Macy's, they're down too, you know. And so Lululemon makes lots of money right now. Oh man, the market dumped. We'll go ahead and cut this at this point in time. Yeah, there we go. We're out. We lost 20 bucks. Relatively insignificant. I'm not sure why the market dumped like that. Some type of news came out, but again, it's all good. It's small. We'll see if we can make it back doing other stuff. But yeah, Lulu. Again, the problem is it's a fashion brand, and fashion brands are vulnerable. We had Campbell Soup dropping their earnings today. Yeah, well, like luxury fashion brands are fine, AJ. But and the only really good one, I think the thing to understand is that the only one that really has done well is Louis Vuitton. That's basically it. Look at all the other ones: Gucci, Dolce & Gabbana. They've lost hype and interest and value as well. And so it's not like literally only Louis Vuitton. Kate Spade lost value. You know, you got to really look at fashion brands objectively to understand, like, yes, they make money now. Like, yes, like listen, I live with my wife and daughter. They love Lululemon. You know, they love Lululemon. They shop there all the time. The problem is that eventually that hype and interest is going to fade. Why? It's a generational thing. You know, the next generation might not like them as much, and that's how these stores get faded out, right? Everybody liked Hollister and Abercrombie, and then they had kids, and then their kids didn't want to wear the same thing, and so those stores lose value. The same thing's going to happen with Lululemon, and you know, like, watch. Just remember me saying this in 10 or 15 years when Lulu is down 75%. Yeah, Lulu basically has been dropping since December. It's down basically 25% since December. So, and meanwhile, that's as the market has been ripping up big since then. You know what I mean? So, I don't know what. I don't know about what. I don't know what we're gonna get from the Powell meeting. All right, so U.S. is reportedly investigating Tesla's Model Y SUV for steering wheels that can fall off, according to AP. Right, now in the 90s, Abercrombie was big. You know, you went in there, you were like, oh, this is the cool thing. And again, like, I'm not saying you can't make money on Lulu short term. That's not what I'm saying. What I'm saying is that trying to hold a fashion company, like a specifically fashion company, and this is a huge thing to understand. Trying to hold a fashion company long term over a period of 10 or 15 or 20 years is an incredibly vulnerable investment, because fashion does not trend that long. They do not stay cool that long. You know, usually 10 years max. They're not going to be cool anymore. The price is going to lose value. So that's the big thing for people to understand. You know, why don't you play UVXY for the downside? It's close to all-time lows, because I don't need. I can buy the SPY or short the SPY directly. So I don't really need to buy inverse, ETFs or anything like that. I appreciate the donation though, Brian. Thank you, bro. I appreciate it. But yeah, but thank you so much, man. I appreciate the donation, Brian. Thank you so much, man. I appreciate the $5 donation. I mean, Lulu is basically pretty flat on the year. Lulu is actually technically red on the year right now. So if you look at a Lulu 12-week chart, it's down, slightly down. It's basically break even on the year. And so, again, they might be selling big. You can make an argument or whatever it is, but it's a fashion company. It's a fashion company. Again, over the next 5 years, sure, they might do great. They might not, but they might do great. Over the next 20, incredibly vulnerable investment, in my opinion. It's fashion. They only stay cool for a finite amount of time. They're not going to stay cool forever. The only one that really there's two, that Polo, so Ralph Lauren, and Louis Vuitton. All the other fashion brands have lost value. Gucci, Dolce & Gabbana used to be huge. Now it's tiny. Kate Spade lost a ton of value. Michael Kors lost tons of value. And so, again, you got to look at it objectively, I think. Yeah, we're going to stream it live. Yeah, well, Levi is different. Like Levi, Nike, Adidas. The difference here is that those companies have been around for a freaking century. Lulu has not. Hey, thank you, Submarine. I appreciate it. Thank you so much, man. I appreciate that. And again, I could be wrong here with Lulu. I'm not trying to hate on it. Like, I could be wrong. But I think when you're looking at long-term investments, like, you want sure things. Like, you want for sure things. And I think Lulu is very far from that. Like, I think Lulu is incredibly vulnerable long-term. And so if you're putting your money in something long-term, are you really going to want to put something in a $300 stock, fashion stock? It just seems like the worst idea you could ever have, is putting all your money long-term in a fashion company that's $300 a share. It just seems like it seems like a road to losing money, but maybe I'm wrong. Again, let me know what you guys think. Tesla breaking down here. SPY is basically flat on the day, but Tesla breaking down. Yeah, Converse. But again, these are all companies that have been around for a freaking century. So there's a difference between already established brands like Nike, Converse, Adidas. You can name all the OGs. There's a difference between that and Lululemon, to be honest. And again, maybe it turns out well. I really don't know. I just think it's a vulnerable investment long term. I don't think it's the safest. I think if I want to hold something for 20 years, it's not going to be a fashion company that's $300 a share. Regardless, it's going to be something that is more stable. Tesla bouncing back up a little bit at 185.40s right now. Is there a justification and a dim buy for this? I don't know. Everybody keeps talking about the poll. Yeah, it looks like most people think we're going to drop on non-farm data. 58% bearish, 42% bullish. Yeah, I mean, what do you mean by that? I mean, what do you guys want me to do with the poll? Like, yeah, 58% bear, 42% bull seems pretty reasonable expectation. I'm never saying the poll is right. We're just gauging sentiment. Tesla just cracked under lows again. But what makes a company like Levi's stand this long? Well, Levi's is kind of, they did deals with Walmart. They did deals with Walmart and Macy's. Distribution deals is what got Levi's to be so big. Lulu right now is running off of individual brick and mortar stores, which is a recipe for failure long term as well. So Yeah, a large majority of penny stocks are terrible companies, Sam. Regardless of the due diligence, I'm just incredibly skeptical of any penny stock, to be honest. Occidental Petroleum, Buffett increased his stake. Cool. All right, guys. So SPY breaking down here. Again, are you buying the dip? Maybe we'll get some pullbacks. I don't think we've had any significant enough pullbacks for me to be interested in actually buying anything yet. For me personally, we'll wait. It skips generation. Skinny jeans was popular with millennials. Yeah, bro. Honestly, it's actually a really funny thing. Like my daughter, my daughter thinks that her generation's style is unique and different, and that they know all about it, and that we don't know anything about their style. And I try to tell her, I was like, look, if you think that baggy jeans is new, watch some Nirvana videos from the 90s. You know, like everything that, for whatever reason, the young generation today is just a carbon copy of the 90s. Like, and I grew up in the 90s. It's a carbon copy. Baggy, holy jeans, neon colors, bowl cuts, you know, like everything about them is literally exactly like the 90s, to be honest. It's just, they look like the 90s. Hey, thank you, Sam. I appreciate it, man. Thank you, brother. Are you saying they are old fashioned? No, I'm just saying they copied the 90s a little bit too much, you know? But I mean, I think fashion is cyclical, and I think that, like, I think it moves in waves, and this is what I taught my daughter, is that it's all cyclical. Like, any fashion trends that you think are unique now are really just copying from others. Like, at this point, like right now, it's kind of like a mix of like the 80s and 90s. So it's like short shorts for the guys, and the 90s. Like, the guys are dressing like they're in the 80s with big poofy hair, with big fluffy poofy hair where they're like artificially curling it in the front and they're like pushing it up. And then the ladies are dressing like they're in the 90s with baggy pants and neon and, you know, stuff like that. That's really what the style is now, is like 80s and 90s. Yeah, bro. Dude, I rocked some Jinkos as a kid, man. Every Friday was free dress Friday at my school in elementary school, and bro, we all got to wear our Jinkos. I had a big pair of Jinkos with an alien on the front of it, dude. I was just the coolest kid ever. At least I thought I was. You know, had my Airwalks. I had some Airwalks that actually had like a game on the bottom of them that I could play. I had Airwalks, Jinkos, a bowl cut that I parted right down the middle. You know, like Jonathan Taylor Thomas. You know, I was cool, man. Listen, 90s was a cool time. You know. Oh, I did skate, bro. I could double kickflip, dude. I did skate. I could skate. I was a skater up until I was like 17. I stopped skating when I was like 17. But I could like double kickflip. I could varial flip. I could 360 flip. I can grind on some stuff too. It's been years though, but I can do that stuff. All right, guys. Market's bouncing back up a little bit. Apple right at that previous closing price. So I'm interested to see what happened. Mostly getting weighed down by Tesla today, is what this is. Mostly getting weighed by weighed down. Oh, I beanbagged. Oh, for sure. No, I never had any soap shoes. Oh, you mean what are they called? What are the grinding shoes called? I had some of them. I had some Heelys is actually what I had, some Heelys. That's another way they're copying the 90s is because they're rolling around in Heelys, man. I had some Heelys. I was actually pretty good at it because I skated, so it's kind of an easy transition. But look at Tesla, man. Tesla looking weak. Stranger Things? Yeah. Okay, nice, Mark. Yeah, I had some DCs. I had a bunch of them. I had some DCs. I had some DCs. I have to look up the brands I had. I had a bunch. Like I was a skater, so I had a lot of different skate shoes. I had some. Was it Enjoys? I had a lot of pair of DCs. So I had a lot of DC shoes. Yeah, I didn't really have that many Vans. I wasn't really a Vans person. I had some DCs. I'm trying to look up where the shoes were. Ooh, I had some of these. What is this? I had some Etnies. Is that what they're called? Etnies? Let me make sure. I feel like that's what I had. Some Etnies. Yeah, I had some Etnies. I had a bunch of them, to be honest. But I had some Etnies. My favorite skate shoes were Etnies, actually, because they were thick, they were big, they would last a long time. Yeah, Tesla. The question is, do we dip? Do we buy the dip here? I'm not buying it yet, but I think there's an argument for it. Americas, yeah, I had some Americas too. All right, Tesla breaking lows again here. Tesla breaking lows again. We'll see if it continues down. But it started to dump down here. We still have about 30 minutes before the actual non-farm data comes out. All right, guys. SPY just broke down under 398. We are at 184s on Tesla here. 184s right now. Hey, what's up, Williams? Yeah, I had some shoes that were taped up too. Like I said, I really did skate for a while. I quit when I was 17 or 18, just because I got older. I started getting more into, like, you know, more into ladies, I guess, as a teenager. Stopped skating as much once I hit like 17 or 18. You know, just didn't have time for it. Yeah, Sam. I mean, that's why I'm not buying Lululemon now. Look, Sam says, back when I cared about fashion, which was 20 years ago, the cool stuff was G-Star, never heard of it. Haglofs, never heard of it. A&F, heard of them. Stone Island, never really heard of them. Armani, I've heard of them. Calvin Klein, Under Armour. Yeah, I mean, again, that exact reason is why I don't buy Lululemon. Is because most of those are kind of done for. Yeah, if Tesla goes, Bitcoin might follow. Well, Tesla's going to follow. Bitcoin's going to follow the broader market more so than Tesla specifically, I think. Yeah, I'm in HKD. I got one share. Yeah, I got my one share of HKD, but it's not really doing that much. I mean, relative to the history of HKD, you know, again, I'm in one share, but I do. Thank you so much, Jose. I appreciate the donation, brother. Thank you so much, man. But yeah, I do have my one share of HKD. It's up. I'm up a whopping $1.50 on that one today. Amazing, you know. But no, thank you so much, man. Yeah, I don't dislike Lulu. I think it's all kind of. I think it's what's the word, man? I'm drawing a blank. Placebo effect, right? Okay, that's the word I was trying to think of. I couldn't think of it. I think it's almost a placebo effect where you're spending a lot. Like I say, it's kind of like if somebody spends $5,000 on a penny stock day trading course. That penny stock day trading course might be utter garbage. It might be the worst course ever. It literally could say 2-3 words: buy the dip, right? But if you spend $5K on a course, you better believe you're going to be sitting there like, this is the best course I ever took. This is the greatest course ever. You know, you're going to be telling everybody, oh yeah, the course is so great. That course might be terrible, but it's like, you want to confirm what you want to believe to be true, right? So confirmation bias is incredibly strong. And it's one of the reasons people get caught up in buying ridiculous courses that are so overpriced. It's not even funny. It's because you got a bunch of mindless drones out there pumping those courses up because they've lost money on it. You know, the reality of it is most trading content is publicly available. Like, you don't need to spend $5,000 on the course. You can find the same content that's in that course on YouTube somewhere for free. And I think with Lululemon and stuff like it, it's the same thing, right? You spend $80 on a pair of yoga pants, you're going to be thinking about how comfortable it is more so than anything else, right? So you're going to be like, oh, these are so comfortable. Wow. It's like, is it really more comfortable, or are you just paying more attention to it because you spent almost $100 on a pair of yoga pants? And I think it's probably the latter. I think it's probably, you know, it's somewhat of a placebo effect going on there. And that's okay. Like I said, if you like wearing it, if you feel good wearing it, fine. But, you know, I have some Lululemon stuff. They're not that comfortable. I mean, they're all right. They're not bad. They're not uncomfortable. But they feel like every other pair of shorts that I have out there, you know. But yeah, HKD is at 850s. Let's FOMO into HKD for John. I graduated in 97, the generation of grunge. Hey, I remember that. I remember grunge. I grew up in the grunge generation too. I had airwalks and jinkos on free dress day in elementary school. I didn't graduate. I was in, I was in middle school mostly in the 90s. But yeah, it's a fun time. A lot of nostalgia for me. All right, guys, we got 25 minutes. 25 minutes. Yeah, for sure, Alex. Oh, there's some funny memes on Twitter today. There's some funny memes. Let's see if the market can pop back over the previous closing price. Apple bounced right at that previous closing price level. You can see it right here. So we pulled back literally right down to that previous closing price level here and then bounced directly off of it. Now let's see if we actually hold, but Apple pulled right back to that very spot, the very level. Oh, for sure, Sam, 100%, man. And again, it's one of those weird things, and I've said this many times over the years, but it's like trying to talk the people out of, like, number one, I think you got different personalities, right? And I think you got certain people that want to follow somebody else in terms of like they want a mentor that they pay, right? They want a paid mentor. Like they feel like they need that for whatever reason in their head. They feel like they need some type of paid mentor for trading instead of a free one. And then, and they really idolize these traders who, are just selling them crap, courses that are just terrible. They're just not good. It's carbon copies of stuff you can find online for free. But it's like, for whatever, but if you try to talk them out of it, if you try to tell them, they're going to say, oh, I can't, they're going to get mad at you for it. It's kind of like talking somebody out of a pyramid scheme. Like they're going to get mad at you for it. Not, it's a weird dynamic. It's one of the reasons, like, all I can do is try to protect traders here. And the reason I say it so much is because if I could save somebody from spending too much on a course, great, then it's worth it, I think. Because it really probably makes me lose followers, I would think. Because you got some people who just don't want to hear the truth because it hurts. It hurts to hear. And again, if I spent $5K on a course and I heard somebody like myself, telling me I didn't need to, I might get kind of weird, feel some type of way about it too, Skechers, I had some Skechers. I like Skechers. Nobody wanted Skechers in school though, I remember. And bro, my dad made me buy Walmart shoes at school. So it's like, I never had cool shoes, bro. It was like, to get my dad to buy me any shoes, it was like, to buy me any type of new shoes outside of Walmart shoes, it was a battle. Honestly, as I got older, I can appreciate it though. Like, I really can appreciate it. But nobody wanted Skechers at school, but I had some. You had the and1 basketball shoes, Buy a course or buy a stock. I'm buying a stock. Yeah, 100%. That's what you should be doing. Bro, I had some airwalks. I had some airwalks where, the game where you where it's like a maze. Like I had a maze game where I had to get the ball into the center of the maze in my Airwalk shoes. I had so much I got so much attention for those shoes. I remember I had the Airwalks where you could kind of scroll it and you can move it. It was like a maze at the bottom. I'm good. John, can you suggest a good 32-inch trading monitor under 500? Go to Costco. Ride. That's where I got mine. I got a 34-inch ultra wide at Costco for like $200. It's an LG. Mine's an LG. Or both of these are LGs actually. The one on top right here is LG, and the one on the bottom is an LG too. That's where I got mine. They're pretty good. They've lasted over a year now, I think. I think it's been over a year now. No. I never was I had a dirt bike, but it wasn't that type of dirt bike. It was I had a dirt bike, but it wasn't like a super, like I said, I never got to do anything as a kid, and it's all right. But I remember one year I got a 1978 GT80. So I got like a 30-year-old dirt bike. It was fun though. I used to ride that thing around. I don't really trade oil. Any thoughts on Nvidia? I think Nvidia is just super volatile. Oh wow, Nvidia at 230s right now. So Nvidia has been on a run, man. Nvidia is way too high for me to buy it up right here. Just way too high for me. Like I don't want to touch it up here. It's at 230s right now. This thing was at 160s. This thing was at $100 in October. It's at 230s right now. So the extension is on the upside for that, in my opinion. It's just too high up there. Yeah, so it's just, I don't want to buy it right now. It's just too high for me. Crude, yeah, I don't really mess with oil. Honestly, a friendly personality gains followers. Yeah, but sometimes people don't want to hear the truth. Like I said, if you've spent $5,000 on a course and you hear me come along and be like, hey, that was not worth it. You know, an objective and an introspective person is going to say, hey, you know, maybe that's true, maybe that's not, but he's just trying to help me. Another person is going to, a less introspective, less mature person is going to be kind of emotional, and because I'm basically attacking their spending habits. And so then they're going to blame me for it and get weird with me. I've had it happen a lot before. You know, they say I'm a hater. They say I'm hating on people that are actually making money out there, you know, where it's like the people I'm hating on are making money from selling courses. And I'm not really hating. I don't mention names. But like I said, you could sell a course, and I could sell a course if I want to. Honestly, if I really wanted to, I could put out a super hyped up course and probably make millions of dollars from it with the amount of followers and the amount of views I get daily. I could probably make a large amount of money selling a course. But the good thing about my channel is that I kind of backed myself into a corner at this point where if I tried to sell a course, I would get so much heat for it that you know, it would never work. And so it's a good thing. I've kind of backed myself in a corner here. Yeah, y'all want to see the dirt bike I had? Let me see. Look, there it is, dude. There it is. It's right here. This is it. Wow. So this is it. This is what I had. Mine was much less clean, but this is what I had. Tesla starting to bounce back. It's at 185.60s. It was fun. I used to ride that thing around my neighborhood. I sold it to a friend of mine. So I sold this thing to a friend of mine. And my friend didn't know how to drive it. So I sold it to a friend of mine. I remember I sold it for like $400. Probably would be worth some money right now, but wait. Is this worth 40 grand? Oh. Comes with a truck. Okay. All right, hold on. Now I gotta look up the price of this thing. Okay, it's gonna cost about $1,800, which is probably about right with inflation. I got it in like the early 2000s for like $400 or $500, And so that's probably about right. If you would have put the same amount of money in the S&P 500, you'd probably make about the same. So it's all good. But yeah, I let my friend ride it. I sold it to my friend, and apparently he didn't know how to ride it. And bro, we had a field by my house, and he wrecked it. And one of the foot pads was like metal, and it jammed into his shin and put a hole in his shin like an inch thick, an inch deep. And I had to carry him back to his house. And for a while, I thought he was gonna sue me, but sorry, Chris. It's your fault, bro. I mean, it ain't my fault. You bought that thing. SPY up to 398.20s. Technically, or not actually green yet. You can see the previous closing price is right around where we are now. Maybe car, maybe, man. I don't know. Yeah, for sure. I had some fun as a kid. I used to race cars too. Like I had an old Prelude, like a 98, 97 Prelude that the 5-speed that I would race a little bit. I brought it to the tracks in Louisiana a couple times. My buddy had a GSR and a Type R. And so I had some fun. I like the cars and stuff. All right, so SPY is out now, technically green on the day. So the SPY just bumped up over that previous closing price. I should have bought the dip. I was thinking about it, but yeah, it's all good. All right, guys, we got 14 minutes before non-farm data comes out. 13 or 14 minutes before we get non-farm data. Why are you in a hat at home? Because my hair is super long and I need a haircut and I don't feel like doing it every morning. And so you better believe I'm just going to throw a hat on and not worry about it. All right, but yeah, SPY is approaching the volume weighted average price in the 200 EMA. Are we expecting good news or bad news? Expectations for non-farm data is 200,000. So we're expecting 200K. I think this is going to be the nuance of this release, but I'm not 100% sure. And of course, I have no idea what's going to happen. But I think higher is worse, is what I think. I think if we do over 200,000, that's going to be worse. And so I think inflationary fears are going to cause an inverse correlation between the release of this, the numbers for the ADP non-farm employment change, and the market itself, the SPY itself. So I think there's going to be an inverse correlation. I think the higher it is, the worse the market's going to react. I think the lower it is, the better the market's going to react. But again, I'm not 100% sure. I really don't know what we're going to get here, and all I can do is speculate on it. But I think inflation fears are going to cause it to be like that. So I think if we come in at like 195, the market is going to go up. If we come in at like 210, 220, whatever, market's going to go down, I think. But again, I'm not 100% sure. And again, it has varied somewhat over the last couple months in terms of reactions to this type of data. So the Michigan barber again? No, man, never again, bro. I should have known, dude. I went to that Michigan barber. He asked if I wanted a boy cut or a girl cut, and I said a boy cut, and he proceeded to like give my son a bowl cut. He might have said bowl cut, but now that I think about it, my son came out of there looking like Jonathan Taylor Thomas, Bro, I kind of respected the guy. Like the problem is like his hands were shaking. This was in Michigan. This was a little shack of a haircut place. It was the only place we could find that was open, and his hands were literally shaking. But I kind of respected it because he still got the job done. I tipped him well. I wasn't gonna complain about it. I was just gonna be like, all right, he was like 80 something, and so it's like my man's out there still cutting hair. I'm not gonna be mean to him about it. Nvidia just bounced right at the previous closing price. Hey, what's up, Molly? Nvidia at 233.40 right now, bouncing right off the previous closing price. Um, but yeah, Tesla's really been what's kind of weighing the market down right now. So it's mostly been Tesla weighing the market. The Walmart haircut was worse. Never again, man. My whole family remembers that. I'm still not convinced that the dude who gave me the Walmart haircut like actually worked for Walmart. I'm still not convinced that, bro. I went to Walmart last time I ever got a Walmart haircut. Carol was shopping and I needed a haircut, so I was like, okay, I'm gonna go to Walmart. You know, we're here. There's nobody there, and I go in there, and like this dude shows up, and he tells me he's filling in for somebody. You know, didn't have a Walmart shirt on, didn't have like the store name front shirt on, and he starts to cut my hair, and he clips the ear on one of my ears. He clips it, and it starts bleeding, and like I know it's bleeding, and like he knows it's bleeding, but he doesn't know that I know it's bleeding, you know. And so I just gotta sit there like awkwardly, and then he clips the other ear, and then the other ear is bleeding, and I got blood coming out of my ears. And I'm just sitting there like, man, and this dude gave me the worst haircut I've ever seen. Honestly, I'm still not convinced that my man didn't just show up there and be like, hey, I'm just going to cut hair today. You know, whoever interviewed that dude needs to be fired. Never again. I had to go to like Sport Clips or somewhere after that and get my hair cut. But never again will I go to Walmart and get my hair cut. Yeah, it was the worst. My whole family makes fun of me now for that. My daughter was like, "Oh my gosh, Daddy, what, are you okay?" Because I was literally bleeding. Anyways, the SPY up to 398.70s. Market started to bounce back a little bit. Tesla is still down here though, so Tesla is still down here. Let's watch $400 on the SPY. I think it's a reasonable level. Yeah, I don't know. I'm like I said, I'm still not convinced that you know he didn't just walk in and be like, "Hey, I'm just gonna pretend to work here and see if they allow me to cut his hair." I'm still not convinced that didn't happen. But yeah, it's a funny story. Tesla back up to 185.50s here. Let's see if we can hold over 185 and start the rebound. Nvidia bouncing back. Market's bouncing back a little bit here. All right, market's starting to hit 399 again. Really decent bounce back so far today. Yeah, for sure, Charles. Nah, I don't know about 210 for Tesla. That seems kind of a big expectation for it, considering where it is now. Definitely not today. At least, I don't know. I guess it depends on what Jerome Powell and this data shows. It's one of those things where we got a lot of data coming out over the next couple days and weeks. Again, just this week alone, we got non-farm data in about 5 minutes, a little bit over 5 minutes. We got non-farm data in about 5 or 6 minutes. We have Jerome Powell testifying in front of the House today at 10, and we're going to stream the whole thing live right here. You won't have to go anywhere. We'll be able to stream the whole thing live, and you'll see it live. We have tomorrow we have jobless claims numbers. We got the JOLTS job report today as well. So at 10 o'clock today, we have JOLTS job reports, and then we've got Jerome Powell testifying in front of the House, which are all, you know, relatively big releases. As well as tomorrow, we have jobless claims data coming out. So jobless claims data tomorrow at 8:30. And then Friday, we have both U.S. and Canada unemployment dropping. We've got non-farm payrolls on Friday, which are kind of the follow-up. Today's kind of like the prelim that happens 2 days before the non-farm payroll data. That's what non-farm employment change is. So all that's happening this week. And then Tuesday of next week, we have the biggest inflation metric being released, which is CPI. That comes out at 8:30 on Tuesday. And that might influence markets. And so if we get the perfect storm of negative releases here, we could get some big drops. I'm not saying that's going to happen. I really don't know. What I will say is that I'm not going to take any really big positions ahead of this stuff because we really don't know what we're going to get. And so just be careful. A lot of big stuff. We're going to stream all of that. We're going to cover all of that stuff live right here. So you'll be able to watch it all live. You know, thousands of people tune into these big streams because we cover the data very fast. And that starts with today in about 5 minutes with the non-farm employment data coming out. So. Yeah, for sure, Steve. Like I said, lesson learned. Never again. Nah, this was like 7 years ago. So this was before. I mean, people still had iPhones back then, but it was before. It wasn't back like even like as recent as like 7 years ago. It wasn't like it is today, where young people just kind of whip out their phones at everything. You know, it's kind of a scary environment now, especially in the gym. Like I go to the gym. People can get weird at the gym. Like there's too many influencers, you know, filming themselves at the gym for my taste. But hey, thank you, Secret. I appreciate that. I don't know how much that is, but thank you so much, man. Oh wow, man, that is $33. Hey, thank you so much, man. I appreciate the support. Thank you so much, bro. Shout out to you, man. Secret on the go. Shout out to you, man. Thank you so much. I appreciate the support, bro. Thank you. Yeah, it's about $33. So thank you, man. That's a lot. Thank you so much, man. I appreciate it. That's awesome. Friday, big day. Yeah, Friday, unemployment data coming out, which is big. But yeah, thank you so much, Secret. I appreciate that. Thank you very much. Who? I don't know who that is, Derek, but I'm going to assume it's a compliment, you know. Yeah. I mean, pretty sure I'm taller than this guy. All right, guys, in about 2 minutes. Oh, dang. Guy's only 5'4". Yeah, I'm much taller than him. I'm like right around 5'11", you know. Sorry, I looked up a picture of him. It's the first thing I noticed. Nothing against my short friends out there, you know. All right, guys, market pull it back to the previous closing price. And here comes the data, guys. We got less than 2 minutes. I think my timer's a little bit off in that regard, so we're going to end this and then end that and see what happens. But market pulled back to the previous closing price. We got less than 2 minutes. Less than 2 minutes. Let me get everything ready here so we get ready to watch this. We also have the trade balance for Canada coming out, the trade balance for the U.S. The big release is the ADP non-farm employment change numbers that dropped. 200,000 expectation here. We're right at the previous closing price now. We got about a minute and a half left. John, you didn't pay for that haircut. I did. But honestly, bro, by the end of it, I was worried. The dude seemed a little weird. He told me some weird stuff, man. He told me that thinning shears were banned. You know, they were banned over in Europe or something. He told me some weird stuff, man. Like again, he seemed kind of obsessive too. I kind of rolled out of there and got out of there, just kind of, you know, I wasn't gonna argue with him. I was just gonna get out of there. Dude seemed a little off. All right, guys, we got 30 seconds. 30 seconds. 200,000 is what's expected here. And again, I think there's going to be an inverse correlation between this data and the market. I think the higher number here, I think we're going to get a worse market reaction. The lower number, I think we're going to get a better market reaction. And the expectation here is 200,000 for ADP. 200,000 is what's expected here. So again, we will see data releases right now, basically. So good luck today, team. Good luck. All right, 242. 242 is what's expected, a much higher number than expected. 242 versus 200,000. And I told you we released this very quickly. 242 versus 200,000. 242 versus 200,000. So again, we cover this very quickly. We covered that within literally half a second, guys. So 200,000. Or 242 versus 200,000 is what showed up here, guys. And so again, as I thought, we would get a worse reaction here. So the higher number is worse, and that's exactly what we got. We'll put this number up on screen. But 242 versus 200K. Yeah, it might be good for currency, Bala, but it's bad for markets. There's an inverse correlation generally with the dollar and the market. So the higher the dollar index goes, the worse, the lower the market goes. So watch, I'm sure the dollar index is probably going to be going up on this data, right? But the market actually went down, right? So yeah, as I just said, the dollar index is moving up on this, but the market itself is down. And so again, there's an inverse correlation between the dollar and the market. And that's why this data is worse, if that makes sense, right? So yeah, worse data than expected. Worse data, 242. Dollar index is ripping up. The market's pulling back. Again, if you haven't already subscribed, guys, we are going to stream the full Jerome Powell press conference today as well. So if you haven't already, hit that subscribe button. We are going to throw it in sub-only mode. We should break 102 today, 102,000 subscribers. We should hit that today. Dollar index is rising up. Tesla pulling back. Market pulling back. As I suggested, I told you guys that this is probably what we would get today. And yeah, so we were right about our sentiment here where higher is worse, lower is better. And yeah, that's what we're seeing so far here today, team. What's the technical reason for the dollar inverse correlation? If your cash is gaining value, you're less likely to invest it. If your cash is losing value, you're more likely to put it into other things because sitting on it's losing value, right? So if your cash is going down, you're more likely to take your cash and stick it into a hedge against that, like the S&P 500. You know, if your cash is gaining value, you're less likely to do so. And so because of that, there's an inverse correlation, as well as the fact that inflation, this signals higher inflation. You know, it is what it is. More people working means more people spending. More people spending is going to be interpreted as a negative thing right now in this market. That's kind of why the correlation is like that. Yeah, Bala. I mean, like I said, Bala, I don't know if you're actually listening to what I'm saying, but what I said before this and just now is that a higher number is going to equal a negative response in markets, not the dollar index, in markets. You can see here the SPY relative to this release has gone down from this. The SPY relative to this release has gone down. If the dollar index has an inverse correlation to the market and the SPY, so you can see the dollar is going to go up on this data and the market is going to go down because, again, a higher number is worse for markets, and that's exactly what the price action showed us here. Is exactly what I said would happen, basically. All right, sorry. My daughter was on the phone. Yeah, it's going to be interesting, Derek. We'll see what happens. It'll be interesting, though, you know. I use Quant Tower, Justin. I use Quant Tower. And so Quant Tower is pretty cool. And again, if you want to know what he's talking about with regards to Top Step is a funded account program for futures, right? So one of the ways you can get in on this economic data is trading futures, right? There's no PDT in futures. You can see here, here's the futures contract of the S&P 500. And then here's the SPY, which is what I'm watching here. And so the futures market is one of the ways you can trade this economic data. And Top Step is the easiest way to test yourself in futures. And again, the big value of Top Step is that what they do is they give you a demo first. And if you can, and they test your profitability, and if you can pass their testing and hit their price target while following their rules, then they fund you between $50,000 to $150,000, and legitimately funding in a prop firm with a 90% profit split. So you keep 90% of your profits that you make once you're funded. And to be fair, I think most people are not going to be able to be funded because most day traders lose money. But that's kind of the point, is that it's a lot cheaper to try out Top Step, still have some pressure. So you're still learning how to trade under pressure. It's basically an easier barrier of entry. It's a lower barrier of entry to enter the markets. If you're good enough, you can pass their testing and get funded, and you got a 90% split, and they'll fund you between 50 to 150K. If you lose, you're not going to lose as much as you would putting up the money yourself. You put up 15K yourself, you can lose thousands of dollars in the futures market, thousands of dollars. And this is a great middle ground where you got some pressure, but not the full extent of it. And so they are a sponsor of mine. I'm certainly biased in their favor. But again, I think it's a great way. I wish I would have had this when I first got started because it would have saved me money. I lost thousands of dollars as a new trader because I was trying to put up the money myself and trade. And this is one of the ways that you can still have some pressure. If you're good enough, you can get funded with a 90% profit split. And they pay out millions every year in actual withdrawals, and they fund thousands. They've been around for over a decade, and they're kind of who all the other funded programs copy off of. But again, they are a sponsor of mine. I'm definitely biased, but you can get 20% off if you use my link. Check it out right there. Yeah, I use Quant Tower, which is the platform. This is TOS right here, so this isn't Quant Tower. We'll day trade on that a little bit later. But yeah, there's the link right there if you want to check it out. Yeah, and you can kind of see here's the SPY, and then here's the futures contract of the SPY doing the exact same thing. It's the exact same price action here in futures. You can also find the link in the description if you want to check that out. But yeah, the dollar index is starting to dip. Market's finally starting to bounce back up some. Uh, 157 was 180 days. Are you bearish? I don't know. I was bearish ahead of the Jerome Powell press conference yesterday. And I was bearish in front of the Jerome Powell press conference yesterday. And I was absolutely right. If you guys heard me, we had a lot of people that say, hey, John, like, what are you in right now? What are you buying? And I told them I'm not buying anything. I was too worried. And again, the logic of why I was bearish makes sense. And I hope you guys can learn from that logic is that over the last couple days prior to yesterday, I liquidated a large majority of my swing trading positions. People would ask me why, and I told them, I said, you got to look at the discrepancies between sentiment now and sentiment during the last time Jerome Powell spoke, right? The last time Jerome Powell spoke, what did he say, right? He said they were optimistic that, he didn't see us pivoting this year, but he would probably do 25 basis points during the next Fed meeting on March 22nd. And you got to look at what changed between now and then, right? What changed is that inflationary data came in much worse. So CPI came in worse. PPI came in worse. So inflation metrics got worse. Like inflation got worse over the last month, right? And so it's logical to assume that when Jerome Powell spoke yesterday, that he would give us an updated plan for the Fed, right? And that's exactly what he did. He said that we might have to raise rates more aggressively than he thought last time. And what does that cause? That causes drops in markets, right? So that's the reason we liquidated our positions. The question now, and this is what we asked on Twitter, as the market's ripping back up, bouncing back up, and the dollar index, as you can see, is negatively correlated. It's dropping down as the market rips up. But now the question is, do we bounce today? Is Jerome Powell done correcting sentiment? Is he done correcting sentiment? I think that's the only question we have today. Like, does the market bounce today based off of that? Or does he continue to kind of, push the bearish sentiment? I'm not sure. If we do take a position today, it's going to be very small. We might take a position based off of a small potential dip buy, but I haven't really found anything yet that I think is extended enough on the downside short term for me to like buying it up. So we'll see. But yeah, that's kind of how I'm looking at it right now. It wasn't positive data, Bruno. It was negative data. It was higher data, which means inflation's getting worse. That's why the market initially reacted negatively to it. I think what came out since then is, did the trade balance data ever drop? No, trade balance data is still not out yet. Or no. So the trade balance import export prices don't drop for another 6 minutes. So in 6 minutes, trade balance data, import export data drop. And we'll see how those influence markets too. But they're supposed to drop pretty soon. Thank you for becoming a member, Secret. Thank you so much, man. I appreciate it. Yeah, we also have the JOLTS job openings for January at 10 a.m. and we have Fed Powell speaking in front of the House at 10 as well. OPK deal with Merck. Yeah, thank you for becoming a member, man. Secret, thank you so much, man. More jobs than expected is equal bear for the market. Yeah, you got to understand why, though. So the reason there's a negative correlation between more jobs in the market is because right now, anything that means more spending is bad, right? So with jobless claims, for instance, right? Like higher jobless claims is better because it means less people working. And I'm not saying I agree with it, but that's the sentiment of the market lately, is that more spending is bad because inflation, and inflationary fears, right? So anything that means more spending can and has been interpreted as negative. And you can kind of see that with this data here, where it was higher than expected, and the reaction we got from the market was a negative one. Now we've rebounded since then, but again, the reaction that we initially got from the market was a negative one here. And so you can kind of see we dumped down from this report. And again, we're pretty flat now, but jobless claims is the same thing. Unemployment is the same thing, where higher unemployment has been seen as better and lower unemployment has been seen as worse. And the reason it's seen like that is, again, because more people working means more spending, and more spending is bad. And again, I'm not saying I agree with it, but that's kind of been the sentiment and the nuance of it lately. So So the Fed's barking, who's a non-voter, says inflation means still have work to do. Labor market has been unbelievably resilient. All right, dollar index starting to pull back down a little bit here. Yeah, the market's ripping back up too. That's good. I'd rather see the market bull than bear. Let me know. Y'all have any extended downside stocks that look good? Apple had a decent drop yesterday. I'm wondering if there's a potential dip buy argument for it. Microsoft's still at 250s, so I think it's still a little bit too high for me, but yeah, we got in about 30 seconds we have, and again, make sure y'all are actually live. In about 30 seconds we have trade balance, import export prices coming out. Trade balance is expected at minus 68.9 billion, minus 68.9 billion. And so we're just waiting for that data here now. It should be dropping within the next 10 seconds. So we'll see how this affects the market too. Market's right around the 200 EMA and the volume weighted average price. And there's the release. All right, so minus 68.3 versus minus 68.9. So minus 68.3 versus minus 68.9. Trade balance came in at 1.92 billion positive versus minus for Canada. But yeah, our trade balance came in at minus 68.3 billion versus minus 68.9 billion. So not much different than expected, but we'll put this data up on screen too. And yeah, I told you guys we cover it fast here. Yeah, and I can see Apple. I see the dollar index moving up. That might cause some drops here in the market. I don't know if it's time to short before Powell's speech. Hey, thank you, Don. Hey, I appreciate it, man. Thank you, bro. But yeah, I don't know if it's time to short. Again, part of me thinks that he got all the negative sentiment stuff out the way. And so now, hopefully we have some optimistic, positive things. But I don't know. SPY is ripping up to 398.80s. Dollar index seems to be falling down some. What do you guys think? What's a cheap stock to buy right now? Get some good action here. All right, market is bouncing back a little bit, still consolidating around the 200 EMA. A nice little bounce and SPY here, but there's the Dixie pushing back up to the 200 EMA. We'll see if we pull back or what happens now. SPY is in the right around the 200 EMA. The dollar index is moving up. Apple has been ripping up too here. So we did have non-farm data today. Getting a little bit of a rejection off the 200 EMA on the dollar index. SPY up to 398.70s. Again, I guess we're going to do a poll now since the non-farm data is out already. We got about 1,000 votes. 59% are bearish, 41% are bullish. And, you know, I don't know if anybody was really right. I think it's pretty flat down the middle here. We're going to do another poll now on just bullish or bearish on today's JPOW house testimony and interview. So vote on this poll, bull or bear. There you go. Again, market's kind of chopped. You know, you can see over the last 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 minutes, we've mostly been sideways. We had a little bit of a run up on the SPY. The dollar index did reject there, which is a pretty good sign. Hopefully that continues. Tesla right at the 186 level here. So we'll see if Tesla can get back over the volume weighted average price in the rest of these levels. So the non-farm data was right here. Which 242 versus 200,000 expected. AMD. AMD is just so volatile. No stocks are cheap. Well, that's a pretty, you know, blanket statement. I think there's obviously going to be some cheap stocks right now. It just depends on what it is. Bed Bath & Beyond, Tilray. No, I'm not touching those. Too much risk. Bed Bath & Beyond is failing. Like I've actually been to a Bed Bath & Beyond over the last couple, months, and there's never anybody there. It's a brick and mortar store where most of the stuff that's sold at Bed Bath & Beyond you can buy on Amazon now, and that's basically gonna cause their failure long term. Walmart. 139. Walmart's about flat on the year. I like Walmart as a stock, but I don't know about right now. Yeah, all good. eBay, I don't trust either. Baba is overseas. I don't trust it. I'm kind of picky with my stocks, but I think that's one of the reasons we're green on the year is being picky with stocks. Yeah, that's kind of what I'm thinking too, Ryan. I mean, my logic is like, my logic is that I think I think that we've already dropped a lot. My logic is that I think we already dropped a lot, and I think maybe we're baked in already to this. Not 100% sure, but he already said his negative things yesterday, and so it's arguable that today maybe, it's arguable that maybe he's done, updating the sentiment, and we could get a potential bounce today. Maybe, not 100% sure, but what I will say is that generally the Fed's pretty good at balance. And I think we had the bear response yesterday, so maybe they're going to update it and have a bull response. We already had some very negative things yesterday, so I think there's an argument for the upside today, but of course I really have no idea, and we'll see. All right, Dixie just fell down pretty fast here. So look at the dollar index drop all the way to 105. So that's a good sign for market activity, I think. Tesla tapped 186. Yeah, we'll see. We could get anything here right now. It's one of the reasons I'm pretty small positioned here. SPY just popped up to 398. Dollar index is kind of moving with it though, which is weird, but starting to get a little pop. Yeah, that's what I'm saying. Like Bed Bath & Beyond, what happened, the reason you got so many people pushing Bed Bath & Beyond right now is simple, is because Bed Bath & Beyond was like it's kind of like AMC where everybody's like, oh, a huge squeeze is gonna be there, you know? But the problem is that the chart looks like this, right? So you got a lot of people that are stuck. You got a lot of people that bought the hype and they're stuck in all this, you know? And so what do they say? Oh, Bed Bath & Beyond, the greatest thing ever. You know, terrible company, almost certainly going to be obsolete and out of business within the next 5 to 10 years. But again, you got a lot of people who got caught in the squeeze that are stuck at these levels here that desperately wanted to go up because they invested too much into it and they bag held it. Unfortunately, this is not a blue chip, and the odds are long term is probably going to get worse and worse for this company. You know, the only thing that could save them is like Ryan Cohen coming out saying he's going to buy, you know, he got a bunch of shares or something. But, you know, I don't know if it will ever get the squeeze that people were calling for it. Market's looking better, though. Yeah, Sean, listen, man, every day you're like, look what I said, man. No offense, bro, but it's been like every day, dude. I don't remember anything you called, man. Like I said, I don't really pay attention to the chat, brother, you know. And so you might have called it. If you did, congrats, man. But technicals generally long-term don't mean anything. The drop yesterday was not from technicals, brother. It's obviously not from technicals, man. The drop yesterday was exactly what I said, which is that he was correcting the sentiment from the last time he spoke, right? And so the drops were obviously correlated with when they started speaking yesterday, not from some technical thing that somebody saw well on out of there, brother. And it's all love here, man. I just hope you understand. Like, anytime I hear somebody say, look what I said, I called this, maybe you did, right? But this move yesterday was obviously not a technical move. The move yesterday happened because like it was completely correlated with when they started talking. And I don't think that's really arguable. I think that's very self-evident. So I hope you understand, you know. Yeah, if Bed Bath & Beyond ends up making it, you'll still get hit with a reverse split and dilution will destroy you anyway. 100%. All right, there's the Dixie falling down. Let's see if it bounces back up here. Let's see what it does. Yeah, I mean, Sean, no offense, man, but if you genuinely think the drops yesterday were technicals, you don't understand trading, brother. No offense to you, man. Again, the drops yesterday, and again, I don't really think it's arguable, bro. You know, like the drops yesterday were obviously correlated with when the congressmen started arguing with each other, right? It was obviously correlated with that. It happened as soon as it happened. Like technical moves, I'll put it this way. Technical moves do not look like this. Okay, here's the best way to put it. All right, technical moves do not look like this. Technical moves will never look like this. They'll never look like that. That's only something that can be brought upon by quick fundamental changes in sentiment. All right. And again, I don't think it's really arguable. Like, again, trying to argue with me is just going to be a losing endeavor. I'd rather not argue about it. Maybe you're right, but I don't think you are. I think this is obviously a reaction to the Jerome Powell interview yesterday. It started right at look at when this started. It was literally when did the Jerome Powell testimony start? At 10 a.m. Look when the drop happened. Literally right at 10 a.m. Look, there's 10 a.m. right there. Right? I don't think it's arguable. I mean, we can claim it's technical, but I think that's silly. No offense. I just think that's silly, brother. I hope you understand, But I got to call a spade a spade. I think trying to tell me that's technical is silly, Yeah, 100%, Joe. The drop was based when Powell was not answering questions. Come on, man, not technicals. Yeah, it's silly. Like I said, you're trying to tell me that the technicals lined up with exactly when Jerome Powell started speaking. Like exactly when my guy, whoever it was with the smoker's voice, started talking, right? He started saying a bunch of negative stuff. The market tanked right at 10 a.m., right when he started talking. Right? That is why the market dropped yesterday at 10 o'clock on the dot. The odds that the technicals were perfect and caused this drop exactly at 10 are so infinitesimally low that it's just a silly argument. No offense to you, man. I hope you understand. Maybe I'm wrong. I really don't think I am. I think most people that understand what happened yesterday are going to see that. And again, one of the reasons, the reason I'm saying this is because I told people I liquidated most of my swing trades positions because I was worried this would happen. I was worried that they would update us, that they would say some negative things during the testimony yesterday, which they did, and the market would tank from it. And that's exactly what we got right at 10 o'clock on the dot. No, market dropped minutes before Powell came on because who was my guy with the smoker's voice? Right? Who was the guy? I think his name was Senator Brown, right? Or who? I can't remember who it was. Let me look this up. Who was the guy with the smoker's voice? Somebody help me out here. Let me see if this was him. Yeah, this was him. When this guy started talking, the market dropped right at 10 o'clock. And again, it's on video. You can look at it. When this man started talking, that's when the market started dropping, right? They didn't need to wait for Powell. At 10 o'clock on the dot, my guy right here started talking. And he started saying some negative things, some very critical things of not just the market, but of the overall economy. And the reaction we got was this, right when he started talking. Again, it's not technical. It's a silly argument. No offense. It's just a silly argument. But yeah, Senator Brown right here. When he started talking, that's when the market started to drop. And again, it's not really arguable. It's obvious. It's so obvious, And again, of course, people who are trying to base their trades off of technicals, it's kind of like, here's another example of what people are trying to do here, right? Which is like, okay, say Apple comes out with better than expected earnings, right? Say Apple comes out with better than expected earnings, better than expected sales, better than expected guidance, and they pump up 20%. What people are trying to do here is the equivalent of saying, hey, Apple's not up from their earnings that dropped on that specific date at that exact time. They're up from, the crossover of the moving average that happened, and that the huge 20% gap up is not from the fundamental release of earnings. It's instead from this technical pattern. In the end, technical traders want to confirm what they want to believe, which is that their technical patterns cause that move. Generally here, though, right? Generally, technical patterns are not going to cause reactions like this. They're not going to cause volatility like this on a short-term basis. They're just not. They're not going to cause huge sentiment changes in markets on a short-term basis right when fundamental stuff is coming out. Technicals are going to cause slow churning reactions and movements, except for like high of the day breakouts. But even they are not going to cause moves like this because they're technical patterns in nature. That's the real thing to understand, is that technicals are not going to cause moves like that. Fundamentals cause reactions like this, not technicals. And technical patterns can work, but in terms of reactionary, things like this, it's almost always fundamental movements. There may be some outliers there, but that's the real way it is. Hey, thank you, No Mode. I appreciate it. Thank you. ADP was, I don't know if it was good or bad. It was higher, or it was much higher than expected. Right, the market dumped at 10 o'clock, Mac, because this man started talking. Right, this guy started talking right at 10 o'clock on the dot. We streamed it, but they were a little bit late in actually posting it, but people that were there knew, and the algos did react to what he was saying fast. I can agree with you there, but it's still a fundamental reaction. Even if it had to do with algos, it's still a fundamental reaction to the 10 o'clock drop of this man speaking, as well as a bunch of other stuff. It wasn't technicals. It was a fundamental reaction, and it might have been algos reacting, but it was fundamental in nature 100%. Like I said, I watch the market every day. I understand, like, again, technicals can move markets, but they're not going to cause reactions like this where you have a big reaction like this on a short-term basis. They're not that predictable. Technicals are not that predictable. If they were, people would, they're just not that predictable. They can work, right? Technicals can be powerful, but they're not going to cause huge range reactions like this most of the time. And I think when you add that to the consideration of fundamental data being released at the exact same time, I think it's silly to argue that it was technicals, but I digress. I don't know if there's a really good point in arguing about it, but again, I think it's a silly argument. Now, to change the subject here, are we going to bounce a little bit right now? Do y'all think there's any dip buying stocks? I'm kind of looking at Tesla. But Tesla just moves so much. It's up like 100% in the last, let me see. Since January, it's up like 100%. Not quite 100% right now. It's roughly at about like 85% gain since January. But that's still a pretty big move here. And, we're right at that $200 level. It looks like it's had some struggles holding over that $200 level. Yeah, it was on the release of Powell's written statement, 100%, but that's fundamental as well. Yeah, 100%, Andrew. Do you think algos manipulate markets? Oh, they certainly influence them. I don't know. It depends on what you consider manipulation. No, I mean, I can ask you, Sean, for your sentiment on any specific day, but coming in and day out and saying, look at me, look what I did. I was right about this. Did you see I was right about this? And it's fine to say that sometimes, but to only say that over and over again, it just starts to wear on me a little bit, Like I said, it's all love here. I'm just being honest about my own personality. And maybe that's a character flaw in me. But when I start to see that, again, I start to I don't know, it starts to wear on me. Yeah, all markets are manipulated to a certain extent. It depends on what level you're going to call it manipulated, though. I think a lot of people are just wrong short term, and then they scream manipulation when they're wrong. But yeah, so the JOLTS job report drops at 10 o'clock. That'll be a big influence as well. But this is economic data. He also speaks in front of the House. And again, I told you guys I thought we would drop yesterday. If you watch the stream, I liquidated all my swing trade positions ahead of that report yesterday because I thought the drop was likely. And so I guess that's another reason why I'm kind of like, okay, you could say it's technical, but I think it's obviously a fundamental drop. The only people that are trying to say it's technicals or technical, like pure technical traders who want to confirm what they want to believe. You know what I mean? And again, I'm not hating on them. I'm just saying you got to call a spade a spade. If it's fundamental, you got to call it fundamental. If it's technicals, we can look at it. But I think since it coincides with 10 a.m. on the dot, it's obviously fundamental, and I don't think it's really arguable. I think it's silly to argue outside of that. But yeah, with that said, right now, I don't know whether I want to buy up stuff or not. I might take a small position in some stuff, and I'm thinking about Tesla, but I don't know. I don't know yet. The logic is like, okay, so now that we got the drops out of the way yesterday, which again is what I thought would happen. I thought Jerome Powell would correct or update us on the sentiments from the corrected or newly released CPI inflation data from the past 30 days. The inflation data has been worse over the last month, and that's going to change Powell's tone and sentiment since we had some of that data updated to us over the last 30 days since he spoke last, right? And so that's exactly what we got yesterday. We got Powell basically updating us. My question is, what rate hike do you think we'll get? I know a lot of people think 25 still. Do you think we're going to go to 50? I think there's a chance we do 50. And I think some of the quotes that Jerome Powell said yesterday could show that we might do 50 basis points. In chat, what are your opinion on the odds of that, on the 50 basis point? Let me know what you guys think. Yeah, Sean, just a friendly request, man. No more arguing, no more saying, hey, I told you so. It's going to be antagonistic, brother. I hope you understand. Just trying to curb some of the arguing in chat. It's all love here, man. Like I said, we can agree to disagree. I think it's silly to argue that that's technical. And even if you called it, I think the drops yesterday were so clearly fundamental. I think it's a silly argument. I could say the same thing. I called the exact same thing. I told you guys we would drop, but the reason I thought we would drop is because of fundamental Powell updating sentiment. But again, it's not worth arguing about. And I think continuing to argue, not just you, Sean, but I think everybody, like, it's all love here. Let's just kind of drop that conversation. Again, my take on it is that I think it's a silly argument, but I could be wrong. And, let's just have some harmony in chat, if you will. So yeah, SPY at 398.50s. Let's see if we bounce. Tesla's still dipping down a little bit. Got rejected at that 200 EMA and the volume weighted average price. The dollar index is at the top of the range right now. So we'll see if that holds up. But we've been pretty choppy since the opening bell, although big range, but choppy nonetheless. So this is the dollar index since the open. We'll see what happens there. I think I prefer 50. Yeah, I think 50 is going to do enough to curb inflation. I think 50 is going to be enough to curb inflation. And I think it's going to I think 50 or 75 would rip the Band-Aid off and then get the inflation out the way. But the other fear is that they do 50 and the market tanks and then spending is still kind of out of control. I think that's why they're hesitant to do 50. I think the odds are still at 25 basis point. But I'm curious to see what the updated poll numbers show between 50 and 25. Beginner trading, you are absolutely right. Yeah, I mean, again, I know. Listen, I don't want to keep arguing about it. It's probably better that I don't say anything. I know that the drop happening exactly at 10 o'clock on the dot is not a coincidence, right? The drop happening right when the report is released, when the Powell statements are released at 10 o'clock on the dot is not a coincidence, right? That's the easiest way to put it. But again, I really want to move on from that argument, Depends on the job report. Yeah, the JOLTS job report drops at 10 o'clock on the dot today as well. The expectations for the JOLTS job report are for let me see. There it is. So the expectations for the JOLTS job report are for 10.5 million. If you don't know what the JOLTS job opening report is, we also have the Bank of Canada interest rate decision. But the JOLTS report is a survey done by the U.S. Bureau of Statistics to help measure job vacancies. It collects data from employers about their businesses, employment, job openings, recruitment, hires, and separations. JOLTS defines job openings as positions that are open, not filled on the last business day of the month. A job is open only if it meets all three of the following conditions. Number one, a specific position exists and there is work available for that position. Number two, the job could start within 30 days, whether or not the establishment finds a suitable candidate during that time. And number three, there is active recruiting for workers from outside the establishment location that is happening, or that has the opening. A reading that is stronger is forecast supportive of the U.S. dollar. So I think this is going to be. I don't know. Is this one of those things, Chad? And Chad, you can help me out here. So the JOLTS job report, or the JOLTS job opening, I think it could be backwards to how we usually get it. Like, so if more people working is worse for spending, then does that mean that more job openings means less people working? Or do I have that wrong? And y'all can correct me if I'm wrong here. But is that what that means? I think we could theorize that, but I don't know. What do you guys think? Yeah, I think that's kind of what it is. A broken clock is right 2 times a day. I think 50 would make everybody rich due to massive put contracts. Well, I don't know about everybody. I think there's more longs than shorts in the market, and so I think it's going to cause more people to lose money than gain money. It might make put option traders rich, but well. Tesla right at consolidating around the level. All right, so here, okay, we asked. Here's a great. I think this ends the argument. All right, I think this ends the argument, guys. All right, so we asked Bing here. Why did the market drop at 10 a.m. Eastern Standard Time yesterday? Bing with ChatGPT said, according to Yahoo Finance, U.S. stocks turned lower Tuesday after Fed Reserve Chair Jerome Powell told Congress that interest rates are likely to go up sooner than expected due to inflation pressures. This sparked a sell-off in tech and other growth sectors that are sensitive to high borrowing costs. Argument done. Shout out to robots. But no, with the JOLTS job opening report, 10.5 million. Yeah, it's at 10 o'clock. Yeah, a lot of stuff got beat up yesterday. And again, it's from basically what Jerome Powell said yesterday, was that he thinks that they might have to be a little bit more aggressive in raising rates. The dollar index just broke under the previous closing price. So the dollar index just went red on the day, which is probably good for markets. This might cause a bounce in stocks, but we'll see. Well, no, Bing Chat GPT did. So the good thing about the Bing Chat is that it uses recent data. It uses real-time data. All right, but yeah, the Dixie just broke under lows. We'll see if it continues to hold, but it's right at the previous closing price now. Bing, B-I-N-G. AI puts the smack down. Hey, shout out to Bing. More job openings means more competition for labor. Yeah, but I think more labor is worse, But I think job openings could mean less people working, right? But it also could mean economical growth. And so, the JOLTS job report will be interesting to see the reaction that we get from it. Fed chair is going live at 10 o'clock. Job opening is demand of jobs. More openings equal higher wages. Gotcha. Yeah, there's the Dixie still falling down some. Yeah, the bottom line is that Powell speeches are market movers, 100%. Powell speeches, again, you get, like I said, we had 4,000 or 5,000 people tuning into this stream, just my stream yesterday. And so if you think about the amount of people tuning into the overall congressional testimony that we got yesterday, you'll understand that why the market moved so much at 10 o'clock is because my man Brown started speaking. They dropped the actual file of the report and what they said yesterday. So all of that is going to cause some negative sentiment to happen really, really quickly. And that's what we got right at 10 o'clock on the dot. Again, I think arguing against that is silly, but it's kind of like arguing against on CPI day at 8:30. It's kind of like saying if the market goes up or down big at 8:30 on CPI day, that it's not from CPI and it's instead from some obscure technical pattern that happened. It just doesn't make any sense. Yeah, for sure. Me too. AI is allowing many people new to work remote. Yeah, AI is really cool, man. I'm excited about it. As a software developer myself, AI is really, really useful. And it's going to get better and better, I think, over time. Yeah, so he's speaking with the House today. So yesterday was the congressional testimony. Today is going to be with the House. So today will move markets even more, probably. Maybe not more. I don't know. I think more is, you know. All right, guys, we got less than an hour before Jerome Powell speaks as well. Dollar index is bouncing up. We still got Tesla run pretty sideways over the last 5 or 10 minutes. Now we got 55 minutes. We'll put the we'll put the timer up. So yeah, we got let me see. Yeah, we've got about, that's 53 hours. That's not right. There we go. 53. Yeah, I don't know, man. I don't know what the market's gonna do. $10 a.m. Yeah, it's at 10 o'clock. It's in 52 minutes or so. And we'll see how everything moves here. We got a little bit of period of time where we had non-farm data come out, and we might get some movements now from that. The dollar index is at 105.60s. Yeah, we're going to stream the entire Powell speech live. You know, it's worse than I called a comment that you should have listened to me from some random person you've never met or heard before. Yeah, for sure. I mean, like I said, I will sometimes say, and nobody listened, you know. But I always tell people I have no idea what's going to happen. And like, it depends, right? Like I'm on YouTube, so, you know. When you're right, I think you got to celebrate your wins. And I understand that completely. But I've had a lot of people here that, hindsight trade, right? So they say, hey, you know, this is going to go up, do this. And sometimes I'll listen to them, sometimes I don't. But as I suggested, most of the time I genuinely just tune everybody else out. I just got to tune everybody else out because I'm gonna be my own best advocate, and again, I'm green on the year doing what I'm doing, and so I think if I let other people influence my trading too much, I'll probably just lose money. Um, but I at the same time, I do understand it. Like, I understand celebrating your wins. Uh, so I think the market will bounce today. Yeah, I guess I'm bullish. If I had to pick a direction, I guess I'm bullish today. But I'm not going to take anything major ahead of it because I really don't know here. Tesla's starting to creep back down at 185s though. All right, guys. Yeah, we got Powell again at 10 o'clock today. House testimony today. It got heated yesterday during that testimony too. All right, so the Dixie just broke down again here. We'll see if we get a pop bounce from this. But the Dixie just bounced back down under the previous closing price. The SPY is mostly flat here, mostly flat. Yeah, but I think we're agreeing for different reasons though, Sean. And like I said, man, it's all love here. It really is. Like I said, we could agree to disagree on that. Again, I really don't, maybe it's not an argument, but I just don't want the day to only be talking about this. But I think the equivalent of what you're saying is kind of like somebody saying that if the market moved up or down on CPI day right at 8:30 on the dot, that's like me claiming that it didn't move from CPI and it instead moved. If, say, CPI came out much higher than expected, much worse than expected, the market dropped 2% from that. What you're saying is the equivalent of saying, hey, the drop at 2%, the 2% drop that happened exactly at 8:30 when the fundamental data came out was not from the fundamental data, but was instead because of a moving average crossover. It's just, like I said, we could agree, but I definitely don't agree that it was technical. But it's all love here, man. You know what I mean? It really is. I appreciate you, bro. It's all good here. We don't always have to agree on everything, and I get it, disagreements, and nobody's going to agree 100%. That's part of the endearing thing of the stock market as a whole anyway. I like the buy the I dipped today. I just think they're going to make it that easy, push it down, get the bears excited, then rip it up. Maybe. I don't hate the buy the dip, but my problem is, what do I buy the dip in? Tesla, a little bit too volatile for me, I think. I don't think Microsoft or like this. I don't think the SPY is down a lot, so I guess maybe dip on the SPY makes sense. But what other stocks are extended on the downside enough? We have seen CPI come in worse than expected, and markets go up. Well, I mean, there's a lot of nuance behind it. So unless you show me the actual release and unless I watched it on that specific day, I'm not going to know why that happened. It could happen for a number of different reasons. It could happen from being higher than previous but worse than expected, or being lower than the previous releases like we've seen but a little bit higher than expected. That could still, arguably cause a positive reaction. So, I mean, there's a lot of reasons it could happen, but most of them are fundamental in nature. Because the truth of it is, on a short-term basis, fundamentals trump technicals. And I think that's what a lot of, if y'all can learn anything at home here, it's that on a short-term basis, really on every time frame, fundamentals trump technicals. You might have the best technical pattern in the world happening right at that point in time. But if inflation data comes in much, much worse than expected, like much worse than expected, say they expect 8%, it shows up at 9%, right? If that happens, you could have the best long technical pattern in the world. The market's still going to drop, and I think that's an important thing for people to understand, is that fundamental moves markets in a much more profound way. If you look at the average technical move versus the average fundamental move, the fundamental move from economic data is going to influence the market in a much larger way, and it's going to be much more influential than technicals do, especially long term, but on a short term basis as well. Like another example is you could have a stock that has the best. We're going to get ready to day trade a little bit, but point is, you could have a stock that has the best technical pattern ever right at earnings, as earnings are released, right? But again, that earnings report is going to trump any technical pattern that happens there for the most part. If it's really polarized report, that is, like if it comes in much better or much worse than expected. And so technicals are important, but fundamentals are going to trump technicals by far. And I think that's a very self-evident thing in markets. All right, guys, we're going to get ready to day trade. What about psychological trading? I use psychological trading all the time. I look for extension based off of overreactions. Is my favorite style of trading. Is looking for extensions from overreactions. Extension from overreactions. Like if a company has mixed reports and we drop big, I buy it up and ride the overreaction back up. Did that a lot with Snapchat, Amazon the last year. So I like trading off of psychological moves too. But I think that you got to look at each individual one. All right, SPY right at the previous closing price. We're at 398.50s. Yeah, jolts when job report comes out. Sounds good. All right, guys, 13 minutes. 13 minutes before the market opens. Yeah, I love overreactions too, Snow. They're one of my favorite, most profitable plays. Is just looking for a company that has some negative earnings come out. Maybe EPS is bad. Maybe, whatever's bad. Maybe guidance was a little bit worse. It can't be really bad numbers. Like if it's really, really bad, that's one thing. But I think most of the time I look for earnings that just cause huge extension on the downside, and I just buy those up. It's one of my favorite, most profitable plays. Is just looking for earnings overreactions where we just get huge drops in healthy blue chip companies that I can just kind of buy the dip and ride it back pretty quickly. I do it all the time. It works really well. I did it with Snapchat. I did it with Amazon. Hey, what's up, Jessica? Yeah, I mean, I think that's wrong too, Lee. I've been day trading for 6+ years, man. I think that's wrong too. Again, I don't think it's really arguable. Okay, but I'll use the same example. You could have the best technical pattern in the world, right? When CPI drops at 830, that technical pattern is going to be relatively insignificant for short-term price action. And I don't think that's really arguable. I think it's very obvious that at 8:30 on CPI day, that's going to move the market in that direction more than any technical pattern will, a large majority of the time. And it being a large majority of the time proves that at that specific time, fundamentals trump technicals. Now technicals are important, but they're not going to stop a much worse than expected CPI report from dropping the market. That's just not how it goes, man. And again, I think arguing against that is silly. But with that said, I'm going to go ahead and request that this argument is, I don't think there's a point in continuing to talk about it. I think we've been talking about it too long now. Right. You could argue it. It's just not right. You know. Yeah, for sure. Market started to bounce back up a little bit. You can see the E-mini here. We'll see what happens. We're going to try to trade it. Speaking of technicals, we'll try to trade it. Yeah, extension can be the outlier there for sure. But again, it happening a majority of the time means that fundamentals are going to trump technicals a majority of the time. You know, like that's. Oh no, my plaque. Let me get this right. This is my coffee. I'm out of coffee. I'm gonna have to get Carol to make me a coffee. Hook this up. See, I need to get a stand here, guys. Y'all recommend me a stand. I don't want to break that thing. Yeah, it's a good topic. Like I said, it's all love here. We could disagree. I hope you guys don't get too upset. I'm not upset, obviously, and I think it's a good conversation. I just think it's filling up too much of the stream at this point. So, hey, I appreciate it, Sean. You too, man. Thanks, bro. You know, these type of debates are good. They're good for people to hear. They're good for traders, and doing so in a respectful way is always good. It's what we try to do here. So, yeah, man, it's all love here, man. Use pictures of your kids to hold it up. I got this thing I can use that doesn't get enough attention on this stream, but I got this thing I can use. Check out this thing, man. Carol got me this thing a while back. Look at this. This thing is bronze. It's heavy. It's a bull tackling a bear. You know. That's probably a pretty good hold. Yeah, that'll work well. Hey, thanks, Fireworks. Thanks, man. I appreciate it. I use the volume weighted average price. I use like I said, don't misunderstand. I use technicals every day. I day trade purely off of technicals most of the time, but sometimes I will trade fundamentals on days where fundamentals are going to trump technicals, like Jerome Powell press conferences, CPI, PPI. A lot of the time I'll wait for that data to come out. I'll wait to see the sentiment from those reports or releases, and then I'll ride that trend that happens from it. Which, you know, is kind of what we did yesterday. Yesterday we were red trading the open, but once Jerome Powell came out pretty bearish, then we started shorting, and we ended slightly green, up over 100 on the day yesterday. So we'll see if we do that today. I don't know yet, but Dixie's starting to bounce back up a little bit. Really sideways market though over the last couple of minutes here. Permabull. Anybody buying the crypto dip? Yeah, I don't know, Sean. It does, actually, Sean. It does, man. Wow, I didn't notice this before. Oh my gosh, it does. And they are big, too. Wow, I didn't notice that before. The bear does, too. All right, guys, market pull it back a little bit. I think this thing, I don't want this thing to fall. There we go. You can trade before 9:30 on TOS, Shepard. The way you got to put an EXT order in there. So you got to change, you got to look at the time, and you got to go to the TIF, the time in force, and change it to EXT, and then only use limit orders. So you have to use limit orders in pre-market. You can also, you also have to change the time in force to EXT. Yeah, I'm a very contrarian trader. Like I like looking for big extension on one side when everybody's saying the sky's going to fall on the downside. I buy the dip and ride it up, and then vice versa. When everybody is saying bull, bull run, yeah, I usually get pretty flat and don't trade. TIF is what it's going to be labeled as, Shepard. Market dip and open. I don't know. I really don't know. I think the market's down a lot over the last 24 hours, and so I think if there's some really short-term extension, I think it's on the downside, but it's not enough extension to really say, hey, we're done going down. We might bounce up. I think it depends on what Powell says today. It's going to influence how we close or open, or how we close today and open tomorrow. I think it's going to depend on what Powell says. We also have the JOLTS job report coming out too at 10, so we got some stuff. Why? Are you meaning actual, like literally that, or what do you mean by that, man? If you're talking about literal ones, I've got a 6-hour right next to me, but if you're talking about options expiry contracts, which is what I think you're talking about, I don't know. Do a double kickflip on that like button. Yeah, market was flat ahead of it. Yeah, I mean, even if that's the thing to watch today is like, listen, people are apprehensive ahead of these Powell speeches. If you look at yesterday ahead of his Powell speech yesterday here, if you zoom out here, the market was pretty flat. Where's 10 o'clock? You kind of see the same thing yesterday where, like, leading up to the big drop yesterday, the market was almost completely sideways. Like, look, sideways, apprehension, nerves, Powell speech is released, dump, right? That's something where a lot of people are going to be tuning in today as well, and we'll see what happens. But yeah, today's is going to be in front of the house. We'll see. We got sideways momentum today, basically, too, though. Apprehensive. Yeah, they're going to be less likely to trade because of big economic influences and fundamental moves. They're going to be less likely to trade because they understand that regardless of what happens this morning at the opening bell, the market's going to be heavily influenced by the Jerome Powell House interview. It is what it is. Yeah, I don't know, Jake. We'll see, man. Hey, good luck, DS. Thanks, brother. Yeah, I'm going to be pretty flat. If I do trade, it's going to be small. CrowdStrike, didn't they have earnings yesterday? I just don't know enough about them as a company to really say yes or no. They're gapping up big, though, man. They're up to 130s from 120s. So it looks like their earnings were favorable. So I need Apple to pump. Yeah, we'll see. Market's going to be pretty flat ahead until the Jerome Powell stuff comes out, though. All right, so here's the opening bell, guys. Good luck. We'll try to trade today. We'll see if we get anything good. But again, choppiness might be here until the Jerome Powell stuff in 30 minutes. There's the open. Market's moving up a little bit at the opening bell. A little bit. Yeah, Powell in 30 minutes. CrowdStrike ripping up too, man. Look at that. Dollar index falling down. That's good. Do me a favor, hit the subscribe button as well, guys. We need 50 more subs to break 102,000, 102,000. We need 50 more subs. But yeah, market's flying up. Nice. I don't know anything about them, Timothy. At the same time, Powell speaks, the Bank of Canada is reporting their rate hike decisions. Yeah. All right, market ripped up at the open. Dixie just dumped down fast too. Yeah, that's kind of how I'm feeling too, Will. It's like I don't want to take any huge positions just because of risks of a rebound happening. Market's playing out a little bit here. SPY is still dollar index just flew down here, just a huge drop. Market just broke highs. Looks strong. Tesla's still kind of consolidating over the VWAP though. SPY ripped up to the top. Quick flush rejection, mostly from Tesla breaking down here. See if we buy the dip. I'm going to try to let things play out though. I don't want to take any huge size right now. I'm going to let the opening bell do something. Tesla started to dump down though. See if it drags the market back down here. And dollar index still looks pretty good though. Tesla weighing the market down right now. Tesla breaking lows. Yeah, the market is very choppy right now, to be honest. Like, it is a very, look at this huge upwick here. It's very choppy. I haven't traded yet. Tesla just broke lows, cracked under lows of the day. Yeah, baby. All right. All right, if you saw that, I accidentally shorted the regular E-mini here, which is not what I meant to do at all. I think I made some money there, though. But I think I cut it right in time. But that was not what I was trying to do, man. It's too early for me to take a regular E-mini trade. But yeah, we're green on the day. Accidentally green, but green nonetheless. I'll take it, you know. Yeah, look, we made about 40 bucks there accidentally. I accidentally brought the regular E-mini and I cut it just in time too, because that thing is volatile right now, man. Market looks weak though. I mean, it looks like it's going to flush down here. So we'll take some trades of the regular micro, which is what we initially wanted here. Because the market does look weak. Yeah, and there's the weakness coming through. Like, this is where you use technicals, is watching like little short-term patterns. But like fundamentals are going to trump anything like this. All right, we're going to cover that. Cut a little bit more there at the bottom. All right, so we're up about 60 bucks now on the day pretty quickly in the first 5 minutes of the day. Market's starting to dump down. SPY hit the previous closing price, bouncing right back up. Dollar index is starting to climb back up as well. Yeah, luckily I didn't end up buying anything too big at the open bell because this was just too risky here. I just think that I like playing overreactions, and I think yesterday was somewhat of an overreact. I'll put it this way. I like playing overreactions, but I don't know how much of an overreaction yesterday was. I think yesterday's reaction was pretty reasonable considering what happened, right? Which is basically, Powell said that 50 was an option. So here's the test of lows here. Yeah, for sure. I mean, I could understand why people think it was an underreaction because, again, he's basically saying that they might do 50 instead, which I think is not good. We're going to short this a little bit more. Try to ride it up. We'll try to get maybe 3 or 4 contracts here. There's 3. Maybe going to add 1 more here to this. There's 4. The problem is we're right at the previous closing price. There we go. All right, we just covered some of it. Got out a half. Lock in profit there. There we go. Took another half off. 1 contract left. All right, just cut out the rest. So yeah, we're up about 75 bucks on the day now. Almost 100 pretty quickly. Got a little cushion that we can trade into as well. Just a lot of weakness at the opening bell. Tesla's kind of what's dragging the market down, I think. Market's pretty flat on the day, though. Do you think the Bank of Canada interest rate decision will influence the market? Not that much. No, I think that's probably the smaller economic release today. I think we got the JOLTS job report and Jerome Powell testifying in front of the House. And so I think those are 2 much bigger fundamental releases and economical releases than the Bank of Canada interest rate decision in another country. So I think we'll pay attention to it, but it's not a huge influencer of markets relative to everything else. I got a question. What's the difference between the testimony of the Senate versus the House? Wouldn't Powell be saying the same stuff as yesterday? Wouldn't the market know already what he'll say? Not necessarily. It's going to be a different interviewers, different people testifying, different people talking to him who might have different sentiments, different views, different questions. You know, so it's going to be very relevant in that way too. The House will be harder on him than think. Yeah, that might be true. All right, there's the breakdown. Yeah, no worries. Got a little pop up here. I could short. 2 contracts short here. right, we covered half of that. We're going to get out there. I think we could bounce back here. So we just cut that. So we're up about 90 on the day. Yeah, there's the bounce back. So no losses so far at the open. And again, this is where I trade technicals. I trade technicals short term because short term are where technicals are the most relevant, like this. But again, don't get me wrong. If a fundamental release happened right now, depending on how big the release is, it's going to trump what technicals, do here. All right, market just broke lows. You were right on the money. Hey. All right, market's consolidating. Yeah, I don't mind that idea. Stelios. I don't mind. If we drop all the way until CPI report, I'll probably buy up some stuff too, but it depends. But yeah, there's the bounce back here. We're just going to kind of hang out right now. So far, so good, though. I mean, no losses yet. Yeah, I thought we might get a bounce back too. It's one of the reasons we covered that short position we were in. All right, so here's the rebound coming through. See if it holds. Dollar index still looks weak, and it's pressing down here. Dixie looks weak still. It's a good sign. Tesla trying to bounce back, but the market's turning here, I think. Yeah, and again, I'm pretty flat on my long-term trades. I told you guys yesterday I thought we might drop from the Powell testimony. And again, I think the logic, you guys got to understand the logic there, which is that inflation data got worse in between the last time Powell spoke. And the last time Powell spoke, he basically said that he wanted to sustain 25 basis point rate hikes, but he would consider raising it if things changed. And I think between now and what Powell said last time, things have obviously changed. And so, it's one of the reasons we liquidated our positions and swing trades over the last couple days, because we assumed that we might correct a little bit. And again, I think the question leading into the next Powell testimony with the House today is, do we bounce? Are we extended on the downside, and do we bounce? I'm not convinced anything yet, so I'm pretty flat on my swings. But I think there's an argument for both sides. It depends on his tone today, and I think we'll have to wait and see what happens. Let me know what you guys think. I know we did a poll number here. Let me see what the poll said. I am trading the E-mini Nasser in the futures market. The E-mini is a futures contract that allows you to day trade essentially the S&P 500.
Yeah, I'm gonna wait right now. I think it's too up in the air. I think that Powell could say good or bad things. If you guys know me, I always try to get out of swings ahead of big economic releases and fundamental releases. And I think right now what we have is, big fundamental release and Powell getting interviewed by the House, who might be harder on him than the Senate was yesterday. So I'm flat right now, and we mostly made our money shorting the market today. But we're not going to take any big positions. If we get a big drop from the Powell testimony today, then we might load up some stuff. But remember, on the 14th we have CPI coming out, and so it's one of those big fundamental weeks where I don't really hold much because of large economic and fundamental influences over markets. So again, today we've got jolts coming out in about 15 minutes. We've got Powell speaking with the House at 10. In about 15 minutes. Tomorrow we have jobless claims. Friday we have unemployment in both Canada and the U.S. as well as the non-farm payroll data. Tuesday of next week we have CPI. So regardless of what my directional bias is here, these are things that can massively influence the market fundamentally, and because of that, I would prefer to stay flat ahead of this. So it's called the E-mini. And again, if you want to try out the futures market without taking on a lot of risk, they have funded account programs for futures. And I think it's a lot cheaper to try one of these out because I think most people who day trade are going to lose money. And so I wish I would have had these funded account programs when I first got started trading because it's just a lot cheaper. You still have some pressure, so it still kind of feels like trading regularly. And what they do is they give you a demo, and if you can hit the target on their demo while following their rules, they fund you basically. So it gives you some pressure, but you're not risking a lot. The base one's like $140 a month. They're a sponsor of mine. But essentially, I'm day trading the S&P 500 in futures, and there's no PDT rule. And so if you want to check them out, here is the funded account program I'm using right there. It's called Top Step. But you do have to prove yourself with a paper demo account first. Tesla breaking lows down to 182s. Forward at 1230s. Nice, Marcus. Symmetry of the bars. Yeah, this just means we're in a sideways range. I could literally draw a square around the range. Just choppy. This is called a range. So we're just in a little range here that goes like this, So the interesting thing will be when we break out of the range, either on the upside or downside. And the question is, where do we go from that? I don't know. But there's the range right there. We'll see when we break the range. Yeah, that's what I'm trying to do, Stelios. I'm just trying to be patient, man, and wait. Like I look for objective value and overreactions, and I don't know. Again, I think the reactions to yesterday's Powell sentiment was reasonable. The SPY is basically sideways, though. Like you're gonna have some people that are doom and gloom. 20-day chart's pretty sideways on the SPY. 180-day chart is very green. A yearly chart is red. A weekly chart is green. You know what I mean? So it's like I think we're actually pretty neutral here, and we've been around the same area for the last couple weeks or months, really. So time will tell. Tesla finally pulled it back some, which kind of shows. That's why I was skeptical to buy it. Yeah, we got about 12 minutes until the Powell speech, and we're going to stream the whole Powell speech live right here. We got 10 minutes, guys. 10 minutes before the Powell speech. I'm not going to say you're ready, Pyro. I don't know you as a trader, brother. What I will say is that it's cheaper to lose on a funded account program than it is to lose on a real account. So it's completely up to you. We're going to cover the jobs data as soon as it starts as well. Like we're going to cover both of them. Like we'll stream the entire Powell testimony as well as the jobs data, as well as let you watch the market reaction to it too. I'm using Quant Tower with Top Step. Bro, I lost 90% of my wallet because of Powell yesterday. Why are you trading super big size like that, brother? You know, most trading problems can be solved by scaling down, bro. And so scale down, man. Don't risk 90% of your portfolio in something, man. That sounds incredibly risky. You know. Hey, what's up, Mountain? Market very sideways, which is not surprising considering that we got Powell testimony coming up right now. So we are waiting for this to start here. You can kind of see. Waiting for it to start. We got it on hold now. Tesla had a recall, or Tesla had something about the steering wheel falling off or something like that that came out this morning. Yeah, I don't know if he says the same thing or not. I think, again, the thing to understand here is that Powell will probably have, he's going to have different interviewers. He's going to have different questions. He's going to have different, it's going to be a different interview here. He might say the same thing, but he might not. And they might ask him different questions that are all relevant to market activity. And so because of that, we can't just say, oh, it's going to be the same thing. We got to look at it objectively and say, okay, well, we'll see what he says. But it doesn't necessarily mean we're going to get the same reaction we got yesterday. It doesn't mean we won't either. But we'll see. Again, we're going to stream it all live. Hit that subscribe button. Hit the notification bell. All right, market is slowly churning up, but not really super big in terms of activity and movement. Because I'm a beginner and I got a signal from all of my friends to go for layer after layer till I lost everything. Yeah, man. I mean, in the end, one of the basic truths of trading is that your friends don't have your best interest at heart. They're gonna try to artificially inflate their own positions by telling everybody that they know to buy the stuff that they're holding because misery loves company and losing traders want other people to lose. That's just the truth, right? And so don't listen to your friends, man. If you don't know what you're trading, don't buy it. Research it yourself and make your own conclusions is the best move you can do, man. Good luck. I hope you make some money, bro. But yeah, in the end, you're always going to have people trying to pull you in one direction. Yeah, you're going to hear the full Powell speech live right here. It starts soon. All right, Tesla's still consolidating around lows. We made a little bit of money today, but we stopped trading once the market started to look like this. We caught the breakdown a little bit, but the market is just kind of churning today. Not really the easiest thing to bet on right now in terms of technicals and short-term price action here. So, yeah, we're gonna cover jolts. I'm not sure. Pyro. You know what I mean? And the way you trade is completely up to you, brother. Again, what I know is that we got a big fundamental release happening in about 6 minutes. And so because of that, I'm pretty flat in everything. I'm not telling you you should be flat. I really don't know what you should do, but I'm pretty flat. So 10 o'clock is when the speech begins. We might trade a little bit, I'm not sure, but probably we're going to be very careful. If we do trade during it, it's going to be very small. Yeah, we got jolts coming out too. Again, we need 10 more subs to hit 102,000. 10. I'm talking to you right there. Hit that subscribe button. Try it one time. It might feel good. Do it now. Subscribe if you haven't already, guys. Hit the notification bell. We certainly appreciate it. Again, we're just kind of sitting here waiting. So again, right at 5 o'clock on the dot, we got jolts, and we got, or right at 10 o'clock on the dot, we got the jolts job report as well as the Powell testimony going live here. So hey, thank you. We appreciate the support, guys. Yeah, hit the subscribe button, hit the notification bell. Again, it goes live pretty soon. We're going to fix this chart so we can get ready to trade it and watch the market reaction here for it. 3 minutes, guys, 3 minutes. So here's the NQ on the bottom. We'll put the NASDAQ 100 on the bottom, and then we'll put the E-mini on the top, or on the right. 2 minutes, guys, 2 minutes. Y'all can hear the music, correct? You should be able to. I've heard some compliments in the music today, so you should be able to. SPY actually rip it back up, so the market's actually rebounding nicely here. Again, we'll see if we get anything good. But there's the market starting to bounce back. We got less than 3 minutes here, team. About 2 minutes until the JOLTS report goes live. This looks to be a little bit delayed, but this is coming straight off of the Financial House website. Let me check this to be sure. Should be a website here. Hold on, bear with me, guys. All right, guys, JOLTS job report comes out in about a minute and a half here. Market's actually flying back up, bouncing up a little bit ahead of this. So that's good. Yeah, so it looks like it's not just me. It's live right now, so this is basically their timer is a little bit off. But yeah, here we go, guys. 45 seconds, 45 seconds. JOLT's expectation is for 10.5 million. 10.5 million. All right, it drops in about 10 seconds. We'll see how this moves markets, as well as the release should happen right at 10 o'clock on the dot. All right, there's a big release. Yeah, that's what I'm saying. Saying this release is technical is just silly. All right, you can see the release again right at the dot on 10. The JOLTS job report hasn't updated yet. Let me look other places here. Bank of Canada is doing 4.5% as expected. No JOLTS data coming out yet. They might have released the statement here for Powell's testimony. But yeah, the Bank of Canada did it as expected. Market is dumping down here. All right, so JOLTS came in at 10.82 million. 10.82 million for JOLTS. 10.82 million. Still waiting for the stream to start for Powell. And again, there's the SPY. And again, as I said before, saying that this is technical is silly. This is obviously from fundamental and economic data. It's the same type of move we got yesterday at 10 o'clock on the dot. You know, if moves like this happened every day at 10 o'clock on the dot, then, you know. But yeah, you can see it starts at about a minute. 4.5% for the Bank of Canada. JOLTS came in at 10.824 million. Again, we're on their website. We are live. You can see the red live button. And make sure on this stream it's red as well. You need to see the red live button right here. That's where you know it's actually live. I'm going to turn the music off and get ready here. This is about to start, but the SPY is dumping down. NASDAQ dropping. JOLTS job report come out higher than expected, which means economic growth, which is going to be seen as negative. SPY dollar index just ripped up. And we got this report live right here, team. So we are just waiting for the press conference to start. But the market is definitely reacting negatively here. All right, guys, waiting to start. Again, it should start now. It looks like they're a little bit late here, waiting for them to start. But yeah, JOLTS came in higher than expected. Yeah, I'm not trading until Powell comes on. And again, we're waiting for that to happen now. We're just kind of sitting back, waiting for it to start. Getting a little bit of a rebound back up. Yeah, they haven't started yet. We're looking. Yeah, I could see. So basically, they're just kind of sitting back now. Nothing started yet. Waiting for Powell to start speaking here. All right, so here's the statement. Market started to bounce back a little bit again. We're just kind of sitting back waiting. You can kind of see we're on their page waiting for it to start. They haven't started it yet. Just kind of sideways trending until it starts. Nothing yet. Yeah, nothing yet. Waiting patiently, guys. Waiting for them to start. You can kind of see we're on their actual page here live. Still nothing yet. Waiting for them to hit the live button here. Bear with me, guys. Market's starting to rebound a little bit. You can kind of see we're not really moving yet until they start speaking here. There we go.
For inclusion in the record, and I'll note at the outset that this hearing has a hard stop of 1 p.m. This is traditional for the Fed chair, which we intend to strictly observe. I now recognize myself for 4 minutes to give an opening statement.
Sound check.
Thank you, Chairman Powell, for your testimony today. This week, you stated that the Fed will, quote, stay the course until the job is done. And that is to restore price stability. This is positive. But you know as well as I do, you're facing a very strong headwind from the political left. Democrats are pressuring the Fed to stray from its narrow mandate. It's a page out of their same old progressive playbook. When they don't have the votes to achieve something here in Congress, they turn to regulators. And now, Chair Powell, they're looking at you and the Federal Reserve. President Biden's kowtowing to the far left is what got us into this inflationary mess. I urge you to reject the ideologues who put their social agenda ahead of economic prosperity. High prices continue to eat away at workers' wages and retirees' incomes. Since President Biden took office, we've experienced inflation at rates not seen since the late 70s and early 80s. Inflation rapidly accelerated after Democrats passed their so-called American Rescue Plan, which poured nearly $2 trillion of inflationary fuel into the economy. By June of last year, the Consumer Price Index showed inflation skyrocketed from below 2% to nearly 9%. And personal consumption expenditures, the Fed's preferred measure of consumer prices, ballooned to 7%. Instead of being rescued by Democrats, Americans were punished with pain at the grocery store and sticker shock at the pump. While inflation is now below its mid-2022 peak, it is persisting at rates well above the Fed's target. It remains broad-based and continues to hammer Americans' pocketbooks. In fact, a recent Gallup poll shows half of the respondents say they are worse off financially than a year ago. It's clear that there's still a long way to go in the effort to bring down costs. I look forward to hearing you reaffirm your commitment to that work today. Republicans also want to hear from you regarding some concerning developments at the Federal Reserve on the regulatory front. Recently, the Federal Reserve's Vice Chair for Supervision announced a quote-unquote holistic review of bank capital in the Fed's regulatory regime. However, it seems that only a small group within the Fed knows what this means, what it entails, how much review is being vetted by the full board, and the type of quantitative analysis the Fed is performing. The Fed shouldn't operate in the shadows, especially when the regulation in question can have broad and significant economic effects. It's also unclear the motivation for the Fed's holistic review, particularly when so many board members have stated that the banking system is very well capitalized, and any review of capital standards should be targeted. It also appears the Federal Reserve Board is laying the groundwork for climate policy to be implemented through the Fed regulation with an opening salvo to quote unquote scenario analysis. Addressing an issue like climate change is important, but a policy that should originate here in Congress by the elected representatives of the people, not the central bank. As you said, the Fed needs to stick to its knitting. I agree. There is concern from many that the Fed is picking up new needles and knitting partisan sweaters. At such a precarious time for our economy here at home, for your testimony and the questions by our members. The chair now recognizes the ranking member of the committee, Ms. Waters, for 4 minutes for an opening statement.
Thank you very much, Mr. Chairman. Good morning, Chair Powell. Since your last visit, our country, under the leadership of President Biden, has made major progress to improve economic conditions, including adding a record 12 million jobs, reducing unemployment to its lowest rate in 54 years, while also reducing the deficit by $1.7 trillion. Unfortunately, many families are still struggling to afford basic necessities because of inflation. What's more, interest rate hikes are making borrowing, especially for mortgages, outrageously expensive. Since I raised this concern for you in a November letter, the rate hikes continue to have an outsized impact on housing costs, which are, as you know, a primary driver of core inflation. But, Mr. Chair, I think that you will agree that Congress also has a role. That's why I'm somewhat disappointed that after 2 months, Republicans have taken no serious action to address inflation. By this time last Congress, House Democrats had passed the American Rescue Plan to provide relief from the ongoing pandemic, which included our committee's efforts to provide $70 billion for homeowners, renters, businesses, and first responders. If Republicans are looking for ideas, committee Democrats have put forth additional bills like the Build Back Better Act to bring down costs for Americans, especially housing costs. Even more concerning, we're just months away from an economic catastrophe beyond what we have ever seen, including spiking interest rates, massive job losses, and global instability. I'm talking about the threats by Republican leadership to force a default on our nation's debt if we don't agree to their demands to cut Social Security, Medicare, or other critical programs. You've urged Congress to take immediate action to raise the debt ceiling. But rather than focusing on this very real issue, the first bill that committee Republicans brought to the floor instead suggested that Social Security and Medicare are socialist threats to America. Since then, we have considered legislation related to deregulating securities and banking laws and countering threats from China, but Republicans have completely ignored the biggest economic threat to businesses, consumers, and our economy, defaulting on our debt. Last month, I wrote a letter to Chair McHenry urging him to take this matter seriously and hold a hearing, but I'm still waiting for a response. I hope Republicans will listen today to the real consequences that even the mere threat of a default would have for everyone in this country. And finally, I'm so pleased that we're finally making progress on diversity and inclusion for key positions at the Fed, including last year's historic confirmation of Dr. Lisa Cook to serve as the very first Black woman on the Federal Reserve Board, with the board's vice chair and Kansas City Fed president positions vacant. I think President Biden and Kansas City Fed Board should build on this progress by seriously considering diverse candidates for these positions. With that, I yield back the balance of my time.
The ranking member yields back the balance of my time, asking unanimous consent to submit for the record my letter to Secretary of the Treasury, Janet Yellen, from February 28th, asking for an update on the ex-date for the debt ceiling. I also ask unanimous consent to submit for the record the latest CBO long-term budget outlook on the unsustainability of our debt, most recently released. And without objection, so ordered. I'll now recognize the Chair of the Financial Institutions Subcommittee Chair, Mr. Barr, for 1 minute.
Thank you, Mr. Chairman. And Chairman Powell, thank you for being here today to discuss The Federal Reserve's monetary policy actions in a time of economic uncertainty, mixed economic data, historic inflation that continues to plague families and businesses around the country. It is paramount that the Federal Reserve remain vigilant on reducing inflation, anchoring inflation expectations, and restoring price stability at the Fed's 2% target. I also look forward to discussing the Fed's regulatory and supervisory activities. As the Fed reviews the bank capital framework, it needs to consider the impact to the real economy and our global competitiveness when raising capital requirements and sidelining capital would work at cross purposes with monetary tightening, constraining the supply side when we need more, not less, investment to fix supply chains and reduce inflation. Tailored regulations are required of the Fed by law, and a one-size-fits-all approach would be the wrong path to take. Finally, I urge the Fed, in your words, to stick to its knitting and not attempt to be a climate regulator. I yield back.
Gentleman's time has expired. We'll now recognize the ranking member of the Financial Institutions Subcommittee, Mr. Foster, for 1 minute.
Thank you, and thank you, Chair Powell, for being here today. Today is the 15th anniversary of when I was first elected to Congress and placed on the Financial Services Committee, just as the economy was about to collapse. And so that was my trial by fire, the emergency response to rescue the economy and the legislative response, the Dodd-Frank Act, that successfully stabilized our financial system. So 15 years later, as I take my place as the ranking member on the Committee of Oversight over U.S. banking and monetary policy, I recall the solemn oath that I swore to myself back then to make sure that this kind of calamity never happens again. The monetary policy report that we're receiving today is largely a narrative of a return to normal. Lead times to manufacturers are back to pre-COVID levels. The job market retains supernatural strength, and inflation is responding more or less as predicted to the usual measures. And by far, the largest threat on the horizon is a repeat of the 2011 default crisis. Congress has the power to avoid that, and we owe it to the American people to do so. And I yield back.
Today, we welcome the testimony of Jerome Powell, Chair of the Board of Governors of the Federal Reserve System. Chair Powell was reappointed and sworn in for a second four-year term as chair on May 23rd, 2022. Chair Powell also serves as chairman of the Federal Open Markets Committee and the system's principal monetary policymaking, which is the system's principal monetary policymaking body. Chair Powell, we thank you for taking the time to be here. We will recognize you for 5 minutes to give an oral presentation or testimony. Without objection, your written statement will be made part of the record. Chairman Powell, you're recognized.
Chairman McHenry, Ranking Member Waters, and other members of the committee, good morning. And I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. My colleagues and I are acutely aware that high inflation is causing significant hardship, and we're strongly committed to returning inflation to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our tightening so far are yet to be felt. Even so, we have more work to do. Our policy actions are guided by our dual mandate to promote maximum employment and stable prices. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. I will review the current economic situation before turning to monetary policy. The data from January on employment, consumer spending, manufacturing production, and inflation have partly reversed the softening trends that we had seen in the data just a month ago. Some of this reversal likely reflects the unseasonably warm weather in January in much of the country. Still, the breadth of the reversal, along with the revisions to the previous quarter, suggest that inflationary pressures are running higher than expected at the time of our previous FOMC meeting. From a broader perspective, inflation has moderated somewhat since the middle of last year, but remains well above our longer run objective of 2%. The 12-month change in total PCE prices has slowed from its peak of 7% in June to 5.4% in January, as energy prices have declined and supply chain bottlenecks have eased. Over the past 12 months, core PCE inflation, which excludes the volatile food and energy prices, was 4.7%. As supply chain bottlenecks have eased and tighter policy has restrained demand, inflation in the core goods sector has fallen. And while housing services inflation remains too high, the flattening out in rents evident in recently signed leases points to a deceleration in this component component of inflation over the year ahead. That said, there is little sign of disinflation thus far in the category of core services excluding housing, which accounts for more than half of core consumer expenditures. To restore price stability, we will need to see lower inflation in this sector, and there will very likely be some softening in labor market conditions. Although nominal wage gains have slowed somewhat in recent months, they remain above what is consistent with 2% inflation and current trends in productivity. Strong wage growth is good for workers, but only if it's not eroded by inflation. Turning to growth, the U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Although consumer spending appears to be expanding at a solid pace this quarter, other recent indicators point to subdued growth of spending and production. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight. The unemployment rate was 3.4% in January, its lowest level since 1969. Job gains remain very strong in January, while the supply of labor has continued to lag. As of the end of December, there were 1.9 job openings for each unemployed individual, close to the all-time peak recorded last March, while unemployment insurance claims have remained near historic lows. Turning to monetary policy. With inflation well above our longer-run goal of 2% and with the labor market remaining extremely tight, the FOMC has continued to tighten the stance of monetary policy, raising interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to bring inflation down to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee slowed the pace of interest rate increases over its past 2 meetings. We will continue to make our decisions meeting by meeting, taking into account the totality of the incoming data and their implications for the outlook for economic activity and inflation. Although inflation has been moderating in recent months, the process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. As I mentioned, the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If, and I stress that no decision has been made on this, but if the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes. Restoring price stability will likely require that we maintain a restrictive stance of monetary policy for some time. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you, Chairman Powell. I'll now recognize myself for 5 minutes for the purposes of questioning. Chairman Powell, there's been a lot of discussion over the last 24 hours about the effect of rate increases on the economy. A lot of debate about what you said yesterday in the Senate. But no one asked you this directly. We have a March meeting coming up, Open Markets Committee meeting coming up in 2 weeks. How do you think about the March meeting? What's your approach to that? What are we likely to see?
Thank you. So I won't repeat what I just said in my testimony, but if I turn to the March meeting, I guess I would say that we have some potentially important data coming up, data to be analyzed. One of them came out at exactly 10 o'clock. That would be the JOLTS report, which of course I haven't seen, having being sitting here at 10 o'clock. But we're also getting a jobs report on Friday and a CPI and PPI inflation report next week. So those will be important and we'll scrutinize them. When we say that we're going to be looking at the totality of the data, which is what I said, that does include these reports yet to come. They're going to be important in our assessment of the higher readings that we have very recently received and of the overall direction of the economy and of our progress in bringing inflation down. And we'll be carefully analyzing them. Again, we have not made any decision about the March meeting. We're not going to do that until we see the additional data. The larger point, though, is that we're not on a preset path and that we will be guided by the incoming data and the evolving outlook.
But you've also said higher longer. Is that
Yes.
still the case?
Yeah, so, and as I said in my testimony, we look at the data since January and also the revisions to the November and December inflation data, and they suggest that the ultimate level of interest rates is
So to
likely to be
repeat,
higher than we'd expected.
And what are those economic factors?
So going back to January, as I mentioned, the softer inflation readings of November and December were revised up. We got a very strong inflation report for January. We got an extraordinarily strong employment report, very strong consumer spending, strong manufacturing data right across the board. And as I pointed out, some of that may have been affected by the very warm January weather, but nonetheless, all of it pointed in the same direction.
Okay, let's move to regulation. Chair Powell, in January, the Federal Reserve put out a policy statement noting that digital asset custody is a permissible activity if done in a safe and sound manner. However, if a bank can demonstrate to the Fed that it can conduct that activity in safe and sound manner, the capital impact of the SEC's staff accounting bulletin effectively precludes banks from offering digital asset custody service at any scale. Are you aware of this staff accounting bulletin by the Securities Exchange Commission and its impact on custodial services?
I am aware of it. Of course, it's an SEC accounting bill. This is SAB 121, I think, and
That's right.
Certainly aware of it. And we do follow general accepted accounting principles in our
Yes.
capital regulation.
Okay. Well, without objection, I'll submit to the submit for the record my letter to the bank regulators about this. So while the Fed says it can be done in a safe and sound manner, the Securities Exchange Commission has regulated it so that it cannot be done. Next question is certainly about bank capital standards. You got questions about this yesterday. Chair Barr has announced a holistic review of capital requirements. As I said in my opening statement, there are a lot of questions about this process. And previous statements by members of the Fed governors about the adequacy of current capital standards. And so while the Vice Chair for Supervision has announced that the Fed will engage in a holistic review of capital regulation, is that Fed staff? Is that done at the at the governor's, the board level? What is the process? There are a lot of questions that people have about his statements. And so we want to understand why it's necessary for the Fed to conduct a holistic review and what that process is. So, my general question is, do you still agree with your previous statements about the adequacy on a generalized basis of our financial system? Or are we to read into this that we're not adequately capitalized and there's a high level of risk in the system that we're unaware of at this point?
Thank you. So the why really just is that as a new Vice Chair for Supervision, Vice Chair Barr has he's taking a fresh look at everything, including capital. That actually is typical of the last two people to have this job. So that makes a lot of sense. In terms of the process, it's certainly conducted under Vice Chair Barr's leadership with input from the staff and discussions with governors on that committee. And I'm kept broadly apprised about what's going on. But the bottom line is nothing has been proposed to the board. Nothing has been formalized at this point. It's a lot of work that's going on. I think discussions are going on, meetings with industry and that kind of thing. When we get to the place where that's appropriate, the board will be carefully briefed. Ultimately, we'll vote on a proposal, and that proposal will go out for comment, and we'll solicit comment from any and all commenters, and we'll look very carefully at that. So it'll be a wide open process in the sunshine.
Thank you. I yield back. Now recognize the gentlewoman from California, the ranking member. Ms. Waters.
Thank you very much. Chair Powell, I agree with what you said on February 1st, that Congress must raise the debt limit because of what you described as the highly risky consequences of failing to do so. You are perhaps the most important expert on the debt limit, which is why I find it very concerning that your recommendation to raise the debt limit in a timely manner is being ignored by my colleagues on the other side of the aisle. I'm also concerned that the consequences of this brinksmanship are imminent. Fitch Ratings said this week they may seriously look at downgrading the U.S. debt based on the escalating brinksmanship they are observing, even if Congress ultimately addresses the debt limit at the last minute. This is history repeating itself. Standard & Poor's downgraded our debt back in 2011 when Republicans last controlled the House and threatened default. The Bipartisan Policy Center later found that the 2011 debt limit debate cost us $18.9 billion in higher borrowing costs, even though we never defaulted. To put that into perspective, that could have been leveraged to provide up to $200 billion in loans to small businesses through the state Small Business Credit Initiative, or to provide hundreds of thousands of people down payment assistance to buy their first home. So I want to emphasize that House Republicans, including most of the Republicans on this committee, had no qualms about paying our debts when Trump was in office. 3 times they addressed the debt ceiling in a timely manner without holding our country hostage. But Republicans are ready to tear down the hard work of Americans everywhere to weather the pandemic and build back a strong recovery. Chair Powell, can you describe for us the risk you see if Congress continues to delay action on the debt limit, both for our economy and for individuals and families?
Let me start briefly by saying that we have no role and seek no role in what is really at the heart of fiscal policy, except I will limit myself to the 2 things that other Fed chairs have said about this. One is just that Congress raising the debt ceiling is really the only alternative. There are no rabbits in hats to be pulled out on this. 2 really is just that no one should assume that the Fed can protect the economy from the non-payment of the government's bills, let alone a debt default or something of that nature, which we don't think will happen here. But no one should be thinking that we have the tools to protect the economy from all the potential effects of that.
Thank you very much. I don't want to miss what you said. I somewhat quoted you when you said that Congress must raise the debt limit because of what you described as a highly risky consequence of failing to do so. Is that your language?
Well, must in the sense that it's really the only way for the debt limit to be raised is Congress must act. Again, these are fiscal discussions, and we don't want to be a part of them. And really, they're between elected officials.
But you are an expert on the subject.
Well, I spent a lot of time on this, as you'll recall.
As an expert on
years.
this subject, you are concerned about the high risky consequence of failing to do so. Is that correct? Did I correctly quote you?
That's correct.
Thank you. And so, again, let me just go a little bit further. The chair mentioned that he had either written a letter or maybe even had some conversation from Janet Yellen about the time limits that she had attempted to describe. Is it your understanding that she said she could maneuver and kind of manipulate things so that she paid the bills that were coming due, but this could only last until about June? Is that your understanding?
Honestly, I would really have to not try to interpret the secretary's words for you. That's really up to her to do.
Can she keep us afloat until about June?
I don't, honestly. That's not for me to say. These are really questions for the secretary. I'm sorry, Ms. Waters.
Have you had any conversation with her about the statement that she made about being able to manipulate the debt and pay bills that were coming due out of another account, et cetera. Did you have that conversation with her?
The conversations that you and I have privately don't go anywhere. I don't talk about them with anybody. And the conversations I have with Secretary Yellen, I don't.
Okay, and I don't want to get you
Gentlelady
in a-
time is expired. The gentlelady's time is expired.
Did I have equal time with you?
You sure did. He went over time.
If I did, thank you. I yield back.
I now recognize the Vice Chair of the full committee, Mr. Hill of Arkansas.
Thank you, Mr. Chairman, and thank you, Chair Powell, for being with us. You're welcome anytime. Don't wait till we ask. If you want to volunteer and come, we love having your views on many topics. Thanks for talking about your commitment to price stability. You know, we've had this discussion last June between us of, I do think that's the primary mission of the Fed, and I think it should be the only priority of the Fed is price stability, because it's the legislative branch and the executive branch that really are responsible for, quote, full employment and having that policy environment and making sure that that's right. So your commitment to price stability is welcome by this committee. Yesterday in the Senate, you suggested that you supported a regulatory framework, a broadly regulatory framework for digital assets. Is that right?
Yes.
And is it your view that if we had a regulatory framework here in the United States for digital assets, that there'd be more transparency and rules of the road for both consumers, investors, and developers?
Absolutely.
And would it, if we had those rules of the road for business seeking to use and develop blockchain as a potential new technology in their business and tokenized payments, that again, that would be beneficial to business to know how to go about that?
Yes, and to assure that it's all done in a safe and sound manner when we're talking about banks.
Right. And then my next point would be exactly that, to help banks, investment brokers, custodians understand how they could even participate in that market in a safe and sound manner. You agree that a regulatory framework would help on that?
Yes.
And then finally, we've grown up in our country, and it's unique in the world, that we have a dual banking system. And due to a quirk here in Congress over 100 years ago, we have insurance is regulated exclusively by the states. So would you believe that that regulatory framework would also have to preserve some sort of role subject to safety and soundness, you know, for states to play some role in that regulatory framework for digital assets?
Let me just say, I think that it certainly works in banking and insurance. I have no problem with those.
Right.
I'd have
But
to think
you
about,
think it could, you consider it possible that it could also work in digital assets?
certainly possible.
Yeah. Thank you. Turning to a topic that's been a subject here for nearly 4 years, central bank digital currencies. Article 1 of the Constitution reserves coins and money issuance to the Congress. And we've in turn delegated that to the U.S. Treasury, which has since 1912 engaged the Federal Reserve as their fiscal agent. You've testified here many times before that to issue a central bank digital currency, that would have to be authorized by statute by Congress. Is that still your testimony?
So that is absolutely the case as it relates to a retail CBDC. There are,
Right.
Potential forms of a wholesale CBDC that we need to look at. It's less clear, but we've always been talking about retail CBDC, and that's something we would certainly need congressional approval for.
And what would be a parameter on something that's not a retail CBDC where you think that that could be issued in some form or fashion without Congress's direct statutory authorization?
It would be, for example, it would just be something between banks. So it would look an awful lot like a bank reserve. And you might ask, well, why would we need it? And that's a really good question too.
Yeah.
But it's just something that's literally within a wholesale market.
But that speaks that you might have a blockchain between banks and the Fed using a central bank digital currency token to settle transactions institutionally inside yeah. So that leads me to FedNow, which is supposed to be up and running, I think, this summer, somewhat behind the scene there. I would like to ask you to formally have this full committee briefed on that by the Federal Reserve. I know the chair of the Kansas City Bank was involved. She's now left. And I think the committee has a lot of questions about FedNow, how its interoperability will work, how it's going to roll out. And also just a question that we've been asked that why the Fed wire system isn't up 24 hours a day, 7 days a week now to benefit consumers that are using Venmo. Do you have a thought on that?
I'm not sure why we're not 24/7 on that. And we, of course, be delighted to come up and brief the committee on Fed.
That'd be good. We'll take you up on that and the right person from the Fed. And Mr. Chairman, I yield back.
Gentleman yields back. We'll now recognize the the ranking member of the Capital Markets Subcommittee, Mr. Sherman of California, for 5 minutes.
Thank you. Mr. Chairman, I want to thank you for bringing to our committee's attention several years ago the importance of tough legacy LIBOR, some $16 trillion of instruments where the creditor wouldn't know how much the debtor was supposed to pay. This committee, we passed legislation over a year before the LIBOR hit the fan. You issued regulations 7 months before the absolute deadline. I hope we do this in other areas, and it's my understanding that with those final regulations, we're done and we've solved the LIBOR issue. Is that correct?
That's my understanding as well.
Good. People talk about inflation, and they somehow say that it's a matter of the personalities and politics in the United States. Others argue that the entire world is hit by inflation because Ukraine and COVID. I think we've got the answer to this question in that inflation is considerably higher in the Eurozone than it is in the United States today. And it's very hard to say that Joe Biden is responsible for inflation in Germany. I commend the ranking member for bringing up the debt limit and the harm that's already done to our economy. If we solve the problem tomorrow, we had less investment than we would have had yesterday. And I would say that I commend the president. He's going to issue a budget plan tomorrow. And perhaps in their time, one of our Republican colleagues can tell us when the Republican budget plan will be released. We are all eagerly awaiting it. Housing is a huge part of inflation, and we've left it to local government, but the permitting process there guarantees scarcity, which guarantees high housing costs. Mr. Chair, we've talked back in 2001 and several times even before that about wire fraud. And having just bought a home, I saw the process up front. Everybody's very nervous about one thing, and that is, will the buyer of the house be tricked into wiring their down payment to the wrong account? Or will the seller, the buyer be tricked into, or the escrow agent be tricked into sending the money to someone other than the seller of the property? We talked about this back in 2001, where I urged you with your FedNow system, which I'm glad is on track to move forward, to have what the Brits have. When you send the wire, you identify not only the number of the account you're sending it to, but also the name of the person or entity that's supposed to receive that. At that time, back in 2001, you said that payee matching is not the best way to do it. There are other ways to do it, and that you'd be happy to get back to me as to how you're going to make sure that an email from a Nigerian prince does not get the wired funds, particularly in a housing transaction, wired to an account number that turns out to be in Lagos. What progress do you have? When can home buyers have a system where they're sending it to a named payee as well as to a number?
So I hope we did come back in a timely way to you on that. But it's a problem you've brought to our attention, you're right, over many years. And we continue to focus on that.
Well, the bureaucrats who are working on this don't want to do what the Brits did. They've proven it can be done. You said you were going to accomplish the same goal in some other way, and it has been a while, and it's not solved, nor are you aware of any solution. I would hope that you would go back and say, we don't want to add this anxiety to every real estate transaction. We go back to the drawing boards, follow what the Brits have done, and have pay matching. Finally, as to crypto, cryptocurrency says what it means. Hidden money. That's what it means. And if we impose know your customer and anti-money laundering statutes to it, it won't be crypto anymore. What crypto wants is to have part of its ecosystem above the waterline, visible and subject to know your customer, and then have the rest of the iceberg below the waterline.
Gentleman's
time has
time's
expired.
expired. I will now go to the gentleman from Texas, Mr. Sessions, is now recognized for 5 minutes.
Chairman McHenry, thank you very much. Chairman Powell, thank you for joining us today. We appreciate not only your professionalism, but your direction at us. Chairman Powell, I know that the Fed considers divergences, and you talked about it as you spoke in your opening statement about consumer price index, personal consumer expenditures, inflation, GDP, and all these things are talked about in your report, monetary report, March 3, 2023. Thank you. A couple days ago, I had an opportunity to see that an economist, Arthur Laffer, produced a report that spoke about literally this country doubling GDP. Now, I know we're putting CPI, PCE, inflation, all these things into a mix. But he said that if we made changes in healthcare to efficiencies, we could double the current GDP rate. My question to you that I hope you can answer is, what do you think about that? Is that something that is in this document that I have missed? And it's seemingly to a person who follows this, as Art Laffer does for 50 years. What do you think is an important way to look at efficiencies in healthcare? Thank you.
So no, that's not in our monetary policy report. I'll just say one thing, and that is we do spend something like 17 or 18 in that range % of GDP delivering healthcare. Other similarly wealthy countries spend 10%. So it's the delivery system. It's not that the benefits are incredibly rich or anything like that. It's just that the delivery system is very expensive. That's $1 trillion a year that we spend and get nothing for it. This is fiscal policy, but I'm responding to your. So I would think that he may have meant that if we had a delivery system that saved that $1 trillion that doesn't really get us anything, then that would be great for the economy, which I would agree with.
So you've spoken of supply chain disruptions because it in fact is an inhibitor or an accelerator as we gain that advantage. You just talked about some seemingly which would offer some validation to Mr. Laffer as he spoke about the huge importance of this. Is that something you should start paying attention to where policy people, not only at the Fed, but your Fed banks around the country would start looking at and start putting pressure on us to gain those efficiencies as a result of a global view?
So on supply chains generally, they have suddenly been tremendously important in inflation, as you know, for the last couple of years, and for the first time really have been something that we've had to study carefully. In terms of healthcare delivery, that is strictly a question for you and for the parts of the government that are charged with it. The Fed does not have a role to play and does not seek a role in that.
Does not see a role. And yet, as I look at this, you've got a role in projecting confidence. You've got a role in education. You've got a role in who's in the workplace. You've got a role. Interest rates, and yet my point is, it's such a staggering number that impacts us. just love to have you go back. Perhaps we from this committee need to give you some direction on that. But I think your testimony today, it recognizes the staggering impact on that. I don't think it's political. The answer may be political, but I think the actual numbers are not political. It's an inefficiency that is happening across the country, not a regional matter. And so I wanted to get your take on that, and I appreciate you being here as always. Thank you for your confidence and your hard work that you give this country. Mr. Chairman, I yield back my time.
Gentleman yields back. We'll now recognize the ranking member of the Agriculture Committee, Mr. Scott of Georgia, for 5 minutes.
Thank you very much, Chairman, and welcome back, Chairman Powell. Now, Chairman Powell, listen to me very carefully here, because I think we're on the verge of making a terrible mistake. Back in 2008, if you recall, Barney Frank then and Miss Waters asked me to take a look and kind of work with you and the Fed. You were a board member in 2008. And we came to the conclusion that we needed a more equitable playing field between our large banks, like Goldman Sachs, Citigroup, and our regional and smaller banks like Truist and our community banks. And we changed that. But now I hear that the Fed and the FDIC plan to drop a new rule which seeks to apply the long-term and higher requirements that were created, and you and I did this back in 2008, and you remember, that were created for the Goldman Sachs and for them. And now we want to apply these rules to the regional banks. There's a big difference, and we've omitted this difference if you proceed in this manner. I think it's very misguided. It works, and you and I worked on this. You recall this. You were a board member, and we saw that we needed to have a better playing field to protect. And if you all go along with this, it could put many of our regional banks and small community banks out of business. So I want you to reverse this. First of all, tell me, am I speaking the truth? Are you all planning to all of a sudden here put these smaller and regional banks under the same heavy or financial load as your large worldwide banks? Tell me.
No, we're not planning that. We
Well-
believe strongly and always have in tailoring to address the different size and risk characteristics of financial institutions, and certainly nothing like that for the regionals. They won't have anything like what the very large, most systemically important banks have in terms of overall regulation.
Yeah, because I remember clearly you and I were back, I think we were on this side then, talking about this in the same committee room. And you worked with us on that. I'm glad to hear that. Where is that coming from? I mean, it's a concern. It's just a rumor. Have there been any discussions about removing the playing field and the guardrails we have here, the differentiations in the requirements between the regional banks, community banks, and your larger global banks?
So
There's nothing to that?
well, I would say this, we're required by the law now, and we're doing this. Dodd-Frank actually required us, or
Yes, we did.
suggested that we should tailor, and then the S-2155 then required it. And anything that we do
Right.
will reflect appropriate tailoring.
All right, so that's off the board. We're not going to change and put the smaller and regional banks under the same financial obligation role as the large banks. We got that right from you, correct?
Yeah, that's right.
All right, good. Now let me turn to China. I'm really worried about China, and right now people may not know it, but China is the world's largest economy in terms of purchasing power. Now, at our last meeting, I talked about this move where we didn't blow the balloon up. And this is an example of what I was pointing out.
Gentleman's time's expired. We'll now recognize the Chair of the Science Committee, Mr. Lucas of Oklahoma, for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, I'd like to follow up on the topic of capital standards. One of those things we've discussed many times together. As you know, commodity markets have seen significant volatility in the last few years. And during times of tremendous economic uncertainty, like we've seen, end users turn to the markets to hedge risk, particularly those in the agriculture and energy sectors. And I know that the Fed is early in the review process of potential changes in capital requirements. Can you, well, I'll ask anyway. Can you commit to ensuring that these changes will not increase the cost for banks providing those commodity derivatives to end users?
That's a really specific, can I go look at that? I mean, I'm not actually sure that the work even addresses that. So
Fair
I'm happy
point.
to come back to you on that.
And that particular response makes me feel better, because after all, those products are very important to my folks and make a great deal of difference in how they're able to address their issues. So, as you discussed earlier, and as you've consistently assured, the Fed's not a climate-making policymaker. You and I have talked about this issue, again, many times in the past. However, I'm concerned that the Fed could be heading in that direction and could be laying the groundwork for climate-related stress tests that would reduce access to capital for entire sectors of the economy. This would also open up the Federal Reserve potentially to political pressure and force the Fed, in fact, to make policy decisions related to climate change. We've seen, for example, this administration turn to regulators to impose climate policy as an alternative to the legislative process. Chairman Powell, how careful are you in ensuring that the Fed does not place itself into the climate debate? And how can Congress ensure that the Fed's regulatory toolkit is not, shall we say, warped into creating climate policy outcomes?
So I think we do have a narrow but real role there, which is around bank supervision, making sure the banks understand and can manage their risks over time from climate. I think my colleagues and I all understand that it's a tightly circumscribed role that we're playing, and that we're not looking to move into an area where we're actually becoming a climate policymaker. I would completely agree with you, though, that over time that border needs to be very carefully guarded, and I will tell you that I will do that as long as I'm at the Board of Governors.
I very much appreciate that, because again, it's a very important issue to the 3rd District of Oklahoma. Traditional production agriculture, oil and gas, and the actions that the Fed takes have a significant impact back home. So it's vital that we resist the demands to do that sort of thing now or in the future. And I very much appreciate that response. And with that, I'll yield back the balance of my time, Mr. Chairman.
Gentleman yields back. The gentleman from Massachusetts, the ranking member of the Digital Asset Subcommittee, Mr. Lynch, is recognized for 5 minutes.
Thank you, Mr. Chairman. And thank you, Mr. Chairman, and for your willingness to come here and to update us. Last week, the Treasury Department announced that leaders from Treasury would begin to meet regularly with leaders from the Fed and from the White House to discuss a possible CBDC, central bank digital currency, and other payment innovations. In the statement, it was mentioned, and I'll quote from it, it said that the Fed is encouraged to provide periodic public updates as it continues its research and its technical experimentation on central bank digital currencies. I was wondering, first of all, when you might be expecting to share some of these public updates? What's the timing on that?
So we did go out for comment in general on a CBDC a year or so ago, and I do expect we'll go out. I can't give you a date, but we'll certainly go out and engage. We engage with the public on an ongoing basis.
Yeah.
We're also doing research on policy and also on technology. That's what we're up to.
I'm aware of the Boston Fed has a partnership there. The Hamilton project over there with the folks from MIT Media Lab, they're doing a great job. But it says here that the discussions would include technical experimentation. I was just wondering, at what level are you talking about making decisions on architecture for a CBDC, a retail CBDC?
We're not at the stage of making any real decisions. What we're doing is experimenting in kind of early stage experimentation. How would this work? Does it work? What's the best technology? What's the most efficient? We're really at an early stage but we're making progress on sort of technological issues. The policy issues are equally important, though. We haven't decided that this is something that the financial system in the country want or need.
Right.
So that's going to be very important.
Right. Well, I think I speak for the chairman as well. Would love to have more dialogue with the Fed on that, and maybe bring in the folks from MIT as well, and just make sure that Congress and this committee is as up to date as others. Let me switch over to Fed now. There are some champions of digital currency and stable coins in particular that continue to cite the need for faster payment systems. However, as was earlier mentioned, the Fed Now is a service that the Fed is working on to finalize that will allow for instant payments between bank accounts. And the Fed has a target release date for Fed Now between May and July, which is right around the corner. Do you see any reason why cryptocurrencies would provide faster payments than the Fed Now system? And would this offer, with the transparency of Fed Now, would it offer distinct advantages over some of these stable coins that are touting faster payments?
What Fed Now will do is it will enable all the banks, any bank in the United States, not just the big ones, to offer instantly available funds and real-time payments to their customers. That's what it will do. So that's a great thing. A CBDC, I think you're asking whether a CBDC would serve some of that, but a CBDC is going to be years in the evaluation. And, I think we can get this into the hands of the public very quickly. And I think we'll have real-time payments in this country very, very soon. And so that's a good thing.
It is. I do have an overriding question, and that is, before the greenback, everybody had their own currency. You had rail companies, you had coal companies, you had, state banks that were authorized to issue their own currency. But when the greenback came out, all of those various currencies went to zero because everyone had, because the greenback had the full faith and credit of the United States behind it. I'm worried about a lot of these stable coins and other cryptocurrencies. Do they go to zero when we come up with a CBDC that has the full faith and credit of the United States behind it? And we've got thousands of these out there, and you've got people investing millions and millions of dollars in these, well, trillions right now. And I'm just thinking, if we had those advantages built into a CBDC, wouldn't those alternatives go to zero if they did not have the transparency and the full faith and credit that we enjoy?
So certainly unbacked cryptocurrencies that don't have any intrinsic value, but nonetheless trade for a positive number, those have never understood the valuation of those. Stable coins are actually, many of them are really, they're drawing on the credibility of the dollar. They have dollar-based, they're dollar denominated mainly, and they have dollar-based reserves, although we don't know what's in the reserves because there's no regulation.
Gentleman's time has expired. The gentleman from Missouri, Mr. Lukemeyer, is recognized for 5 minutes. The chair of the National Security Subcommittee.
Thank you, Mr. Chairman. And thank you, Chairman Powell, for being here this morning. The reserve currency status of the dollar to the U.S. has enormous financial and national security benefits. In the wake of Russia's unprovoked invasion of Ukraine, the Fed took action to prevent the Kremlin from accessing more than $300 billion in reserves, roughly half of Russia's reserves. However, this led to an accelerated effort by countries like China to de-dollarize their official foreign exchange reserves. Just last week, there was an article in the Wall Street Journal titled, "Russia Turns to the Yuan in an Effort to Ditch the Dollar." Not only that, but China's President Xi Jinping pushed for the settlement of energy trades in the Chinese yuan at a summit with Arab leaders in December. The question is, are you concerned about these actions by Russia and China to establish different reserves and conduct transactions in non-U.S. dollars?
So the U.S. dollar is the widely accepted and really the only serious candidate for the world's principal reserve currency, and that's because of our democratic institutions, our liquid markets, the rule of law, and all those kinds of things, and also the fact that the dollar has held its value over time. So other countries who are competing on other playing fields may want to establish different currencies, but really the dollar is the one that's going to be used more broadly in international commerce because we have those aspects and other countries don't.
Well, that's true to now, but my question is, are you concerned about the actions of these countries? Because if they see themselves being challenged or concerned, for instance, if China would invade Taiwan, as Russia invaded Ukraine, there were some sanctions put on. And I don't disagree with the sanctions. The last time you were here, though, Mr. Chairman, I asked a question because it's an instructive moment for us from the standpoint that knowing that we put sanctions on Russia, all other different accounts, as well as the oligarchs from that country, are we thinking about doing the same thing to China when they invade Taiwan? And your answer at that point was no. We passed a bill out of this committee last week to ask the administration, basically, to start thinking about that in those terms. What kind of situations can you come up with? Are you talking to allies, begin to talk to them to start putting together a list of how you would go about sanctioning the different individuals, the different accounts, things like that? So have you started thinking about that at all yet?
Well, let me say, the business of sanctions is entirely in the hands of the elected government and the Treasury Department. We are an implementer as it relates to banks. That's it.
Yeah, but we're going to take your advice on different aspects of this, Mr. Chairman.
Sorry?
We're going to take your advice on the different aspects of this.
Well, I mean, honestly, when the sanctions were being put in place, Treasury was doing it. We weren't doing it.
Okay.
Yeah, I mean, that's the way it works.
Next question. There was an article again in one of the political newspapers yesterday, I guess it was, and it talked about the problem that we have here with the Fed's balance sheet. It says it now appears similar to a hedge fund whose long-term assets are financed by short-term borrowing, and the bottom line is that it's going to cost money. The Fed now has a negative income as a result of having to do this. And so it says here that the Fed will simply borrow the money to pay the bills. Is this true? That the Fed's losing money right now as a result of the way you've got these debt borrowings that you've purchased structured?
The place I would start is that the Fed has, we always turn over all of our earnings in every year. We turn them over on an ongoing basis, and we've turned over something like $1.2 trillion in earnings just in the last, decade or so. So we always know that when we raise interest rates,
Okay.
you're going to lose money.
Okay,
of course,
but you agree with the point that we have a negative income right now.
That's
and
right.
This makes my point to my next question, or my concern is, the CFPB gets their money the CFPB gets their money to run their agency from the Fed.
That's right.
So basically, there's no money for the Fed to pay the CFPB's bills if this is the case, unless you continue to borrow, which is basically what's going to happen now. Is you're going to have to borrow money to be able to pay the CFPB's bills. Is that not correct?
No, we don't borrow money. We issue, basically, yes, we don't shut down the Fed when we have negative income.
Okay.
We can pay our bills and we can pay.
So my follow-up question then is, do you do any accountability or assessing of the CFPB's spending of these dollars at all?
No, we don't.
So they just get a blank check. You just told me they just got a blank check. They send you a bill, you send them a check. There's no accountability for them.
No, I think there are limits built into the law, which I don't have in the front of my head.
I have yet to see a limit, Mr. Chairman. I'd love to see what the limits are because I don't think that they've ever agreed that they have that. But I see my time is up. Mr. Chairman, I yield back.
Gentleman's time has expired. We'll now go to Mr. Foster, the Ranking member of the Financial Institutions Monetary Policy Subcommittee.
Thank you. And just a quick comment. I think it's a mistake to imagine that you can completely hide from the macroeconomic effects of technology in your scenario planning. You know, we just talked briefly about healthcare costs, you know, obesity, half of our healthcare costs, and there are treatments in these GLP-1 receptor agonists that look like they're just a home run against obesity. And so these will be near-term impacts, which will have macroeconomic effects. So just a comment. I hope you have a certain fraction of futurists in the room when you're talking about your scenario planning, because a lot of that future is like now. Okay, back to economics. So we have this historically low unemployment rate, 3.4%. And historically, this would be considered to drive runaway inflation. You know, your predecessor, Alan Greenspan, repeatedly referred to dangerously low levels of unemployment. And yet we see inflation is coming down. So what is going on here? How can we have these historically low levels of unemployment without having inflation take off? Is it possible that we simply have less frictional unemployment in our system due perhaps to the fact that people get their new jobs online and have a job lined up before they quit?
So inflation is coming down, but it's very high is the thing. And some part, I've never said all of it or most of it, but some part of the high inflation that we're experiencing is very likely related to an extremely tight labor market. Wages affect prices and prices affect wages. So I do think that's part of it. More to your point though, there was a time when there was a tight relationship between inflation and unemployment. In other words, the Phillips curve was steep, and that went away over the period of the great moderation. And really, in our thinking, that's because people came to expect 2% inflation, and we had 2% inflation, and then people just stopped focusing on inflation, and it stayed very low. So there was really no relationship, or very, very tiny relationship. We could have very weak economic growth or very strong economic growth, and we wouldn't have inflation respond very much. That was before the pandemic, though.
Okay, well, I hope you don't overlearn, some of the lessons there. It's one of my worries that there've been a number of exogenous shocks to the system here, and it'll take a while to go through them. And if you want to be careful there. Now, in a related issue, when you say refer to the totality of factors, you're looking at a mixture of leading and lagging indicators when you look in this totality of factors. And my question, if perhaps you might be paying too much attention to the lagging indicators and not enough to the leading indicators. The example that's referenced in your remarks and is in more detail in the report about the difference between using current rental payments versus the amount that you pay for a new rental contract, and difference in how much they lag. Had you paid more attention, for example, to the leading indicators like current rental contracts, then you probably would have picked up inflation earlier. You would have been, not gotten so far behind the curve on that. And secondly, there are policy implications going forward. If you look at current rental prices for new contracts, we're much farther along in fixing inflation, and that you can take your foot off the brake. And so what's your thinking on that, and whether you may perhaps be systematically not paying enough attention to leading indicators versus lagging ones?
So we've had our eyes on the whole housing inflation thing from the very beginning, and right now what I would say is that every forecaster is baking in lower rent increases. That's a big part of why people think inflation is going to come down in 2023. I think the thing with transitory was more had to do with goods. And it had to do with the thought that these supply side disruptions would go away much quicker than they would, that the labor market disruptions would go away much quicker than they did. And in hindsight, it just took much longer for those disturbances to go away.
Yeah. So with hindsight, and if you allow yourself to Monday morning quarterback yourself, you probably would have gone up to 4% earlier, and not had such a big problem with inflation. And so what is your are there structural things you can contemplate, or even after action reviews to say what would have happened if we would have paid more attention to the leading indicators, or improve the improve the bandwidth of your feedback regulator? that, this is something, if you want to get the best result, you need a high bandwidth feedback in the system, even when there's averaging on the back end.
So this is something we only think about during waking and sleeping hours, as you can imagine. It's really hard to know what the lessons are. Again, we really thought things would. Nobody had seen the supply chains collapse. No one had seen labor force participation plummet. We didn't know, or unemployment go to 14% and higher than that, really. We didn't know how long it would take to go away. And if we ever see this pitch again, we'll know how to swing at it. But it's been
We'll now recognize the
pretty bunch of firsts. Sorry.
gentleman's time has expired. The gentleman, his time has expired. We'll now go to the gentlewoman from Missouri, the chair of the Capital Markets Subcommittee, Ms. Wagner, for 5 minutes.
I thank you, Chairman McHenry, and Chair Powell. Welcome. Thank you for your service and for being here today. Yesterday, I was pleased to hear you discuss how inflation is severely hurting the working people in America. In your testimony, you also state that strong wage growth is good for workers, but only if it is not eroded by inflation. And that is key. Inflation is a tax, a hidden tax on every American. If the Federal Reserve were to shirk its mandates to stabilize prices, leaving inflation alarmingly high, what would it cost America's hardworking families in Missouri's 2nd Congressional District and beyond?
So I think the costs of failure to restore price stability would be extremely high. And while there will be costs to success, the costs of failure will be much higher. You'd be looking at an extended period where people learn to expect and live with high and volatile inflation. And it's very, very hard to have rising real incomes during such a period. So it'd be a bad thing for the country.
Can you reassure the committee that the Fed remains committed to bringing prices down for our constituents?
Yes, I do.
Thank you.
I hereby assure you.
And changing topics here a bit, as China's economy reopens and about 18% of the world's population resumes its consumption of oil and other key goods, what sort of inflationary impact will we see here in the United States, sir?
So a faster reopening of China, which it looks like we may be seeing, it does have the potential to put upward pressure on commodity prices, but it also would mean a faster sort of unraveling of the problems in supply chain. So those would be offsetting effects. I think sitting here today, we don't expect the net effect to be big for the United States. It might be bigger for other parts of the world, but we think it ought to be moderate overall.
China is one of the world's top oil importers. And do you expect any inflationary effects on global energy markets as China's oil consumption returns to their previous levels?
So I think oil prices could be affected. And I think that's a big concern in Europe, for example. We have our own domestic oil, and we've got a lot of natural gas as well.
We sure do. I wish we were actually harvesting more of that liquid natural gas. Chair Powell, you, Vice Chair Barr, and many others have recently identified that the banking system is well capitalized and strong. Bank capitalization remained robust during the shock of the pandemic and related shutdowns of economic activity. Capitalization of large financial institutions weathered severe stress testing mandated by the Fed. And despite all of that, as also previously mentioned by Chairman McHenry, Vice Chair Barr insists on conducting a review of capital rules. I'm concerned that this review is being conducted in a silo and that the findings will not be made fully available to the public. Taking such an approach in the context of this holistic capital requirement review would make it impossible to conduct a transparent rulemaking process, denying the public information necessary to consider and to comment. I think this is just simply not appropriate in this situation. And I'm concerned by the lack of of clarity, I think is the best word perhaps at this point, by the vice chair. A couple questions. You've served on the Fed board for over 10 years since the financial crisis regulatory framework has been put in place. And over that period, have you seen any real world evidence that America's banks are undercapitalized?
So American banks are strongly capitalized, and I believe Vice Chair Barr has said that as well. But
Yes.
the point is, there haven't been any real proposals to evaluate yet. And when there are, that will be done in a highly transparent manner.
I hope so. I'm glad to hear you say in a highly transparent manner. Do you agree that excessively high capital levels constrain banks' lending capacity with spillover effects on jobs and living standards for Americans?
So I think it's always a balance, right? More capital means more safety and soundness and more ability to withstand terribly stressful periods. But it also, it's more expensive. Equity capital is more expensive. U.S. banks have competed incredibly well around the world.
Yes,
with
they have,
high levels of
internationally.
capital. But so that's a trade-off that you're always going to be making when you think about capital.
Gentlewoman's
My
time
time
has
has
expired.
expired. Yes, thank
We'll
you.
now
Madam
recognize the gentlewoman from Ohio, the ranking member of the National Security Subcommittee, Ms. Beatty. Ms. Beatty, for 5 minutes.
Thank you, Mr. Chair, and I like that title. To Chairman Powell, thank you for coming and being such a good colleague and friend. I have a couple questions I'm going to try to get through quickly. Chair Powell, in a press conference last month, you stated, quote, "There is a lot of spending coming into the construction pipeline, both private and public. And so that's going to support economic activity," end of quote. How do you think the strong pipeline of funding from what the Democrats put together in passing the Inflation Reduction Act, the Infrastructure Investment Jobs Act, and the CHIPS Science Act will do to have economic activity this year and moving forward?
So I guess I was making the point that there are a lot of sources of demand that we can rely on, even though demand has been relatively increasing at a relatively modest rate. Part of it is
Will
just
this
state and
help in
local-
that demand?
Yes, I mean there is state and local governments I mentioned are about.
So would you say this is a great thing that we've done coming from the left over
not
here?
not for me to judge the merits of what gets done, but I'm just saying there's
But it will
there's demand
contribute
there that will support economic
and support
activity.
it.
Yeah.
So I'm going to assume from that that's a positive. Let me go to the second question. Chairman Powell, the Federal Open Markets Committee is projecting that unemployment will increase to 4.6% by the end of the year. And those costs, as we know, won't be borne equally. If we look at the ratio from the last time unemployment was 4.6% and compare it to our numbers now, it would mean that white unemployment would go up to about 0.9, but Black unemployment would go up by 2.3%. Does that sound somewhat accurate to you?
Yes.
Can you address the disparity impact with that? And before you answer, let me go to the book and thank you that was put at our places together. You made in this book with your signature on it is stated, however, while disparities in unemployment have largely returned to pre-pandemic levels, there still remain significant disparities in absolute levels of employment across groups like African Americans and Hispanics. So can you address that?
I can. So right now, to your point, actually, African American unemployment is, I think, 5.4%, which is just about as low as it's been since we started tracking it in 1972.
But differential from majority
I'm
by,
going to say so that's 5.4, whereas the overall is 3.4, and that includes Blacks. So that means for whites is well lower than that. What happens is, so there's a persistent gap between Black and white unemployment, and also when unemployment goes up quickly in a recession, it goes up much faster for African Americans. When the economy grows again, it comes down faster. So that's just that's somehow embedded in our economy. We don't really have the best thing we can do is achieve stable prices so that we can have long expansions. And what happens in those long expansions is that the labor market gets tight, sustainably tight, And we have historic lows in unemployment, including for African Americans.
Let me say thank you. And let me also, again, thank you. As you know, in the 117th, I was the chair of the D&I committee. And let the record state that you always pushed for making sure that you understood and respected that. And in that, this is very minor and certainly personal to me. In this report, maybe those who helped you author it, I would like to see the areas that talks about unemployment not under a title of special topics, but something that draws a little more attention to it as some of the others, just very minor. Last question I have. Can you tell me if the Feds is committed to working with the other agencies like the FDIC and the OCC to finalize a rule soon on CRA? Certainly that's something of great interest to many of my colleagues. So can you give us any updates on it or how the process is going or what we can expect?
Yes. So with Governor Brainerd's departure for the White House, I've asked Vice Chair Barr to take the lead in moving it forward. I would characterize it that there's essentially agreement between the three banking agencies on the changes to be made. That's all being written up and vetted, and at a certain point, members of the Board of Governors will be briefed on it. We'll vote on it.
Is there anything we can do to help with that?
No, I think we're hard at work on it, and it's going to take some months, but I think we're nearing we can see the airport, and we'll be landing in a few
Gentlewoman's
months.
time has expired. The
Thank you.
gentleman
You're
from
back.
Kentucky, the Chair of the Financial Institutions and Monetary Policy Subcommittee, Mr. Barr, is recognized for 5 minutes.
Thank you, Chairman McHenry and Chairman Powell. Economic data are mixed, as you know. On the one hand, low unemployment, robust hiring, strong consumer spending, and persistent core inflation, and a CPI that's still more than 3 times your 2% target suggests more aggressive tightening is warranted. On the other hand, because the Fed misjudged the inflationary impact of Democrats' overspending, kept interest rates too low for far too long, and failed to end quantitative easing soon enough, the Fed has been forced to raise the Fed funds rate 450 basis points in just 11 months and reduce the M2 money supply at the fastest rate since the 1930s. As a result, wage gains have slowed, credit card debt is at an all-time high, the housing market is in a slump, and the yield curve is inverted. I agree with you that the historical record cautions strongly against prematurely loosening policy. But what would you say to those who caution about the lag effects of monetary policy, the precipitous decline in liquidity? Will the economy have to suffer a recession in order to bring inflation down to 2%?
We are very well aware of the lags with which monetary policy affects economic activity and inflation. Those are long and variable, and I would stress highly uncertain. There is really no agreement on exactly how long they are, but we know that slowing down the pace of rate hikes this year is a way for us to see more of those effects as they come in.
In December, most Fed officials expected to lift rates this year to between 5 and 5.5%. Is that still your estimated terminal rate, or does the data suggest that the terminal rate could be higher than 5.5%?
My colleagues and I will write down new forecasts and release them to the public on March 22. But as I mentioned in my testimony, the data we've seen so far this year suggests that the ultimate level of rates will need to be higher. But we still have some more data to come in between now and the meeting. But as of today, it suggests a higher level than that.
Let's go to Vice Chairman Barr's review of the capital framework. A lot of questions for you on that. When Governors Brainerd, Quarles, Clarida, Bowman, and Waller made up the board under your leadership, major changes in policy were addressed following board consensus and not when there was significant dissent. Will you commit to not implementing a new capital framework following this holistic review or the Basel Endgame if there is considerable dissent from the board?
I can't really commit to that. We are a consensus kind of an organization, and that's what we'll work toward. But ultimately, we
Would that be a break from your prior practices? You're a consensus builder, Mr. Chairman. You pride yourself in that, and we credit you for being a consensus-oriented chairman. Will you commit to continuing that practice and not allow major changes to the bank capital regulatory framework to be made by one person?
Well, they can't be made by any one person, but I do commit to that. And I commit to doing everything I possibly can to bring people together in consensus, to have something that can be broadly supported.
Thank you. Earlier this year, you said, and I quote, "We are not and will not be a climate policy maker." However, in the Fed's draft principles on climate-related financial risks, one proposed principle suggested that boards of directors or of a financial institution should consider making changes to its compensation policies to align with values in the context of supposed climate risks. It appears then that the Federal Reserve, through regulation, wants to begin implementing climate policies. So which is it? There seems to be a disconnect between your statements publicly and the rules that the board is putting forward for comment.
Well, I feel strongly that climate change is an important issue that needs to be addressed by elected people. It's just not something that we've been charged with by Congress, clearly. So we do have a narrow role, and that role will be around making sure that banks understand and can manage the risks that they're running, and that's going to be it. And I, as I said before, we don't want to drift into becoming a climate policymaker, and we'll have to guard that border very carefully.
Regarding the Fed's climate scenario analysis pilot program, did the board vote to approve the creation of that pilot program?
I have to check, but I don't think so. I think it was already authorized.
And this is a concern that I have. I'm concerned that one governor acting unilaterally to implement major policy changes without board consensus is a problem. And so I would urge you and your colleagues on the board to continue a consensus-oriented approach, and I yield.
Gentleman's time has expired. We'll now go to the ranking member of the House Intelligence Committee, Mr. Himes of Connecticut, for 5 minutes.
Thank you, Mr. Chairman, and welcome, Chairman Powell. Thank you for your careful conduct of monetary policy, independent of the many political desires that circulate in this building. Independent monetary policy is a bedrock of a solid economy. I want to reflect for a moment on another bedrock of the American economy, the full faith and credit of the United States government, which is now being put at risk by the Republican majority. My Republican friends know how very dangerous a game they are playing. They know that salary payments to our soldiers are at risk. They know that their irresponsibility will raise mortgage rates for new home buyers. But they say this is the only time we focus on spending in the debt, which of course is baloney. It's a pernicious form of baloney. The time to focus on the deficit is when you are voting for the spending and the tax cuts that create the deficit. When you're voting for the Trump tax cuts, which the CBO said would add $2 trillion to the national debt, that's the moment to consider whether you want to do that. Not when the good name of the United States is hanging in the balance. This stuff gets a little complicated, but the American people really need to understand what's happening here. The Congress sits down to a huge 10-course meal of tax cuts and spending and more defense spending and expansion of this program and stimulus, all of which we vote for collectively. First course, second course, white wine, red wine, 4 servings of dessert. And then the bill comes and my Republicans say, whoa, wait a minute, hold on, look at this bill. This is irresponsible. Do we really want to pay this bill? That's not the moment for the consideration. The moment is when you're ordering 4 helpings of dessert. That's when we should be talking about it and taking responsibility for the choices that we make without putting the full faith and credit of the United States at risk. Now here's where the hypocrisy comes in. My Republican friends like to point the finger at this side of the aisle and blame us. The Chairman, as you know, fully 1/4, 25% of today's United States debt was accrued in the 4 years of the Trump administration. This country's been around for 246 years, and fully 1/4 of the United States debt was accrued under President Trump. By the way, speaking of hypocrisy, in the 4 years of President Trump, the debt ceiling was raised or suspended 3 times. I didn't even notice. But now, of course, we have a different president, and so the calculus is different. Now, Mr. Chairman, I don't think I'm going to persuade the majority to act responsibly here. I actually think the markets will persuade them. And you'll recall, because we were watching this closely, September 29th, 2008, the Republican House of Representatives voted down the Great Recession Rescue Package. As the vote was going down in the House of Representatives, the equity market dropped 7%. $1.2 trillion lost in people's retirement accounts. Now, Congress sobered up, and a couple days later, we passed the Rescue Act. So, Mr. Chairman, there is a question here, and the question is this. You and I both watch the markets pretty closely. Treasury tells us that on June 5th, that's just 3 months away, on June 5th, the Treasury runs out of money. So my question to you, Mr. Chairman, I know I'm asking you to be a little speculative here, but what should we watch for? What market signals could indicate that the markets are getting fed up with the manifest irresponsibility around this? Give us some things that we should be looking for.
And I'd love to, but I'm going to limit myself to what other Fed chairs have said about the debt ceiling, which is that it does need to be raised by Congress. In the end, there are no rabbits in hats, as I mentioned, and also that no one should assume that we, the Fed, this is the Fed's business, is to protect the economy from various events. And you know, I wouldn't assume, no one should assume that we have the tools to protect the highly uncertain effects of that kind of an event.
So monetary policy is obviously very concerned with interest rates. If global capital markets begin to decide that we're really serious about hurting ourselves this time, is it possible that we could see interest rates rise more because borrowers of United States debt decide that we're actually a little risky? Is that possible?
I think that and many other things are possible. The thing is, we've never crossed that line, and if we cross that line, we're going to find out. And I think it's highly uncertain.
Okay, so that's possible. And you know, I don't like pressing you on these things, but you said this and many other things are possible. You want to elaborate on what might be in the category of many other things?
Rather not, actually.
Okay. I figured. All right. Thank you, Mr. Powell. Again, I really thank you for your really responsible conduct of monetary policy. And there's a reason that you are insulated from our political desires, and I very much appreciate that, and yield back.
Gentleman yields back. We'll now recognize the chair of the Small Business Committee, Mr. Roger Williams of Texas.
Thank you, Mr. Chairman. And Chairman, it's good to see you. Always good to have you here. In past congressional testimonies, you've repeatedly stated that you support protecting the state-based system of insurance regulation, which is the most effective and competitive in the world. In my home state of Texas, is the world's 7th largest insurance market, proving the success of this system. Now at the International Association for Insurance Supervisors Conference in November, there is the opportunity to have the U.S. state-based aggregation method become formally recognized as comparable or equivalent to the insurance capital standard. We should not be following the European model that has increased regulations and less competition, and we should prioritize a model that encourages deregulation, competition, and less government involvement in pricing. So my question is, Chairman, can you highlight the benefits of the U.S. state-based aggregation method compared to the European model regarding market resiliency and systematic risk? And can you confirm that you will push for aggregation method to be deemed equivalent by the IAIS?
I can say this. I do think that our insurance regulatory system has proved itself appropriate and adequate and gotten the job done for a long time, and we don't need to be copying other countries or other regions' insurance regulatory system. I'm a little rusty on the details of the capital requirements, but that sounds right.
But our bottom line is our side works, the other doesn't. We need to stay where we are.
Our side works.
Yeah, thank you. Also, in the past, you stated that banks were well capitalized. We've talked about that today, but now there have been increased conversations about raising capital requirements. Numerous economic studies have found that raising capital requirements for banks will increase borrowing costs for their consumer and commercial customers. And I'm somebody that's owned 50 years. I've never had a day I wasn't out of debt, so I'm concerned about this. And implementing additional regulatory capital requirements will slow economic growth and limit financial institutions' lending ability. So do you believe that raising capital requirements would raise the cost of borrowing and add cost to our economy in Main Street America?
Well, it depends on which banks experience higher capital requirements, and there isn't any proposal to evaluate right now, of course, but it's always a trade-off. You know, higher capital is good in a sense because it keeps banks able to lend during bad times. That's really a good thing. Too much capital, though, probably limits credit availability. So we're trying to strike that balance always.
And this has been touched on a little today, but let me come from a different angle on it. But the Reserve was created to act as a nonpartisan entity that remains separate from party politics. Talked about that. And unfortunately, throughout recent years, the Fed has gotten caught up in politically charged issues like economic inequality, gender and race discrimination, and climate change. Recently, the Federal Reserve Board proposed guidance on managing climate-related risks for large banks, further proving that the Fed is giving in to some political pressure and operating outside its intended purpose and responsibilities. So our country's financial leaders, in my mind, should be focusing on addressing runaway inflation instead of worrying about the financial institutions are doing to monitor climate change. So, and we touched on this a little bit, but how can the Fed ensure that they're not placing undue regulations and guidance on banks by forcing involvement in partisan green politics? And how's the Federal Reserve ensuring they remain separate from political influence?
I think it's absolutely critical that we do. I mean, our independence is partly founded on the idea that we will stay out of stuff that you have not assigned us to do. And if we're going to wander all over and take on the hot issue of the day, our case for our independence is dramatically weakened. On climate change, I think we do, you mentioned the guidance, and then there are also the stress scenarios. And those are the two things that we've done. We tried to keep those tightly focused on the banks, understanding and being able to manage the risks that they'll run over the longer time periods on climate, and not slide into a broader sort of policy making role on climate change. And I accept that could be a slippery slope and a moving border. And I just want to say, and I think my colleagues feel the same way on the board, that we're going to guard that border carefully, and we're going to stick to our role and not try to be policymakers the way in many other countries the central bank is out there in the lead with the support of the public doing climate policy. But that's not where we are in the United States, and we're not going to pretend that it is.
I've got some time left. I'll yield back, but I just want to say, as an auto dealer, I'm looking for the first day of that rate cut. So, thank you for being here. We appreciate it.
Gentleman's time has expired. We'll now go to the gentleman from California, Mr. Vargas, for 5 minutes.
Thank you very much, Mr. Chairman. And again, thank you for holding this hearing. Chairman Powell, a pleasure to see you again. I've said it before and I'll say it again. It's always great to see you, because I always think of the old Republicans, the ones who are very noble, did the right thing, didn't play chicken with the economy, very forthright. And so anyway, I appreciate you being here very much. Like some of my colleagues on the other side, I'd say the same thing about some of them. And I appreciate you. So we heard today that the inflation is Biden's fault. So what is the inflation rate in the European Union today?
It's high.
It's high. Is it 10% possibly?
I think if you're talking about headline, I don't have this figure in my head, but it's very, very high from a headline standpoint. And they've had core inflation move up too.
Yeah. So are they following Biden's then policies? Is that what caused the inflation? Because it seems to be Biden's fault.
So I think inflation is everywhere, and it must have to do with a common factor, and that common factor has to be the reopening of the economy and the things that were done on COVID. On the other hand, each country has a little bit different case, and I think you have to be careful. We had much more of a demand-oriented issue than they did. Now they have their inflation looks a lot like ours did a year ago.
Right. Yeah, I just had to bring it up because, again, Mr. Sherman brought it up, but it's interesting every time I hear inflation is caused by Biden, I wonder why is it all over the world? I mean, it's not because of the pandemic, of course, or, Europe's at war. I mean, that wouldn't cause it, of course. It'd have to be Biden's policies. That's ridiculous. And I think the voters saw through it last time. So I haven't been here 15 years as my good friend, Mr. Foster. I've only been here 11. But when I first got here, the boogeyman, and I heard it all from my friends on the other side, was Dodd-Frank. Dodd-Frank was going to be the end of banking. And in fact, some of my colleagues would almost scream how horrible this was. And then we got the bankers up here during a real stress test, which was the pandemic. And we asked them, has it been helpful to have Dodd-Frank? You know what they said? Do you know what they said?
I don't.
Oh, they said it was helpful. In fact, it kept the banks capitalized. It was fascinating. Now, to be fair to them, they did complain about some of the smaller issues, but not Dodd-Frank in general, the bill. Then it seemed that CFPB, that became the next boogeyman. But they're starting to seem to fade on that. And I think the reason for that is the CFPB has actually helped so many people that now a lot of their own constituents now are getting helped by the CFPB. So all of a sudden, there's not quite the energy. So now they're attacking ESG. ESG. And they're saying that you and everybody else is somehow conspiring to make sure they don't buy their oil or their coal. Are you conspiring to do that? Are you conspiring?
I don't believe we're conspiring.
No. Now, I heard it was supposed climate risk. Is there risk in the climate change?
Yes,
There is? Could it affect the bank?
certainly in the longer run, yes.
Yeah, of course it can. Do you think insurance companies take this into account?
Yes, actually, I believe they do.
They absolutely
Certainly
do.
who write long duration liabilities, they certainly do.
Of course they do. I mean, they're very concerned with it. Weather is a big deal. I was a vice president of Liberty Mutual in their corporate legal department, and I can tell you weather and the changing of the weather, we used to have what we call catastrophes. And these catastrophes happen every 25, 50, 100 years. Now those 25, 50, and 100-year events happen every 5 years, every 2 years. So of course it is. I mean, it's ridiculous not to take a look at these ESG factors. We have to. And again, I'm glad that you guys are taking a look at it because it's real. I'm glad that, you know, the president's taking a look at it. And it's sad that my colleagues on the other side just want to stick their head in the sand and say, no, climate change is supposed climate change. No, the reality is it's real climate change, and it's costing billions and billions of dollars. And if you don't believe it, go ask all those poor people in Florida that had those huge hurricanes come through and wipe them out. So again, I appreciate very much the work that you've done. The only thing I hope is, as you said, if we ever see this pitch again, we'll know how to swing at it. And I hope we don't get the pitch of defaulting, because I'm not sure we'll know how to swing at that one. So thank you again, Mr. Chairman. Thank you for being.
Thank you.
I yield back.
Gentleman's time, gentleman yields back. Gentleman's time has expired. We'll now go to the Chair of the Oversight Subcommittee, the gentleman from Michigan, Mr. Huizinga, for 5 minutes.
Thank you, Mr. Chairman. I'm going to move quickly, and good to see you again, Chair. You know, I caught a little bit of the Senate hearings yesterday, and you had a lot of pressure to keep the sugar high going. And frankly, if the Fed and many of our colleagues had listened to what many of us were saying, we should have been weaned off that artificially low, cheap money that kept the party going. And frankly, we wouldn't be in this position. To reference Chair Greenspan's punch bowl analogy, not only did no one have the courage to remove the punch bowl, you had people cheering on the pouring of another bottle of 151 rum into the punch bowl. And here you got folks wanting to do the exact same thing. Let's spend more. It's just, and now here we are. You have an impossible decision to slow the economy or let everyone get crushed by inflation. And we know tightening means a slower economy. Slower economy means fewer jobs. Fewer jobs hit those who can least afford to lose a job. And so in short, the lower rungs of the economic ladder will suffer more than the rest of the ladder. So that's the state. That's the state of play of where we're at. I have to hit a couple of quick issues here. I wanted to start off by discussing climate, especially given the Fed's announcement in January that it was going to conduct a pilot climate scenario analysis exercise. The Fed, along with the OCC and FDIC, have each issued proposed climate risk management principles for banks that you are attempting to finalize those by the end of the year. And the requirements don't stop at the border. The UK and the EU central banks are moving to require significant ESG disclosure regimes as well. I know the Fed is taking a look at commodities capital charges in the holistic review, but even though the Fed isn't forcing banks to encompass climate analysis in their stress tests, there are many initiatives at the Fed that are going to make it more costly for banks to finance traditional fossil fuel companies. So I want to ask you a very specific question. Will you commit that you will withhold support for a new capital rule that increases capital charges on bank activities in traditional energy companies?
You know, I can't sit here and promise what I will and will not vote for, because I don't know what's going to be in the proposal, but that's not the kind of thing I think we're looking at.
I'm sorry, it's not the kind of thing.
So this isn't about, this is about overall capital levels more than anything else, I think, rather than the specific thing you're talking about.
Okay. We're going to follow up on that because we need to have a real-time conversation about what that is going on there. I want to quickly switch topics and go in a different direction for this next question. I want to ask you about two opinions issued by your legal staff in November of 2019 and December of 2020 to the asset managers Vanguard and BlackRock. Mr. Chairman McHenry, I'd like to submit the two letters for the record.
Without objection.
Thank you. These opinions appear to outline the parameters of both how both Vanguard and BlackRock can operate without being deemed a bank holding company. In addition to the legal restrictions outlined by the bank holding company, these opinions listed out here in quite detail list out commitments that the companies would need to take to avoid being viewed as having, quote, control. These opinions also appear to provide assurances that the Federal Reserve Board staff would not recommend that the board find the asset managers to be bank holding companies. Further, it is unclear whether the board will take any steps beyond a periodic self-certification by the asset managers to monitor compliance with the condition that they, quote, not take any action to control a banking organization. As some asset managers play a larger role and clearly strive to influence policy in companies across the free market, we need to remain vigilant. So, Chair Powell, is the board taking any steps to assess or monitor whether Vanguard and BlackRock are complying with the commitments made in November of 2019 and December of 2020, respectively?
I would have to check and get back to you on that.
Okay.
Familiar with the issue.
I appreciate that. But that says to me that doesn't sound like there's an assessment that's taking place ongoing or scrutiny of that. Is somebody reviewing that, or is someone in charge of reviewing that?
Honestly, that's a very specific, narrow question. I'm quite familiar with the
Well,
issue.
it's specific and narrow to two companies, but not to an industry. I mean, that's what we need to be driving at. And I guess we need to find out whether there's somebody proactively reviewing these activities and these commitments that the companies have made as well as the Fed has made. So how often do you think they should be reassessed? Annually, monthly, biannually?
This is a very narrow set of questions. I can get you great answers really easily, but I don't have them in my head.
I look forward to
Time
those
has
great
expired.
answers, and I yield
We'll
back.
now go to the gentleman from New Jersey, Mr. Gottheimer, for 5 minutes.
Thank you, Mr. Chairman, and Chairman Powell for joining us today. Chairman Powell, when you testified before the committee last June, PCE inflation was up 6.3% year over year. Just a few weeks ago, PCE data showed that the numbers decreased to 5.4%. We're moving in the right direction, but despite the Federal Reserve raising interest rates at the highest rate since October 2007, we're still far off from the 2% inflation that the Federal Reserve is targeting. Do you believe 2% is still the right target for inflation? And given the ongoing energy transition, the push to shift supply chains out of China, and the labor shortage here in the U.S., should the Fed consider adjusting its target to avoid overly burdening Americans? Would a decline to 3% inflation be enough to offer price stability without excessive economic pain?
No, 2% inflation is going to remain our longer-term inflation goal.
Are you concerned given all the other factors that I mentioned, or do you think we just have to keep sticking with that?
I think that's got to remain our longer-term inflation goal. It's the global standard, and it's our standard, and this is not a time at which we can start talking about changing it. We have no instinct to do that.
Thank you, Mr. Chairman. The gig economy has grown significantly in recent years as more Americans are working as contractors or running small businesses. The Dallas Federal Reserve has written that gig workers are often not included in payrolls and not counted among the unemployed, and this may understate the number of Americans who could be counted as unemployed. The Fed has also noted a large number of Americans who are missing from the workforce after the pandemic. Do we need to change the way we think about measuring unemployment to account for these changes?
I missed the word you're saying.
Sorry, do you think we need to change the way we think about measuring unemployment to account for these changes?
I didn't catch this. You said, what was the word?
Gig. Oh, sorry, gig. Gig
Gig
workers.
workers. Gig
Yeah,
workers.
so I'm sorry.
I didn't
Gig workers.
hear that. That's the word I didn't hear. Okay. No, we clearly need to incorporate gig workers both into the labor force and to whether they're working, and they certainly are working. We try to do that. It's not that we're not trying to do that. We may not be doing it perfectly.
Is there a better way to capture them? Just worried that you don't have the unemployment numbers may not, given we're still using older measurement ways. Are we updating our measurement?
We absolutely try. We're definitely trying to get those people, self-employed people. They do report in the household survey, I believe. I can get more for you on that, but
That'd be
I'm sure
great.
we're not doing a perfect job at it because it's a relatively new thing, but we're very well aware of it, and they're supposed to be included.
That'd be great. I'd love to talk to you more about that.
Great.
Thank you. As you're also aware, many of us are having discussions about the long-term fiscal health of our country and our economy. Like many, I worry that higher interest rates will put upward pressure on the national debt. CBO already estimates that annual interest costs will nearly triple for the U.S. over the next decade. You said to the Senate yesterday that interest payments are not a consideration of the Fed, but are you concerned that higher interest rates will more rapidly make payments on the debt unsustainable? And are there actions Congress should consider to address this issue?
So I'll say what my predecessors have said, which is that we're on an unsustainable path, and we really need to. Ultimately, we will get back on a sustainable path, and the sooner we get to work on that, the less painful it will be.
And rates, of course, were low between the financial crisis and the end of 2021, particularly low. After the target inflation rates hit, what do you think the new normal looks like in terms of rates and the Fed balance sheet over the next 5 to 10 years?
It's a really good question. There was a secular decline in longer-term interest rates, which we don't control, for 40 years to the point where they were, where the 10-year was at 10-year Treasury was at 10%, and then at the end of 40 years it was quite low. You're at higher levels. You're at, as you pointed out, levels we haven't seen since earlier in this century. I don't think anybody knows what this is going to look like 5 years down the road. So you have to ask, demographics haven't gotten better. Globalization may actually move a little bit in reverse, which would tend to produce higher inflation and thus higher rates. But you have to ask the factors that caused low rates, how much of that has changed? And some of it has, but much of it hasn't.
Building on that a little bit, what's the right metric you think for, if you're in our shoes, for assessing our fiscal health? Do you think we should be focused on maintaining a specific debt to GDP ratio, or is there a specific number? Are there other measures lawmakers should be focusing on?
So we've traditionally focused on debt to GDP, but many people pointed out before the pandemic that rates were secularly lower, and that therefore you could look at sort of real debt service. There was a lot of research on that. And by those measures, actually, debt service was much more easy to handle. Now we have the 10 years back close to 4%. And I think, we need to be careful not to assume that these secularly low longer-term rates are going to continue indefinitely, because that doesn't look likely now. And frankly, most forecasts have always shown things like the 10-year going back to a higher level. So it won't be that big of a change. I think it's more or less been handled, for example, by CBO that way.
Excellent. Thank you so much, and I yield back.
Now I'll go to the gentleman, the Vice Chair of the Digital Assets Subcommittee, and the Chair of the Housing Subcommittee, Mr. Davidson of Ohio, for 5 minutes.
Thank you, Chairman. Chairman Powell, thank you. It's an honor to be able to talk with you today, and appreciate the work you and the monetary policy focused portion of the Fed does. We're rooting for maybe a more consistent input from our bank regulators. So for the regulatory side, I've spoken with multiple bankers who tell me that they've never seen a higher degree of regulatory burden, steering, guidance, shaping activities in the market from regulators. And I don't think that's just narrowly focused on the Fed, but I'd ask you to look into it. There are a lot of people that feel like there's not Operation Choke Point 2.0 going on, and it's particularly focused on debanking people that are disfavored by the current executive branch primarily, just like the previous Operation Choke Point was. And so to the extent that you yield any influence over the regulatory component of the Federal Reserve, I think that would be meaningful and important, because our monetary system, part of the strength of the US dollar is, of course, a stable store of value. Currencies around the world are wrestling with that and inflation, and you guys are working to tackle it. But the other part is it's an efficient means of an exchange. And when people really feel like some third party is going to steer or shape their money, they don't trust it. I mean, the unbanked and the underbanked, fundamentally, that's lack of trust is part of why they don't use our banking system today. In fact, that's part of the appeal of the digital asset space, is the permissionless nature of it. It seems that a lot of people in the financial services space that have grown up in it, that are leading it today, feel threatened by the prospect of change. And if they've maybe reluctantly concluded that you can't ban crypto, they at least want to keep it account-based, so that some third party can actually control the assets which is a polite way of saying we don't actually trust our citizens to control their money or their assets. We'll let somebody else do it for them because we can control those third parties. And in fact, that's what the regulators do, isn't it?
Isn't what?
They control the third parties. I mean, if you don't comply with the regulatory regime, you don't get to operate a financial services business, right?
That's right.
Yeah. And so at the end of the day, I think a lot of people were concerned by your remarks yesterday. I know I was, by saying that permissionless digital assets pose a systemic risk to the financial system.
Well, what I think, what we said in our guidance, I think if you, by the way, I think if you read through the digital guidance, which I did getting ready for this hearing, of course, I read it before we put it out the first time, but it's pretty careful to say that we don't want regulation to oppose innovation and thus entrench incumbents and things like that. It's pretty balanced, the language, and I think it essentially goes to the question of protecting the safety and soundness of institutions. And there is one, what I think what we say about, I'll paraphrase it, what we say about permissionless blockchains is that they have been vehicles for fraud.
Yeah,
vehicles for theft.
0.24%. So if you follow your own report on fraud, it's a fraction of what it is with the US dollar. So speaking of the dollar, is there any real current threat to the dollar's preeminence as the world's reserve currency?
You say, you're asking a question, I didn't.
Yes, sir.
Is there a real threat?
Is there a threat?
I think that our status as the world's reserve currency is not under particularly strong threat right now. I think it's a pretty stable equilibrium. It's not a permanent equilibrium, but there isn't really a serious competitor, and that's not because of any of this. It's because of our democratic institutions and the rule of law, and the fact that the dollar's value is pretty stable.
Okay. So quickly on the repo market, just any insight into that, and then I'll have my last comment here and just leave the last word to you, but particularly curious about the repo market. But I'll close by simply saying I'd ask you to turn off the purchase of mortgage-backed securities. As the chairman of Housing and Insurance, I'm particularly concerned about affordable housing, and the artificial prop for the mortgage-backed securities does raise the cost of capital in that space. So whether you own it or occupy it or rent it, it's going to raise the cost there. But I'd just ask if you'd comment on the safety and soundness of the repo market, if you would.
Of the repo market. As far as I know, the repo market is functioning reasonably well these days. Are you talking about the reverse repo facility? Or
Yes.
The reverse repo facility is a different thing. We can continue this.
I'd like to follow up with you later, and my time has expired. I yield.
Thanks.
Gentleman from Illinois, Mr. Casson, is recognized for 5 minutes.
Thank you, Mr. Chair. Always a pleasure to see you, and appreciate your time here today. I want to start with this chart in your monetary policy report, which I think is fascinating. Chart 14 on page 17. This is this history of wage growth and job growth. And for those of you who don't have it in front of you, broadly speaking, from 2000 to 2017, we had more workers than jobs. From 17 until the COVID crisis, it was about the same. And since COVID, we've had more jobs than workers. And there's tons of rich stuff in here that I just enjoyed reading. But broadly speaking, if that was the only thing going on in the economy, I would assume that we had 20 years where it was essentially a buyer's market for labor, and the last year and a half where it's been a seller's market for labor. As you look at that, and if I go through and I look at from 2010 to 2020, CPI was up 20% over the period, and real median wage is less than 10%. So for half of the economy, they didn't keep up with wages, even though we think of that as a very low inflationary period. Corporate profits were also up strongly, as you would expect. I'm not saying that with judgment, right? If it's a buyer's market for labor, you would expect the gains from labor productivity to flow to consumers and profits, and that looks like what it did.
Which chart are you looking at?
This is chart 14 on page 17 of the monitor. It's the top right corner there.
Got it. Okay, thanks.
In the last year and a half, median wages are up 5%, which is almost as much as they grew during that 10-year period before. And yes, inflation is still a bit higher than that. But what I'm wondering is, as you look at the economy, is wage growth universally bad in your view, or is wage growth good to the extent that it's keeping up with wages? Because historically, wages didn't keep up. And how do you think through that nuance? Because interest rates are a very blunt tool. And, if we are now, if you agree with me that we're now basically in a seller's market for labor, shouldn't we expect and welcome some wage inflation that goes with that?
So I'd say two things. First, we want wages to go up in ways that are consistent with consistent over time with the increase in productivity and inflation. And that makes all the sense in the world. The other thing I would say is that in this instance, what we've seen is inflation eating up these very high nominal wage gains have very largely been eaten up by higher inflation. So it's very important that we restore price stability so that we can start to see real wage gains after inflation across the income spectrum.
Yeah, no, and to be clear, like we're all opposed to inflation here, but in that 2010 to 2020 period that we all viewed as a very low inflationary period, wages, the gains from productivity did not flow to labor. Wages did not keep up with inflation. And we didn't think about that as a problem for the Fed to fix because overall inflation was down. So, I mean, this gets sort of theoretical, but let's say that we had 6% wage inflation and 5% CPI. There'd be more money in people's pockets, but would we view that as a inflationary period to clamp down on? Because we didn't view the inverse as a problem, if you will.
So our job is to restore price stability and keep price stability. It isn't to keep wages down, and it's certainly not to get involved in trying to establish the appropriate level of labor share of profits, for example. That's not the way we think about it at all. We think about price stability, and when we think about price stability, we think about wages as an important input to that. But we're not targeting a particular level of prices, and we would never say that we don't want real wages to go up. What we're really charged with is price stability, and to do that, we have to think about wages. But in particular, no one at the Fed would be upset to see the labor share go up, but that's not something that our policies affect. That's set by globalization and the advance of technology and educational and skills and aptitude and all those things. That's what drives productivity. That's what drives, labor share.
Yeah, and it's hard to have these conversations in 5 minutes, I realize.
Happy to follow up.
I guess what's hard is that also in that 2010 to 2020 period, median home prices went up by 50%.
Yeah.
We didn't view that as inflationary. 401ks went up a lot. We didn't view that as inflationary because those were asset increases. And so as we have shifted the gains from people who had wealth to people who were dependent on wages, there needs to be some correction. And I leave it there because I'm out of time, but how we think about that.
Gentleman's time has
Thank you.
expired.
Go back.
We'll now go to the gentleman from Tennessee, Mr. Rose, for 5 minutes.
Thank you for being with us today, Chairman Powell. Chair Powell, I just want to echo at the outset some of the concerns that my colleagues have raised about Vice Chair Michael Barr's, quote, holistic review, unquote, of capital markets, and also about the Fed engaging in climate policy, as well as your decision to put Vice Chair Barr in charge of the Community Reinvestment Act rulemaking. With that said, I'm going to dive right into my questions. Chair Powell, I was pleased to see that the U.S. Coin Task Force released their report on the state of coin a few months ago. The report notes that the Federal Reserve and U.S. Mint will be jointly contracting with a third-party consultant to review the coin supply chain and develop recommendations to improve it. Chairman Powell, could you provide us with an update on what the Fed has learned from its review of the coin circulation issues that occurred during the pandemic?
So we know that the flow of coins, the natural flow of coins in the economy slowed down a lot because people were staying home and that kind of thing, and they may have switched to non-coin based means of payment. And we feel like that the evidence is that that's continued now. People are paying electronically and things like that, and coins are sitting in jars and on people's desks and at home, and they're not circulating back into the banks and thus to the retail stores. And so we're working on that. We're working with the Mint. We're working with all the stakeholders in the coin ecosystem to try to address this problem, and we're well aware of it.
So it seems to me that what we learned from that is that it's probably necessary to have a a greater reserve of coins if there is such an interruption in the future so that commerce is not indeed interrupted. Would you share that broad view?
That sounds right. I'm not an expert. I will say it feels like we need more coins now because more of them are sitting in people's homes and pockets, and they're not flowing back to where, retailers in particular need the flow of coins. So that sounds right to me.
On a related note, could you speak about the importance of maintaining cash as a viable payment option, particularly for those that lack or don't have access to traditional financial services?
We think it's absolutely critical because there are people who don't have credit cards. Many people don't have credit cards. They don't have good credit, and they need to be paying in cash. And when stores are not dealing with people who don't have cash, it's a serious problem for those people in the economy. We have it at the Board of Governors, and you see it elsewhere because most payments are now taken care of by credit cards, and it's very efficient. But we need to be looking out for people who use cash.
Thank you. I appreciate that perspective. Picking up on Mr. Lukemeyer's concerns that he expressed earlier, as you know, the Consumer Financial Protection Bureau's funding mechanism is intricately linked to the Federal Reserve System. According to Title 10 of Dodd-Frank, each quarter the CFPB director requests an amount that is reasonably necessary to carry out the Bureau's authorities, and the Federal Reserve must transfer that amount so long as it does not exceed 12% of the Federal Reserve's total operating expenses. For the first 5 years of the existence of CFPB, of course, there was a relaxation there with respect to that 12% cap that allowed $200 million annually to be spent beyond that number so long as it was reported, so long as the reported excess was sent to the President and Congressional appropriators. Chair Powell, during your chairmanship, has the Fed ever rejected a CFPB budget request?
I do not believe so.
And could you tell us what policies and procedures are in place at the Fed to ensure that there is no waste, fraud, or abuse, or that these limits are not otherwise exceeded?
So we have no role in engaging with that. It's really what we share a common inspector general who does work on those issues, but we don't in any way, we don't have any governance of any kind over the CFPB. We're just a source to them.
Thank you. I appreciate that insight. In closing, Chair Powell, yesterday Senator Warren asked you what you would say to the 2 million people who may lose their jobs if the Fed keeps raising interest rates. Frankly, Senator Warren should be asking herself the same question when she voted and advocated for the Democrats' reckless spending packages that caused this inflation that we are seeing today, and is the reason the Fed has had to raise interest rates, in my view. Frankly, I would call on Senator Warren, the President, and the Democratic Party, for that matter, to apologize to the American people for causing this kitchen table crisis across the country. With that, Chairman, I yield back.
Now recognize the gentlewoman from Massachusetts, Ms. Presley, for 5 minutes.
Thank you, Chairman Powell, for joining us today and for your testimony. I'm going to focus my comments and my questions on the high costs that families in my district are seeing because of your interest rate hikes. Now, while the Fed has acknowledged that higher interest rates are not the primary driver for the slowdown in price increases, you continue to raise interest rates, risking not only millions of jobs, but also a recession. Based on projections from the Fed, approximately 2 million people will lose their jobs. So that's 2 million families who will struggle to put food on the table, keep a roof over their heads, and to make ends meet. But the economic hardship does not end there. Mr. Chair, I would like to request unanimous consent to submit a recent paper by the Federal Reserve Bank of Cleveland titled Post-COVID Inflation Dynamics into the record.
Without objection.
Chairman Powell, are you familiar with this publication, yes or no?
No, I'm not.
Okay. Well, let me give you some context. In this paper, the Fed's own economists predict that reaching the 2% inflation goal that you have set will be impossible without causing a recession and spiking the unemployment rate to 7.4%, which translates to millions of working people losing their jobs. Now, Chairman Powell, many economists agree with me when I say that engineering a recession to bring inflation under control is not the right strategy, especially at a time when we are seeing inflation cool in real time, independent of your rate hikes. So on behalf of the people of this country, to prevent a recession, yes or no, Chairman Powell, will you pause future interest rate hikes?
We're not seeking to have a recession, and we don't think we need to have a recession to get price
Respectfully,
stability back.
will you pause interest rate hikes, yes or no?
I don't do yes or no on will I pause interest rate hikes. Yeah, that's a serious question. And I can't tell
Oh.
you because I don't know all the facts. That's not a
Reclaiming my
possible.
time. And in fact, it is a very serious question because it has a very serious implications. The people who will bear the brunt of an economic recession are our most vulnerable. We know from past experiences that recessions have catastrophic and deeply inequitable consequences. In fact, while some will catch a cold, others will catch pneumonia. But you know that, an economic cold or pneumonia. In fact, in your opening statement, you said, "We will stay the course until the job is done." To conclude, we understand that our actions affect communities, families, and businesses across the country. Could you elaborate, what is this effect to communities, families, and businesses, these interest rate hikes?
Well, right now we're trying to bring down inflation on behalf of all those families. I think high inflation is hurting, particularly working families all around the country, very badly. And as you know, if you're on a very limited budget and you don't have a lot of excess earnings, when prices start going up, you're in trouble right away. People, middle and upper middle class people have more resources. So we think it's absolutely critical for the working people of this country that we get inflation back under control. And also, while we're at it, we have a dual mandate.
Apologies,
and we-
Mr. Chair, I'm just reclaiming my time here. Here's the thing, the most devastating impacts will be to our most vulnerable. Veterans to our most vulnerable. Veterans, the elderly, low-income workers, Black and brown workers, those who have often ignored and been neglected in the name of what you refer to as appropriate monetary policy. And yet, you assert that you will stay the course. It's unconscionable, and our most vulnerable workers and families cannot afford to wait for you to realize the harm that you were doing. In my opinion, this sounds more like the assertions of a greedy corporation than someone who has a public mission on behalf of the people of this country. One more question with my remaining time here. Chairman Powell, another consequence of your interest rate hikes has been the increase of the average 30-year fixed mortgage rate to 6.6%, double of what it was 2 years ago. Do you see this widening inequity in the housing market as a problem? And what steps will you take to make housing more affordable? This is putting homeownership further and further out of reach for my constituents, new parents, millennials, people of color, contributing to inequities and the racial wealth gap. So what are your thoughts on that?
Well, our policies do
Gentlemen,
affect.
gentlelady's time has expired. Chairs can submit for the record or answer.
I'll briefly say that if I can, that our interest rate policies affect interest-sensitive spending very directly. When we cut rates, they help housing. When we raise rates, you see the effect on housing. So
Thank you.
The gentleman from South Carolina, Mr. Timmons, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Chair Powell, for being with us today. We currently have $32 trillion in debt. Our debt to GDP ratio is 120%, the highest it's ever been. And yes, we have a debt ceiling fight brewing for this summer. I would argue it's an opportunity to get our fiscal house in order. But sadly, there's no meaningful bipartisan effort to responsibly address our debt. Both sides have even preemptively started political attacks, alleging either side wants to cut Social Security and healthcare. But politics and talking points will not fix our problem. Our debt is the greatest national security threat. Social Security will be insolvent in 2033, and our healthcare system is fundamentally broken. We spend twice as much as the average country per person, and our obesity rate is 3 times the average. I want to be clear, though, I'm not advocating cuts to Social Security, but my Social Security will have to be different than my father's, and we must change the incentive structures of our healthcare system. Briefly, let's go over some history. Social Security was created in 1937. The retirement age then was 65. and average life expectancy was 60. Easy to see how that math works. In 1960, Congress raised the retirement age to 67. It has not been increased since then. That year, life expectancy was 69. That math still works due to a growing population, but it's getting narrower. I will throw in another few statistics for that year, 1960. 14% of Americans were obese, and our debt to GDP ratio was 53%. Let's fast forward to this year. Our retirement age is still 67, but our life expectancy is 77. That math clearly does not work, nor is the program functioning in the purpose for which it was designed. And shockingly, our obesity rate is 37%, and we spend $13,000 per person on healthcare compared to the global average of $6,000 per person and 13% obesity rate. Clearly, our healthcare system is failing. Our system focuses on managing sickness where we should be facilitating health and wellness. We will only meaningfully be able to address the debt ceiling by focusing on the biggest drivers of our debt. Responsible policymakers should be focused on saving Social Security by reforming it and transforming our healthcare system to facilitate a healthy citizenry capable of working and being contributing members of society. The American people deserve more than the political nonsense. 5 years ago, the number one issue I ran on was debt. It has been and continues to be our greatest national security risk. I hate to say it, but the last 4 years has gotten way worse. Congress has spent $7 trillion, of which $5 trillion was done mostly on party lines. The Democrat majority has not only spent money we don't have over the last 4 years, but their fiscal policy has caused out of control inflation, which caused you to raise interest rates. Last year, I asked you if you ever took into consideration the impact of interest rate increases on the cost of our debt service. You appropriately and adamantly said no. Our debt service costs the next 10 years will be over $10 trillion. I'm going to point out two things. Number one, that is more than all of our debt service since 1940 combined, the last 80 years. And while you did not take interest rate increases impact on our debt service into your decision-making, the best estimate is that those rate increases will increase our debt service cost by $2 trillion in the next 10 years. So basically, the $7 trillion that the Democrats spent in the last 4 years is going to cost us an additional $2 trillion. And that's not factoring in future rate increases as you continue to appropriately try to get inflation under control. As you can tell, this is a huge problem. The $7 trillion in unnecessary spending in the last 4 years has caused inflation. Some of my colleagues across the aisle disagree with that causal relationship. Clinton's Treasury Secretary and Obama's Director of National Economic Council, Larry Summers, wrote an op-ed before they spent the money and said it was going to cause inflation. And he has gone on the I was right tour for the last couple years. We need responsible policymakers to address our debt. Let's talk about what's not serious, and that's minting $1 trillion coin. Many of my colleagues across the aisle have advocated for this. Luckily, both President Biden and Secretary Yellen have said that this is not a serious proposal, and they have no plans of considering it. Unfortunately, the Biden administration has a bit of a history of doing a 180 when the political winds blow. Most recently, he said he would veto the DC crime bill, and now he's adamantly supporting it and plans to sign it. So, Chair Powell, my only question of you is if Biden and Yellen send you $1 trillion coin, will you accept it?
What I will say to that is that this only winds up one way, and that is with Congress raising the debt ceiling.
So you will not accept $1 trillion coin and treat it as $1 trillion if it's sent to you?
I'll add, there are no rabbits to be pulled out of hats here. This only ends with Congress.
I know you don't like yes or no's, but if you are sent $1 trillion coin and asked to treat it as $1 trillion, will you treat it as $1 trillion?
That would be a rabbit coming out of a hat.
I'll take that as a no. Thank you. Mr. Chairman, I yield back.
Now recognize the gentlewoman from Michigan, Ms. Tlaib, for 5 minutes.
Thank you so much, Mr. Chairman. Thank you, Chair Powell, for being here. You have a lot of economic, projections, economic projections, various data, various reports that are coming out. How much, and you've studied inflation, right? I mean, obviously, it's your #1 priority right now. How much is inflation impacted by these three things? Corporate profiteering, egregious executive pay, and the use of stock buybacks.
So I don't have numbers, but I would say in the case of executive pay and in the case of share repurchases, I can't think of how it would affect inflation. In the case of executive pay, that would be very small in terms of of the broader economy. In terms of profits, though, the way I think about that is profits are high. The places where profits are really high is places where there are shortages and supply chain issues. And as those things get better, as they are, you're going to see inflation come down and even prices come down, and you'll see corporate margins come down there. And that'll be part of how inflation comes down.
So does that corporate profiteering does impact inflation? You don't have any stats of percentage-wise, how much of it?
Yeah.
Because you seem, I really paid attention to your testimony in the Senate hearing yesterday. And there was a lot of conversation about, my neighbors and residents' wages and so forth. They're finally starting to see a little bit more closer to possibly getting fair wages. It's not even far enough. But I don't know if the Feds is paying closer attention to monopolies, corporate profiteering, and executive egregious pay. All of it, even the stock buybacks, you're saying all of that aside, you're focused more on wages and increasing the interest rate than on those other
Our focus
major-
is really on price stability, not so much wages. Wages play into that because they're an important cost for business, but we're not trying to achieve a particular level of wages. We're trying to achieve 2% inflation.
Yeah, and I think it's really important, Chairman, what we saw during the pandemic is, the wealthy and the corporations continued to profit in large scale and still do buybacks and still do really egregious executive pay and benefits and so forth for those at the top. And then, of course, the communities and such were impacted by it. But what I hear consistently is folks thinking that's the reason. All of a sudden wages are skyrocketing, all this. But all I see is continuation, again, of those that are already getting a huge benefit, the folks at the top, the executives and so forth. My friend Glenn taught me this today, that the Feds are actually sitting on, something in Dodd-Frank Section 956. You all are sitting on the last 12 years on guidance regarding executive compensation and the high risks of it. Like around, there was some sort of proposal done, not implemented. Again, it's been 12 years. Why is that something that you're not concerned about regarding inflation?
Well,
like you guys are sitting, one, you're sitting on it, right? Why?
Well,
It's been 12 years. And then two, why is that you're saying that's not big deal? That's not going to impact the cost of products and so forth for our residents.
It's a multi-agency rule, and there have been repeated attempts to get 5 or 6 or 7, however many it is, agencies to agree. That's one thing.
On disclosures?
No, this is it's on policies to.
Yeah, which include disclosures and arrangements regarding executive pay and the risk of it.
There. Anyway, 956 is, you're right, we haven't been able to get agreement among the agencies. But more to the point, their boards long since, this is just for the big banks where we have this authority, long since board of directors are very focused on how executive compensation works and that it not reward, unnecessarily risky behavior and that kinds of things.
Yeah, but in Dodd-Frank, which Congress passed, there should, you're supposed to put something in place, and it's not in place. And look, I'm saying this because so many people in this chamber, and I feel like the Feds are more obsessed with wages than they are in regards to the monopolies, the corporate profiteering. There hasn't been any, really, I don't think there is a laser focus on that. And it's really, because I think the Feds and Congress can support fair wages and still combat inflation if you are fair in combating egregious executive pay, monopolies, and corporate profiteering.
We don't do competition policy, and we also don't, broadly speaking, regulate corporate wages.
But 956 would have addressed it. 956 addresses it. You should have it's 12 years.
The gentleman from South Carolina, Mr. Norman, is now recognized for 5 minutes.
Thank you, Mr. Powell. Appreciate you coming in. I don't have to tell you the fact that so goes housing, so goes the economy. I'm from a state that, from South Carolina, we have people moving in, the population's increasing. And I can tell you housing, not just single family housing, is in trouble. People are finishing what's in the pipeline. It's now affected multifamily apartments, the high rents that they did get with inflation. That's entirely caused, for the most part, by the policies of of this administration with gas, buying it from other countries, with supply chain shortages. There's no reason to start a project when you can't get supplies. And that's what we're facing in the housing industry at all levels. So any increase in interest is just another dagger that's going to kill the housing industry along with commercial projects that, again, the pipeline's filling up, but the pipeline, once it leaves, you're not going to have any. And I'm from a state that's with people moving in. One of the things that you hear, I think Mr. Davidson mentioned, was regulations. Banks are complaining about being overregulated and the costs associated with it. CRA, I know when Brainerd left, it's in a state of flux. Who's determining that, and when will you have some guidelines out?
That'll be done by the whole Board of Governors when we vote on it, and also by the OCC and the FDIC.
Will they have any input from those who are having to pay the price of implementing CRA? Like, get any input from banks that are having to
Yes.
having to navigate?
So I know that throughout the multi-year process, there's been a tremendous amount of interaction with banks, tremendous amount, and bank lobby groups and also consumer groups. And then, but yeah, there's been a ton of input and, working with the industry to try to achieve these statutory goals efficiently. I won't say it's perfect, but there's certainly been a lot of interaction.
So they're getting input prior to implementing the requirements for CRA or the guidelines for CRA?
Yes, I think I'm I'm pretty sure there's been quite a bit of interaction with the industry in terms of what to do and how to do it.
Okay. Now, I think you've stated that you don't feel it's the Federal Reserve's policy to get into implementing climate change.
We're not, and we shouldn't be climate policymakers. We do have a small role, focused role to play, principally with the larger banks, to make sure they understand and can manage their climate risks in the long run.
Should it be mandated?
Should what be mandated?
Climate change policies be mandated by the Federal Reserve?
I think, again, climate change is something that's going to affect businesses and people and regions and states and whole countries. And I think that's got to be a job for elected people by and large. I think what we're going to affect is we just want to make sure that banks understand and can manage the risks that they're running, and these are principally longer term risks.
What's concerning to those of us in the business community who have to borrow for banks, the Federal Reserve is conducting a pilot climate scenario analysis that's being mandated, not asked, it's being mandated for the six largest banks to participate in. That seems to me like a pretty good, when you have to do a scenario and mandate that they do this, is that not the Federal Reserve getting directly involved in mandating?
I think the banks actually want this. They want these six big banks, they have to face this globally. And what they want is uniform approaches and guidance on how to have one set of rules. They're already running, the big six banks that we're talking to, they're already running climate scenarios all the time, multiple climate scenarios.
Most of the banks are well capitalized now. That could change. And this is just another expense that is out there. On the CFPB, the history, I think you said it was 12%. It cannot go above 12% ratio. Has that, that does not seem logical to me. Has it ever been below the 12% from your perspective?
That's someone here quoted the law, and that rang a bell for me. So that is what the law says. Have they been below? I'd have to go back. I'm happy to provide. It's all.
If you could, because it seems to me like that's if you've got that cap, businesses couldn't operate like that because it would be no incentive to reduce the price as long as it's automated. Thank you.
That's the way the law is set up.
Right. Thank you for being here.
Thank you.
The gentlewoman from Texas, Ms. Garcia, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Chairman Powell, for being with us today. The end is in sight. I would like to begin by highlighting an issue that has been a concern for the Congressional Hispanic Caucus and others. I know that the chairman has suggested that we're going to weave in the diversity and inclusion issues throughout our hearings. So here goes my concern. There has never been a Latino Federal Reserve president. And further, only about 5% of the Federal Reserve's overall workforce identifies as Hispanic or Latino. As we know, over the past year or so, there have been several presidential vacancies at the Federal Reserve banks, and there has still been consistent failure to appoint a Latino candidate. Chair Powell, are you aware of this trend, and do you agree that it's a problem that our diversity and inclusion numbers are in Federal Reserve Board are not reflective of the Latino population?
Yes, it's something we've been focusing on.
All right, and can we get a commitment from you that you'll work on the workforce issues internally?
Yes.
Well, thank you so much. And I'd like to now follow up a little bit on some of the questions from Representative Norman, because I too have a concern about housing costs, particularly as it relates to equity and the negative impact on minority communities. I think you said in your paper that activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. As he mentioned, the rates are higher, not only impacting single-family housing, but multifamily housing. And it's also becoming even more and more difficult for people in my district, which is 77% Latino, to be able to buy their first home buyer, the workforce, entry-level kind of housing. As financing homes get harder, as mortgage to find and mortgage rates rise, the population of home buyers is skewing towards older, wealthier, and whiter communities. In many cases, in our suburbs, equity firms are buying out the housing stock. Chair Powell, can you please speak about the relationship between Federal Reserve interest rate hikes and housing inequity, and what needs to change here?
Well, what needs to change is we need to get inflation under control so that interest rates can come back down. In the meantime, they're high because inflation is hurting all of your constituents, not just the housing sector, and all of everybody's constituents. And it's our job under the law to restore price stability and also to keep maximum employment.
Is there anything else that Congress can be doing in this respect?
That would be up to Congress, but there are lots of ways in which Congress can support people in various ways. But that's really in your hands.
Right. And I want to move on into the numbers that you mentioned again in your remarks at page 2. You mentioned that of course, we all know there's been a record historic unemployment rate. It's down now to 3.4%, the lowest, I believe, in history. And thank you, Mr. President, for that. But you also mentioned that there's 1.9 job openings for each unemployed individual. I wondered if you could tell me how you define unemployed individual. What does the unemployed individual profile look like?
So that has a very specific meaning. It's someone who is not working but is actively seeking a job. So for example, if you take 6 months off and stop looking for a job, you're no longer unemployed. So that means there's a group of people who are kind of around the edges of the labor force who don't count as unemployed. And those people are marginally attached to the labor force, that kind of thing. But to be actually unemployed, you've got to be looking actively for work in the statistics.
Right. So it does not include people who are perhaps disabled and cannot find accommodations in the workplace to be able to get a job.
Unless they're looking for it. If it's the test is whether you're actively looking, I think in the last.
Actively looking regardless of, age,
That's right.
whether or not they're.
It's not a value judgment. It's the way we assess unemployment. We look at the other groups too, but actual unemployment is.
How do you factor in the people that actually are on unemployment insurance?
Sorry?
How do you factor in the people who are on unemployment insurance?
Well, they're unemployed. They've got to be by definition. We count them as unemployed or they wouldn't qualify under the state requirements.
All right. Well, I just want to make sure that we clearly understand that there's children, there's people that are older, people that are disabled, people that can't find daycare. There's so many other reasons why someone is unemployed.
Yes.
All right. Thank you. I yield back.
Gentleman from Wisconsin, Mr. Stile, the chair of the House Administration Committee, is recognized for 5 minutes.
Chairman Powell, thank you for being here with us today. Your testimony today has been insightful as we look to tackle inflation, the impact that it's having on families across the United States right now. I want to go back to a comment that was quoted to you as regards to a question from Senator Kennedy yesterday regarding the impact that fiscal policy is having as it relates to inflation. And the quote that was attributed to you was that it wasn't a big factor. As we look at kind of a whole host of policies here on Capitol Hill, from reckless spending that we saw in the previous Congress, a lack of what we just discussed, individuals who are outside the labor market. How do we get these folks back into the labor market, whether or not we have policies that are discouraging folks to come back into work? As we look at high energy costs and opportunity to drive energy prices lower by unleashing American energy. How do you factor in the fiscal policies, or how should policymakers factor in the fiscal policies and their impact that's also having an inflation? Not looking for your advice on the fiscal policies, because I know you want to stay out of that, but how should lawmakers be looking at the fiscal policy and its impact on inflation?
So let's take energy, for example. So remember, inflation is the change in prices. It's not the level, as you well know. So energy prices have been coming down, right? They're still high, but they've been coming down, and they're contributing negatively to headline inflation. So when I say it's not contributing to inflation, that's what I mean. In addition, if you look at aggregate spending, it peaked, and then it's been coming down. So the fiscal impulse is actually negative at this point. It's no longer most of the inflation that we now have, something like 2/3 of the contribution of inflation in core PCE inflation comes from the services sector. And that isn't really about fiscal policy. Fiscal policy was important at the very beginning, so was monetary policy, by the way, but now it's more about just inflation is out there, and you have to bring it down. The record is it doesn't come down by itself unless it's driven by, transitory factors. For example, in the goods sector, the supply chains have been getting better, and as that's happened, goods inflation has come way down, and sometimes it's negative now. I hope that's helpful.
Yeah, no, thank you. And so to take that one step further, we're waiting on the president's budget. It's over a month late, but we're anticipating receiving that in the near term. And as we look at interest payments on the debt and the cash flow implications that has, not asking for what you're going to do at the next board meeting for obvious reasons, but as you are in those deliberations to future board meetings and potential rate increases, how does the impact of interest on the debt factor into the calculus of you and your colleagues?
So we don't look at that. We're not, if we started to change our monetary policy because we were concerned about the level of debt payments and things like that, that's not something that the United States needs to do, and it's not something we do.
Why would it be something the United States doesn't need to do? Could you elaborate on that?
Yeah, we're going to do our job. Congress has given us the job: maximum employment, price stability, regulate the banks, manage the payment system to some extent. We'll do those jobs. We don't have to worry about the United States budget. That is not our job. And it isn't that the debt today is unsustainable. It's that the path is unsustainable. So we can service our debts. It's just that we're on an unsustainable path, meaning that the debt is growing faster than the economy. So we will never look. If a central bank has to avoid taking actions because it's concerned about the budget, that's called fiscal dominance, and that's a thing you don't see among advanced economies, and it would be something we think we're a long way from that.
Thanks for your feedback on that point. The CBO just released their report showing potential interest payments on the debt accelerating dramatically over the next decade, showing it would be 14% of our fiscal spend. To compare that, right, national defense would be 13, Social Security is also 14, so it's in that level. That's a policymaker issue, but your insights are helpful. I know I only have a few seconds left, and a handful of my colleagues have commented on the ongoing review of bank capital standards. I just want to echo those concerns about what the impact would be of a significant capital level increase. Could you just comment briefly about how you quantify the cost of higher capital and the supposed benefits, and how you balance out that risk and reward?
So it's always a balance, exactly as you say. We know that the capital increases that I supported back in 12, 13, 14, 15, 16, earlier in my time at the Fed, they made the banks stronger and they made them more resilient. And you really want that. You want a banking system that can stand up and keep doing its job in times of crisis. So but the exact balance between that and the availability of capital and the cost of capital is always going to be a matter of judgment.
Thank you very much. I yield back.
The gentlewoman from Georgia, Ms. Williams, is now recognized for 5 minutes.
Thank you, Mr. Chairman. As the member of Congress representing Atlanta, the city with the highest racial wealth gap in the country, I'm focused on creating an economy of inclusion, an economy that works for everyone and brings the most marginalized into our economy. Americans and Atlantans flourish when the economy works for everyone. The Federal Reserve has a mandate of maximum employment that is measured by analyzing various data points of economic conditions. In 2020, the Federal Reserve updated its approach to fulfilling and measuring this mandate to include job growth that was broad-based and inclusive. Chairman Powell, do you agree that broad-based and inclusive growth means job growth that helps reduce racial, employment, unemployment, and wage disparities?
I think it means what it says. We don't target any particular, we can't really target a particular racial or ethnic group with that, but we like to think that our decisions are informed by an understanding of diverse groups across the economy.
Well, Chairman Powell, could you share examples of how the Fed is including broad-based and inclusive job growth in the maximum employment mandate?
Sure, I'd be glad to. So one thing we do is we always, it's always part of the data that we look at each meeting. We always talk about it. We always mention it. Different unemployment rates and labor force participation rates and wage rates and things like that by racial, ethnic, gender groups and that kind of thing. That's always in the data that we look at and talk about. That's the first thing. So it informs our pursuit of maximum employment. We're trying to take a broader and more inclusive understanding of what that statutory goal means.
Thank you. 2 weeks ago, the Federal Trade Commission released data indicating that Georgians reported the most fraud and scam claims of any other state in 2022, amounting to millions of stolen money. The Federal Reserve's website has resources to help consumers protect themselves from scams where criminals leverage the Federal Reserve's name, including emails claiming potential victims are eligible for lottery winnings, robocalls threatening arrest in exchange for money, and other phishing communications. Chairman Powell, how does the Federal Reserve measure whether its counter-fraud communications are reaching the most vulnerable households and communities, especially those that might not be following the Federal Reserve press releases or your website or have limited access to broadband?
So we do, when those kind of scams happen, particularly when they involve us, we go on social media to try to reach people and tell them that if they're contacted by someone pretending to be a Federal Reserve person, that's not. So we do that. We work with our Inspector General who works with law enforcement to make sure that law enforcement's involved. So we're aware of these scams. I think you're talking about the ones that involve people pretending to be a Federal Reserve person and get in touch with me and we'll send you some money. And so we do what we can to reach out to the public on that.
So that is that after the fact, but what happens before so that the general public is aware that this is happening? For those people who are not on social media or tracking is there another way to get this information out to the general public?
We do what we can. We're not an institution that deals with the general public very much. We deal with banks and of course our rate hikes and rate cuts, our monetary policy affects all Americans. But I think when something like that happens, it's a broad program. It's a bunch of people who are perpetuating a fraud on many, many people, and we try to get out there quickly and try to reach people, and again, also alert law enforcement.
Thank you, Chairman. And Chairman McHenry, I yield back the balance of my time.
That is very kind and gracious of you. The first of the day. We need to commend that for the record. With that, we'll recognize the gentleman from Pennsylvania, Mr. Muser, for 5 minutes.
Thank you very much, Chairman McHenry. Thank you, Chairman Powell, for being with us. Chairman, is the Fed's commitment regarding ESG not to force investment banks to renege on their fiduciary responsibilities?
We don't actually have policies in effect in that space. That's not an assignment that we have.
You saw some issuances by heads of some investment banks, not to mention any names, that felt that was the case.
That the Fed was asking them to, we don't.
SEC, Fed, you stated a couple of minutes ago that you feel that some sort of ESG, you stated that banks want it. And
I'm telling you, no, that's different, completely different. It's regulated financial institutions that we regulate and supervise They're subject to, particularly the big ones are subject to
So the Fed, so
climate change.
you agree that
Climate
the Fed
change
won't,
issues all over the country.
won't ask banks to renege on their fiduciary responsibilities? The Fed won't do that.
We don't regulate the investment banks. The SEC does.
Okay. So the answer is no.
What's the question again?
I'll move on. Earlier, some of my colleagues and Chair McHenry questioned the holistic review of the capital bank holdings. This holistic review, which no one has seen, according to my sources, but there are published reports that it will call for more capital to be held by banks. I understand the deferral to Vice Chair Barr, but do you have any thing that you could add that would warrant a need for large banks' capital increase?
So there isn't a proposal to evaluate or talk about yet. Vice Chair Barr has indicated he was going to take a look. He said he thinks capital is strong, and the question really is it strong enough? And I know he's been working, and there'll be a process when he does arrive at conclusions. He has no authority to enact something himself. It has to go through the Board of Governors, also through the FDIC and the OCC.
Okay, this has
So there'll be
nothing
a
to do with the
transparent
QT,
process.
I'm sorry, with the QT initiative, the tightening of the money supply? They're not related at all?
No, I would say not.
Are you comfortable with the QT reductions which have taken place?
Yes, the balance sheet is, we have the balance sheet moving down at a healthy clip, and it seems to be going pretty well.
Okay,
Very well.
so the Biden administration's fiscal and energy policy has caused trillions in deficit spending, as you well know, very, very excessive trillions. Meanwhile, energy costs for the average American have, from heating oils to gasoline, have increased by over 40%, and businesses, of course, in just over the last 2 years. So high energy obviously affects the cost for manufacturing, wages, general cost of living in almost every aspect of society. Would not such fiscal and energy policy work of the Biden administration working hand in hand with initiatives such as QT and initiatives of the Fed be far more effective than the Fed fighting inflation on your own?
Well, I mean, we are the agency that has the responsibility to restore price stability, and we just have to do it. That's the task we've been given under the law. It's great if Congress helps. It's great if the administration helps, but we have to deliver it, and we will. That's our responsibility, which we fully accept.
We're not risking stagflation if the fiscal policy and monetary policy are working against each other?
Again, we don't comment on fiscal policy. That's for elected people, and we have a job, maximum employment and price stability. We use our tools. We try to stay in our lane, stick to our knitting.
It's just the fear of a number of people that we're going to have high interest rates and higher than 2% inflation if there's not that level of fiscal and monetary cooperation.
Again, fiscal
i.e.
policy does what
stagflation.
it's going to do. We take that as exogenous. That's the fiscal policy will be what you and your colleagues do with, and that comes into the economy, and we see it, and we don't have a view. We don't try to comment on the decisions that you make, and we use our tools to restore price stability no matter what happens outside of our building.
Sure. Okay. Mr. Chairman, I'll yield back. Thank you.
Gentleman yields back. We now recognize the ranking member of the Oversight Subcommittee, Mr. Green of Texas, for 5 minutes.
Thank you, Mr. Chairman. Thank you, Mr. Powell, for being with us today. I greatly appreciate your work, but I would like to take just a few moments to talk about how our legislative bodies have legitimized systemic racism. It's been done by having a Fed that has a responsibility to produce maximum employment, knowing that the 2-to-1 black-white wage gap exists traditionally, and also knowing that traditional actions and methodologies will not change that. But yet, we won't give you the authority to make recommendations or to take actions that would directly target that. It's not your fault. It's the legislative body's fault. We perpetuate systemic racism in your mandate of maximum employment. We also perpetuate it in lending because we know that invidious discrimination exists in lending. We know it exists. And there are laws that will prevent and punish persons who cheat banks. You will be prosecuted and you will be fined criminally if you cheat a bank. No such law exists if you cheat a customer. And we know that Black people who are more qualified than whites will get less money when they get a loan and pay a higher interest rate. These are all things that are the case. They're true. So legislative bodies continue to legitimize systemic racism. And the bodies have become so bold now, so many of the members, they're so bold now as to say they're sick and tired of hearing about this. They don't want a discussion about racism and systemic discrimination. They believe that all is well as long as all is well in the white world. But many, they won't say it that way, Mr. Powell, but that's the way their actions would lead one to conclude they have positioned themselves. Many of these people are my friends, people that I associate with, talk to regularly. But there comes a time when you just have to be truthful. Systemic racism can be eliminated. It can be dealt with. We know how to, but we don't have the will to do it. So I don't fault you. I don't fault you. Not one scintilla of blame would I cast your way. It's the legislative body. It's the people who sit on this committee who won't allow laws to be passed, making it a crime to deny a person a loan who is qualified to get that loan. People on this committee who will say they don't want to hear anymore and encourage persons who are professionals, experts, encourage them to push back against talk about invidious discrimination. Systemic racism emanates from the legislative body. And you, sir, are in a very awkward position because I genuinely believe that you'd like to do something about it, but you can't. Creates a sad state of affairs. I thank you for the time, Mr. Chairman, and I yield back.
Gentleman's time has expired and yields back. The gentleman from Wisconsin, Mr. Fitzgerald, is recognized for 5 minutes.
Chairman, thanks for being here today. Probably get right under the wire here.
Wait, they're going to go over.
I just had one, and some of my colleagues have touched on this today again, that there's certainly, I think we're well aware, I'm well aware that there's a dynamic back in the district and across this nation. There's a certain segment of adults, 25 to 35-year-olds, many of them dual income, no kids, and they are completely froze out of the housing market right now, either because the cost of a home at a new subdivision in any municipality is $500,000 or more. And as a result of that, it's not only by actions of the Fed, I think, on the interest rates, but certainly the other thing I wanted to bring up, because the balance sheet at the Fed has gone from $4 trillion to $9 trillion post-pandemic, could the Fed, by no longer buying mortgage-backed securities in a smaller universe of the private sector buyers who demand a higher rate of return, right? is there not another kind of built-in trigger there that mortgage rates are going to continue to go higher, unrelated to what the Fed does? Because I think the concern is that between the dynamics of no new subdivisions, 25 to 35-year-olds unable to get a loan, and then interest rates continuing to climb, all of these factors are just, we're going to lose a generation of adults here that are never going to get home ownership. They're never going to benefit, which we all know is the big wealth builder for any family. So I'm just, if there's anything I take away from what we heard today in the questions asked, I hope that that is something that the Fed is in tune to and is looking at closely.
One thing is that there's a challenge with supply nationally, and that's zoning, it's people, it's materials. And so the housing stock is constrained to some extent by just harder to find zoning anymore because things are so built up in so many places. And those are not things that we can control. In terms of our ownership of mortgage-backed securities, what happens with them is they mature, or they're repaid or prepaid, and they run off on their own. That's a passive sort of way to shrink the balance sheet. And of course, they don't run off very quickly when rates are this high because people are not refinancing their mortgages because they have much lower mortgage rates. So, there's no evidence at this point that, that the market's having a hard time absorbing, the supply of mortgages because the supply of new mortgages is very low. It's probably right, it has to be right, that when we're no longer buying mortgages, and we're not buying mortgages now, and I hope we don't have to buy any more mortgage-backed, we don't buy individual, we buy mortgage-backed securities. I hope we're not doing that anytime soon. We only do that in really severe situations. That the fixed income markets are gigantic, and there's a lot of buyers out there, and where there's a yield, there'll be buyers. And I think I expect that'll be the case. It might, not that it wouldn't have some upward pressure on rates for us not to be a buyer anymore, but we weren't a buyer for a very long time. We thought we'd never go back in after the global financial crisis, and we kind of had to after the pandemic financial crisis just to keep the markets working, and now we've stopped again.
Good. Thank you very much, Chair, and I yield back.
Gentleman yields back.
All right, bro, that's it.
Noteworthy. I want to thank, in particular, our members, Mr. Fitzgerald and Ms. Williams, for their additional minutes back to the Fed chair. In a rate environment like this, time is money, and that's much more valuable these days.
Yeah, give them an
I'd like to thank the
applause.
Chair for his testimony.
All right.
And without objection, all members will have 5 legislative days with whom which to submit additional written questions for the.
All right, guys. So that is it for today. We're going to be doing a crypto show, so don't go anywhere. As soon as we close this stream, we're going to be doing a crypto show. Let me know what you guys think. The market is essentially completely flat right now. I'm going to say the same thing I said again yesterday. Y'all need to stop being so emotional about this, man. Like, listen, we test the highs. Everybody's like, ah, ha, ha, shorts. Ah, ha, ha. We test the lows. Everybody's like, ah, ha, ha, longs. It's like, bro, we're just ranging back and forth. We're literally completely sideways right now. The market has basically been completely sideways since the open. Stop being so emotional about the stock market, everybody. Before we go on, I appreciate everybody joining the stream. Check out Chart Prime. Chart Prime is a trading view indicator service that gives you custom alerts and can be really powerful. Like, what they do is they automatically document support or resistance. They show you reversal potential, reversal patterns, reversal potential. They show you range support. They show you support or resistance. They show you candlestick patterns. Like, look at how useful this is, guys. Genuinely, look at how useful this is. This thing literally has basically 100% accuracy today. Like, look at this. All right, just before we go on to our crypto show, look, reversal down, drop. Reversal up, bounce. And these don't repaint. The real edge is when 2 of them show up together at once. Look, 2 of them here, a bullish engulfing candle and a reversal up signal, bounce. Reversal down, drop. Reversal up, literally right at the bottom, bounce. 2 bearish engulfing candles, drop. This one bounced at the candlesticks. This one, double candlestick and reversal up signal, bounce. And they automatically document support and resistance. You can see the range here, which was actually correct again. And you can use them on any time frame. They're actually really, really cheap. And right now they have a sale where you get 40% off. So they have a 40% off sale going on right now. So yeah, it can be really, really useful. And right now it's like $35 a month. I think it's like $35 a month, and you can really use them on any time frame. So you can use them on long-term time frames, short-term time frames. Look at this one. It literally predict the bottom over a day's period of time. If you want to check it, it's called Chart Prime. Check them out. Also check out Top Step. Top Step is a funded account program for futures. You can find both of the links for this in the description. Here's Chart Prime right here. Again, $35 a month. Very cheap right now. Very cheap. Yeah, no worries, guys. No worries. Also, check out Top Step. Top Step is one of the ways you can trade these big economic releases. You can short the market, day trade in futures, and test your skill without risking a lot of money. Top Step funds you if you prove your profitability. They give you a demo, and then if you can prove your profitability, they fund you between 50 to 150K. The most legit futures funded program in the world. They've been around for over a decade. They pay out millions every year. Great way to test your skill without taking on a lot of risk and actually get your foot in the door with day trading. And you're day trading the S&P 500 in futures with the E-mini or the SPY. So check it out. There's the link. I will be back tomorrow, bright and early. Tomorrow, we got some stuff going on tomorrow, guys. So again, I'm going to end this stream, and as soon as we close it down, I'll see you guys over on the updated stream. So yeah, good luck. Love you all. Good luck. I'll see you guys later. Again, we're going to be doing a crypto show today, guys. So we're going to be doing a crypto show. So literally, as soon as we end this stream, it's going to bring you to our crypto channel. I'm just trying to make sure it works and it actually redirects you guys. And yeah, we're set. So as soon as we end the stream, we're going to start the crypto stream right now. And as soon as we end the stream, it'll bring you to the crypto stream. I'll see you over there.